Okay, so let us start with share-based payments first of all. Now, what is the meaning of share-based payments? So, share-based payment basically means entity is purchasing any goods, okay, is taking any services or purchasing any assets. So, understand first of all, entity is purchasing these things. Entities purchasing goods, assets or services. Now definitely if the entity has made a purchase, entity has to make the payment, right? Entity has to make the payment. Now if the payment is made in the form of equity shares of my own company, if the payment is made in the form of equity shares of my own company, then this transaction is called a share based payments. This transaction is called a share based payments. Now understand, this transaction can be settled in two forms. Let's suppose Reliance company has purchased an asset. Now the price of that asset was, let's suppose, $10,000. Now Reliance company has issued equity shares worth $10,000. That is called a share based payment. Okay, now let's suppose Reliance company has purchased an asset. To settle this transaction, Reliance company says that I will give you cash based on market price of my equity share. This is called a share based payment. Okay, now Mukesh Bhai Ambani purchases an asset and pays the amount in cash equal to the fair value of the asset. Is this transaction in the scope of share based payment? Tell me, is this transaction in the scope of share based payment? No, no. So if the consideration for the purchase of goods, services or assets is based on the shares of my own company, then that transaction is covered in the scope of share based payment. Now let me take one more example. I have not purchased any assets or goods or taken any services. No, I have not done anything. But still I have issued equity shares to my investors and took the cash from them. Will that transaction be covered here? No, that transaction will not be covered here. That transaction will also not be covered here. So understand, when we are studying about share based payment, there has to be two things mentorily. Point number one, the entity should have purchased the goods or taken the services or purchased the assets. Now because it has purchased these things, now it has to pay the consideration. Now the consideration is based in the form of equity shares of my own company. In that case we say that this is a share based payment transaction. Is it clear, everyone? So share based payment now is divided into two parts. Our discussion on share based payment is divided into two parts: share based payments to employees and non-employees, though our syllabus covers majority part for share based payment to employees, but we'll discuss a quick overview of share based payment to non-employees as well. Okay, we'll discuss a quick overview of share based payment to non-employees as well. Okay, so first of all, let us discuss the share based payment to employees of the company. Now understand why this transaction is covered for employees. Understand here. So what happens, let's suppose this is Reliance and these are the employees of Reliance. Right? So don't you think employees of Reliance gives services to Reliance company? Employees of Reliance gives services to Reliance company, for which Reliance company has to pay salary to the employees. Right? Now this salary, if I pay in the form of equity shares of Reliance, don't you think this transaction is covered in the scope of IFRS 2 share based payments? Right? So this is what is happening. Now to understand the accounting treatment for share based payment to employees, we need to understand few basic terminologies. So now what are the few basic terminologies? Grant date. What is the meaning of grant date? So the standard says that date when the share based payment is approved by the shareholders and communicated to the employees, that date is called as the grant date. The date when the share based payment is approved by the shareholders and it is communicated to the employees. Then what is the vesting period? The period over which the vesting condition has to be satisfied. What is the vesting date? The date when the vesting period is over, the date when the vesting condition is satisfied and the employees are eligible to take the shares, and the employees are eligible to take the shares. What is the exercise period? The period over which the employees are eligible to take the shares any time during this exercise period. Employees can take the shares anytime during this exercise period. Now, what is the exercise date? The date when the employees exercise their right to purchase the shares from the company, to take the shares from the company, to take the shares from the company. So I believe you are understanding the meaning of grant date. Grant date is the date when the share-based payment is approved by shareholders and communicated to employees. Vesting period is the period when the vesting condition has to be satisfied. Okay, vesting date is the date when the date on which the vesting condition is completely satisfied. Exercise period is the period over which employee has to exercise their right of taking the options of taking the shares. Okay, now exercise date is the date when the employees actually exercise their rights and take the shares. Okay, so this is what is the meaning and the basics of share based payment. I believe it is clear to all of you. Now moving further, so as you know the basics, few further basics of share based payment, understand. So if you can recall, I discussed in the class three basics. What? Share based payment are of two types: equity settled and cash settled. Equity settled and cash settled. Now, equity settled means settlement in the form of equity shares of my own company. Cash settlement means equity settlement in the form of cash but based on the market price of my own company. Settlement in the form of cash but based on the market price of my own company. Now, if it is equity settlement, I will record what? Share based payment reserve. I will record a reserve. If it is a cash settlement, I will record what? I will record what? Provision. I will record what? Provision for share appreciation rights. Provision for share appreciation rights, or even I can record SBP liability. SBP liability, but we don't know what is the actual amount. We don't know what is the actual amount that will be paid, right? Because in cash settlement, as you know, we pay on the basis of intrinsic value on the exercise date. So as of now, we don't know what is the actual amount that will be existing there. But yes, we can estimate. Hence, it is called as provision, not a liability. Okay. Now, this is the first point. Second point. For equity settled, we consider fair value on grant date. Okay, and for cash settlement, we consider fair value at each reporting dates. At each reporting date, we will consider the fair value. At each reporting date, we consider the fair value. Okay. Now the third point. Changes in fair value. Do we consider changes in fair value? Do we consider changes in fair value in case of equity settled? No, we don't consider that. But in case of cash settled, we do consider changes in fair value at each reporting date. Yes, we do consider the same. Okay. So these are the few basic points. For share based payment. Now moving further. Okay. Now use of fair values. So you know, if it is an equity settled, you will consider fair value on grant date. If it is a cash settle, you will consider fair value on each reporting date. Vesting condition, I will come back to the vesting condition again, but not now. Moving on to the further, how to calculate option expense. So the option expense you will calculate is number of employees. Number of employees should be the best estimate. Understand. Let's suppose this is your vesting period. Okay, so over the vesting period, you need to see. Let's suppose you are standing here. This is your vesting period. Okay, 1, 2, 3. You are standing here. Then you have to see how many number of employees will be existing here. You have to evaluate, you have to estimate how many number of employees will be existing here. Let's suppose if you are standing here, then you have to see how many number of employees have all actually left here, they have actually left here, and how many number of employees will leave here. So basically we have to see how many number of employees will be existing here on the vesting date. Let's suppose you are standing here, so you have to see how many number of employees will be existing on the vesting date. So you have to make a best estimate of the number of employees that will exist on the vesting date, Now the examiner will give you this data in multiple forms. Examiner can give you this data in the multiple forms. How? So form number 1, examiner will say that this is the actual number of employees who have left in the past. This is the estimate of the number of employees that will leave in the future. Okay, that will leave in the future. Actual and estimate number of employees the question will give you. Second, the question will say 10% employees will leave over 3-year period. Over the entire 3-year period, 10% employees will leave. So let's suppose on the grant date you had 50 employees. So what is the number of employee on the vesting date? So 50 multiplied by 90%. Let's suppose question says 10% over 3-year period. Now let's suppose question says 10% per annum. 10% per annum. Then what will you say? 50 employees multiplied by 90% multiplied by 90% multiplied by 90%. But if it is 10% over 3-year period, then I will say 50% multiplied by 90% is equals to 45. It equals to how much? 50 into 0.9 into 0.9 into 0.9 is 37 employees. Tell me, is that clear, everyone? Are you clear on this part? Tell me. Okay, so this is the number of employees. Options per employee will be given in the question. Fair value per option, you have to see if it is equity settled, grant date, if it is cash settled, reporting date. Now expired period, cumulative expired period. Let's suppose the vesting period is 3 years. Okay, so at the end of first year, expired period will be 1. At the end of second year, the expired period will be 2 years. At the end of third year, expired period will be 3 years. Divided by the total vesting period less expense already recognized. So what you have to do is, let's suppose this here. So you are standing here. So you will calculate the expense for this period. Now let's suppose you are standing here. So you will calculate the expense for this period and then deduct the expense for this period. So expense already recognized in previous years, you will deduct here. Okay, let's suppose you are standing here. Then what will you do? You will calculate the expense for this period and then you will minus this period. Then you will minus the expense that you have recognized in previous years. So this is how you calculate your option expense. Is that clear, everyone? Now, as we discussed that we have two types of share-based payment, that is equity settled and cash settled. So let me discuss both. So now in equity settled, what will you do? At each reporting date, we will calculate the option expense using this logic. And we will record employee benefit expense account debit to SBP reserve. Now, and on exercise date, if the options are exercised, what will I do? I will first of all request exercise price from the employees. I will first of all take the exercise price from the employees. Now you will ask me, sir, what is the meaning of exercise price? So let me tell you. So now let's suppose Reliance shares are traded in the market at the shares of Reliance are traded in the market at, let's suppose, rupees 2800. Now Mukesh Bhai Ambani says that I will give these shares to my employees because I have received services from my employees. So now what Mukesh Bhai Ambani says that, okay, fine, but I will not give you these shares for free. I will take some money. So let's suppose I will take only 200 from the employees. 200 is a nominal price that I will collect from my employees. Okay. So this 200 will come under bank. It is called as exercise price, the price which the employee has to pay to take the shares. Okay, now SBP reserve, whatever expense you have recorded over the vesting period is called as SBP reserve. See, SBP reserve. Okay, now to equity share capital you will issue the shares and the differential will go to securities premium. The differential will go to securities premium. But if the option gets lapsed, then whatever SBP reserve that you have created will be transferred to retained earnings. Is that clear, everyone? Is that clear, everyone? Okay, so this is all about share based payment, equity settled share based payment. Now comes cash settled share based payment. Now in cash settled share based payment also we will consider the approach that we will use is the same, but there are few basic differences here. So understand, when you are recording the expense, employee benefit expense account debit to provision for SAR, as I discussed here, see here, as I discussed, we'll record provision for SAR, we'll record provision for SAR, we'll record provision for SAR. SAR means share appreciation rights. Now, on each exercise date, see, understand, on reporting date, we'll do this. On exercise date, on the date when the employees actually avail their rights of taking the cash, then in that case, what will I do? Provision for SAR account debit to bank. Now understand, I have recorded the provision for SAR at fair value. But I will be paying at intrinsic value. What is the meaning of intrinsic value? So intrinsic value means market price minus exercise price. The net market price of the share minus the exercise price, because it doesn't make any sense that first of all I will ask the employees to pay the exercise price and then I will give them the market price. So anyways, if they have to give me cash, I have to give them cash. So let us do the net settlement. And the net amount is called as intrinsic value. So the payment will be done by the company entity to the employees at the intrinsic value. We have recorded the expense at fair value. The differential, if any, will go to employee benefit expense. So let's suppose I have recorded my SAR at $12. Okay, but the intrinsic value is $15. So 3 will go to employee benefit expense. I believe it is clear to all of you. Very much clear to all of you. Now, I have written few additional points here. So let me explain that also. Fair value on each reporting date has to be considered. I believe it is clear to all of you. Fair value at each reporting date has to be considered, not the grant date, reporting date. Why? Because it's a liability that you have to settle in the form of cash. This is a liability that you have to settle in the form of cash. So you have to continue remeasuring your liability. Sir, then why for equity settled we considered the fair value on grant date, but so that equity remains constant, but the liability keeps on getting remeasured. Equity remains constant, but the liability keeps on getting remeasured. So that's why equity settled we value at fair value on grant date, but for liability we take the fair value on each reporting dates and keep on remeasuring it. Okay, now subsequent to the vesting period, understand this point. Subsequent to the vesting period, but before the options are exercised, during the exercise period, provision for SAR needs to be remeasured at each reporting date. So even if the vesting period is over and you've recorded the entire expense for that share based payment, okay, then also till the time the SAR is not exercised, standard is saying that you have to continue remeasuring it on the value that if I have to pay it now, what should be my liability? If I have to settle this liability today? So I have to continue remeasuring it till the time it is settled. Okay. Now remeasurement gain or loss will be recognized in P&L as employee benefit expense. Okay. Now provision for SAR has to be settled at intrinsic value. Now I do have an example. But this example is not an example, rather it is an exam based question, December 2018 question. Okay, So the Kanishka is a query. So the remeasurement gain or loss throughout vesting period plus the experience period, not experience period, exercise period will be in P&L as employee benefit expense. Yes, will be in P&L as employee benefit expense. Yes, Kanishka. Okay, so I do have an example which will clarify all your queries for cash settled share based payment. Okay, so this is an exam based question. Let me discuss this part. So it says on 1st October 20x5 Yanong company granted 500 share appreciation rights to its 300 managers. All the rights vested on 30th September 20x5, but they 20x7. Okay, I have drawn the examples here. I've drawn the diagram here. So let me explain using the help of this diagram. So understand. So there were 500 options granted to 300 employees. Okay. Now my expectation is 5% employees. 5% will employees will leave over the 3-year period. 5% employees will leave over 3-year or 2-year. 1st October 20x5, 30th September 20x7. 2-year period. 5% employees will leave over 2-year period. Now understand it is cash settled, and the fair value at each reporting date is given. Understand one more point, that this is your vesting period. Let me highlight that this is your vesting period, and this is your vesting date. Further, let me highlight one more point. This is your exercise period. Again, let me highlight. So this is your vesting period and this is your exercise period. Okay. Now understand. So you have to record the expense over vesting period first of all. So how will you record? How many employees? 300 employees. How many employees will leave? 5%. So how many employees will be there with me? Tell me. 300 into 0.95 is 285 employees. 285 employees will be there with me. Per option, how many? Per employee, how many options? 500 options. Now what is the fair value? 9. Now how many vesting period? 2 years. So 1 by 2. So this is my expense 6641250. So what is the journal entry for this one? So journal entry will be employee benefit expense account debit to provision for share appreciation rights. Okay. Now coming to the next year. So here we recorded an expense of 641,250. Now here what will happen? How many number of employees? 285. 285 is the number of employees. Per employee, how many options? 500. What is the fair value? 11. Now, what is the expired period? 2. What is the total vesting period? 2. So what is the amount of expense that I have to record? Minus 641,250, that is recognized in previous year. So 285 into 500 into 11 minus 641,250, that comes to 926,250. 926,250, and your liability becomes how much? Your liability becomes 1567500. 1567500 is your liability because you have not yet paid to your employees. Tell me, is that clear everyone till here? Is that clear to everyone till here? Guys, tell me. Now now the vesting period is over. Now when we reach exercise period, now here it says that let's remove this line for the time being. Let's remove this word for time being. So now what happens? So now again, see, standard says that you need to continue remeasuring your liability. Okay. So now understand. So what will I do? My fair value is how much? 12. So I will continue to remeasure. So what will be my liability here? Tell me. So my liability will be 285 into 500 into 12. My liability will be 17,10,000. How much is the liability that I have recorded? 1567500. 1567500. That is 1425. So what is your remeasurement? What is your remeasurement gain or loss? 142,500. 142,500. See here the remeasurement loss. How much? Your carrying amount of liability was this much. The fair value is this much. So this is your remeasurement loss or remeasurement expense. Is that clear, everyone? But now the question also goes on to state that we have 60 employees exercised their rights, and now we have to pay them basis the intrinsic value of 10.5. We have to pay them on the basis of intrinsic value at 10.5. We have to pay them on the basis of intrinsic value at 10.5. Now, if we have to pay them at intrinsic value of 10.5, now understand what will happen. I have recorded the liability for these 60 employees at what value? 12. At what value? 12. So 60 into 500 into 12, if my liability is 3,60,000. My liability is 3,60,000. How much am I paying? 60 into 500 into 10.5. So I am paying only 315,000. So what will I have to do? I have to record a gain of 45,000. I have to record a gain of 45,000. So what will happen ultimately if you just do the net amount 142,500 minus 45,000, it comes to 97,500. Now, you might ask me, sir, can we first of all pay and then remeasure? Yes, you can do that also. You can first of all pay and then do the remeasurement So how will it happen in that case? So first of all, if you pay, then what you will say, what is your carrying amount of liability? So carrying amount is 60 into 500 per option multiplied by, you have recorded your liability on the basis of 11, right? So if you have to pay first, your liability is on the basis of 11. Okay. Now, how much you the carrying amount and how much is the amount that you paid? So 60 into 500 into 10.5. So what is your payment loss or gain? 60 into 500 into 0.5 is how much? 15,000. 15,000 is your payment ka gain. Now what is your remeasurement loss in this case? So now you have to calculate the remeasurement loss only for 225 employees. So for 225 employees multiplied by 500 options per employee multiplied by my carrying amount of the liability was at 11. I have to measure at 12. So into 1. So what is the value? 225 into 500 is 112500. So now this is a loss. So what is the net amount? Minus 15,000. Again it comes to 97,500. So you do this way or that way, the amount will come to same. Amount will come as same only. I have discussed both with you guys. Now this 97,500, this 97,500 will go to P and L as employee benefit expense. This will go to P and L as employee benefit expense. Is that clear, everyone? Is that clear, everyone? Come on, guys, tell me. Now, vesting condition. So what is the meaning of vesting condition? So vesting condition is a condition that you have to satisfy over the vesting period. So understand, the vesting condition can be of three types. It can be a service condition, it can be a performance condition, or it can be a market linked condition. Let me explain each of these to you. Now, what is a service condition? What is the meaning of service condition? To remain in service for a specified period. Let me give you an example. Service condition is you have to I will give you the equity shares of my company if you remain in service for 2 years. So 2 years is your vesting condition on the basis of service condition. Okay, so that is called as 2 years. So in that case we have to record expense over the service period. Okay, now vesting period is fixed at the grant date as service period. Now, performance condition. What happens in the case of performance condition? Let me explain here. Vesting condition. Point number 1. If it is a service condition, so what you have to do is you have to record expense over service period. It's very simple. Second is performance condition. performance condition. Guys, please understand a very important point. Second is performance condition. Performance condition example is employee have to reduce the cost of production by 10%. Employee have to reduce the cost of production by 10% over 2 years. Over 2 years, they have to reduce the cost of production by 10%. So now what happens? Let's suppose we are standing on the grant date. Grant date by estimate is that we have to reduce the cost of production by within 2 years. We have to reduce the cost of production by 10%. So what happens at year end 1? At year end 1, we believe that yes, we will reduce the cost of production. We will reduce the cost of production by 10% over 2 year period. So here what will you do? Here you will do record expense over 2 years. Now we reached year end 2. We reached year end 2, and we think that no, we won't be able to achieve this condition over 2 year period. We need 3 years for this. We need 3 years for this. So now here what you will do? Here you will record expense over 3 year period. 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 Okay. Now, so this is what you will do in performance condition. Now, in the third one comes market condition. What is the meaning of market condition? What is the meaning of market condition? Market condition is share price of the company has to go up by 20% over 2 year period. Over 2 or over 3 year period. Share price of the company has to go up by 20% over 3 year period. So what I will do here is, let's suppose here I believe that okay, we'll have to record over 3 year period. So year end 1 come. We believe that okay, we will achieve this condition over 3 year period. So I will record expense over 3 years. That is, I will do 1 by 3 year. Okay. Now year end 2. Year end 2. I believe that I will not be able to achieve this condition over 3 year period, but rather I will be able to achieve this condition over 4 year period. Over 4 year period. Then tell me, will I record expense over 4 years? Will I record expense over 4 years? No. I will have to record expense over 3 years only. I will have to record expense over 3 years only. So understand what happens in performance based condition. In performance based condition, we can postpone our expenses. We can postpone our expenses, but in market based condition we cannot postpone our expenses. We cannot postpone our expenses. Are you getting this point? Are you getting this point? But understand, let's suppose my estimate was that you have to achieve this market condition within 3 years, but now at year end 1, we believe that we will be able to achieve this condition over 2 year period only. Then we will record expense over 2 years. So we can prepone the expense. We can prepone the expense. So the difference what I'm trying to explain here is, if it is a performance condition, now in this case we can prepone, we can postpone according to the best estimate available. According to best estimate available. But if it is a market condition, we can just prepone. Can we postpone? No, we cannot postpone. Okay, no, we cannot postpone the expense. So Kanishka has a query, then how it will be recorded? So what's the challenge? We will record the expense over 2 year period in that case, or we will record the expense over 3 year period. Normally, irrespective of on what date market condition will be achieved, I will record expense over 3 year period only. Okay, I will record expense over 3 year period only. Okay. Why we are doing this? 2 reasons. Understand. Performance condition is something which is in the control of the employees, but market condition is something which is not in the control of employees. Okay, market condition is something which is not in the control of employees. Now further, standard goes on to state that when we calculate the fair value of the options, we do consider the increase in the market price or decrease in the market price in the future using the Black-Scholes model of option pricing. using the Black-Scholes model of option pricing. So the increase or decrease in the market price is already factored in the fair value. So you are not required to factor it again. Okay, so you are not required to take the best estimate. Whatever is the estimate of vesting period on the grant date is the period over which you have to record the expense. But yes, if it gets satisfied earlier, you can record it earlier. But if it gets pushed, you are not required to push it. I believe it is clear to all of you. This is a very small point where you could have made a mistake, but now I believe you will understand and not repeat this mistake in the exam. Okay, now, so this completes this part. Now coming to the next part. Modification or repricing. Now, modification or repricing, what exactly does it mean? So it means that we are changing the terms or conditions of the share based payment. Basically, we are repricing the exercise price. So we are decreasing the exercise price. So repricing means what? We are decreasing the exercise price. We are decreasing the exercise price. Why we are decreasing the exercise price? To increase the fair value. Of options, so that the options appear more attractive. Okay. Now, and employees are motivated to remain in the company. So now understand, when the repricing happens, I am discussing this part only for equity settled, because it is not applicable for the case of cash settled. Okay, now understand what happens when we repricing. So when on the date of repricing or on the date of modification, the fair value of the option increases. Now tell me, if this option is equity settled, we consider the fair value on what date? Tell me. For equity settled, grant date. Now, any changes in the fair value subsequently, do we account for that? No, we don't account. So now standard is saying, since on the date of modification, there is a change in the fair value. And in equity settled, we don't account for change in the fair value. So hence we have to record this change in the fair value separately. How? So standard says that whatever is the fair value on grant date, record that as an expense normally. So normally, how you would have recorded the expense, continue to record that. See, for the first year I have recorded the expense, for the second year I have recorded the expense, for the third year I have recorded the expense on the basis of fair value on grant date. Best estimate of employees. So record expense usually over the grant period, over the vesting period. Record expense normally over the vesting period. But additionally, record the incremental fair value due to repricing. Over the remaining vesting period. So understand, what is the incremental fair value on the repricing? Okay, so understand, we have done the repricing on this date. So we have to calculate what is the incremental fair value. So on this date, what is the fair value prior to modification and what is the fair value after modification? So what is the increase in fair value? 0.15 per option. So standard says that record this as an expense over the remaining vesting period, not over the entire vesting period. No, only over the remaining vesting period. Is that clear, everyone? See, I have recorded this over the remaining vesting period. 0.5 by 1.5, 1.5 by 1.5. How? 0.5. Understand? See here. Half year and 1 year. So it total is 1.5 year. So for this year, I am recording 0.5 by 1.5. For this year, I am recording 1.5 by 1.5 minus the record expense for this part. From where 0.9 and 1.5 came, 1.05 came, it will be given in the question, Palak. It will be given in the question. Okay. fair value prior to modification and fair value after modification. It will be given in the question. See, in the question is written fair value of the options is 0.90, okay, and after the decrease in exercise price, it increased the fair value to 1.05. So it is given in the question. See, 0.90 and 1.05 per option. It is given in the question. Okay, so this is called as accounting for repricing. Now comes the accounting for cancellation of share based payment. Cancellation of share based payment. Okay, now understand, cancellation of share based payment used to be in our syllabus, but it is not in the syllabus now. But still I will explain it. You never know, it can come anytime because it has been moved from the main syllabus to the essential reading. So I'm not leaving this part. So let me discuss. So whenever you cancel the share based payment, what you do is, let's suppose you had a vesting period of 3 years. Okay, you had a vesting period of 3 years. On this date, you cancel the share based payment. So standard says that first of all, prepone all your expenses. So record the entire expense here itself. The entire share based payment expense, record it here itself. See, ideally I should have done here 2/3, right? Because the vesting period was 3 years and we have expired period is 2 years. But see what I'm doing here, 2/2. I assume that my vesting period now is only 2 years. So 2/2 and record the entire expense here itself. Okay, recorded the entire expense here itself. Now I have to see if I'm canceling the share based payment, it will demotivate my employees, but I can't let my employees get demotivated. So what I will do, I will pay compensation to my employees. So now I have to calculate what is the compensation that I have to pay to my employees. For cancellation of share based payment? For that, I will calculate the compensation amount. It is given in the question. Compensation to be paid is 95 per option. Okay, it is given in the question. Now the standard says that compensation up to fair value. On date of cancellation has to be paid from share based payment reserve. Any excess has to be paid from the P&L employee benefit expense. Now understand, what is the fair value on date of cancellation? Entity planned to cancel the option plans on 31st March 2023, on which date the fair value is 90 per option. And cancellation amount is 95 per option. So what I will do, I will pay up to the extent of 90 from share based payment reserve, but I have to pay an amount of 95. So the excess $5 I will pay from employee benefit expense. I pay from employee benefit expense. Is that clear, everyone? Okay, so first of all, I will prepone the expense. I am recording the steps. So first of all, I will prepone the expense. Then I will have to pay compensation. So understand, when you are paying compensation up to fair value on date of cancellation, I will pay from SBP reserve. Okay, any excess I will pay from P&L, that is employee benefit expense. Now after paying compensation, whatever is the balance left in SBP reserve, whatever is the balance left in SBP reserve is to be transferred to retained earnings. Is that clear, everyone? Okay, now this is cancellation. Now comes share based payment with settlement alternative. Now let us discuss share based payment with settlement alternative. Now understand, here we have given the counterparty a choice. The employees have a choice. If they want to take cash, they can take cash. If they want to take equity shares, they can take equity shares. So this one I will help you with with the help of an example. So understand. So in this question it says that the company has granted options to their employees. Okay, now, and they have an option to receive either 20,000 shares on June, okay, or they can receive cash to the value of 18,000 shares. So they do have this option. But the employee must remain till 30th June 2024. So this is the vesting period for how many years? 2, 3, 4. 3 years is the vesting period. Now the market price of the company is $5 on 1st July 20x1. This is the fair value given. This is the fair value given. Okay. This is the fair value given. Now the fair value of the share root is 4.9. So can you please tell me what is the fair value of the share root? 20,000 shares into 4.9, that is equals to 98,000. That is equals to 98,000. Now what is the fair value of cash root? 18,000 into 5. 18,000 into 5. 18,000 into 5. 18,000 into 5 is 90,000. So this is the fair value of cash root. Now tell me, which one do you think is an obligation to pay? Which one do you think is an obligation to pay? Share root means if employees exercise shares, if employees exercise and they request for shares, what is the fair value of that root? What is the fair value of that root? And if the employees exercise and ask for cash, what is the fair value of that root? So we are calculating the fair value of both root first of all. Now tell me, which one do you think is an obligation? Which one do you think is an obligation? So the cash root is an obligation, because if the employees demand cash, can I deny that? No, I cannot deny. So it is an obligation which has to be recorded in full, which has to be recorded in full. So what I will do, cash settlement. Yes, yes, Palak. So this I am doing, this assessment I am doing, understand, please understand that this assessment I am doing on grant date. I am doing it on grant date. Why? Because I need to find out the fair value of equity option. I need to find out the fair value of equity option. See, understand, since cash root is an obligation, so I have to record the cash entirely. I have to record the cash entirely. Okay. Now understand how I am recording cash. See here. For cash, I am recording, see, on the basis of fair value on reporting date only, not on the grant date. See, 5.35, 5.8, 6.1. 5.35, 5.8, 6.1. I am recording on the basis of fair value on reporting date only. I am recording on the basis of fair value on reporting date only. Okay. Now understand further. But then why I am doing it? To find out the fair value of equity option. So you will understand. Just give me a minute. You will understand everything. Just give me a minute. You will understand everything. So now understand, what is the excess of fair value of equity over cash? What is the excess of fair value of equity over cash? 8,000. And yesterday in the chapter of financial instruments, we discussed that equity is the residual part. So what is the residual part? 8,000. So 8,000 is the value of equity. 8,000 is the value of equity. 8,000 is the value of equity that we have to record over the 3-year period. 8,000 is the value of equity that we have to record over the period, over the 3-year period. Tell me, is that clear, everyone? So how will we record 8,000? So 8,000 will record over 3-year period equally. So because we don't change the fair value in case of equity settled, we don't change the value of equity settled over the reporting over the vesting period. So it is 8,000 divided by 3. It is 2667 per year. 2667, 2667, 2667 per year for expense. Okay. Now the equity becomes this much, this much, this much. I believe it is clear to all of you. I believe it is clear to all of you. Now on settlement date, if employees asks for cash, then what will I do? If employee asks for cash, then what will I do? Provision for SAR account debit. What is my liability? 109800. 109800. I will do to bank, and whatever is the balance in SBP reserve, that is 8,000, will be transferred to retained earning. But if employees request for shares, then what will I do? If the employees request for shares, then what will I do? So provision for SAR, I will first of all transfer to equity, that is share based payment reserve. That is share based payment reserve. From share based payment reserve, I will transfer to equity share capital to securities premium. So don't you think it is exactly like compound financial instruments? The treatment is more or less like a compound financial instrument. The treatment is more or less like a compound financial instrument, right? So understand here, one more point. Let's suppose this fair value of equity root, would have been not 98, would have been 88,000. Then what will be the fair value of equity? Rather than 98, if it was 88,000, then what will be the fair value of equity? Come on, guys, tell me. Will we say it is negative 2000? No, it can be zero but not negative. It can be zero but not negative. So in that case, the fair value of equity will become zero. Okay, it will become zero. Are you understanding this point? Tell me. Now, Kaniska is okay. So, but if some employees ask for shares and some for cash, then we will have to first respective reserve and the yes, very good, Kaniska, very good, Kaniska. So, if some employees ask for shares and some employees ask for cash, then we have to do the mixed treatment of these two. We have to identify that how many number of employees are asking for cash. So, for that, I will do this treatment. How many number of employees are asking for shares? For them, we have to do this treatment. Okay. Okay. Now, moving on to the next part, that is share based payment to non-employees. Okay, so in the case of share based payment to non-employees, always understand we record the share based payment reserve not at the fair value of equity option, rather we record at the fair value of the asset or the expense, the asset or the goods or the expense that we have received. On the fair value of that, we record the SBP reserve. On the fair value of that, we record the SBP reserve. Okay, so understand here, if we have purchased the asset or the goods or the services, so if we record at the fair value of the goods, services or assets that we have acquired. Okay, so SBP reserve will be at fair value of goods, services or assets to equity share capital, that is number of shares that I am issuing of my own company multiplied by face value. Whatever is the excess will come to securities premium. Okay, now you can strike off this line, not required. Now, a wonderful point following up now is deferred tax treatment. So understand a very important point, for deferred tax. So understand here, if it is not tax deductible, if the share based payment is not tax deductible, then definitely we will not create deferred tax for the same. Why? Because following the principles of IAS 12, if the settlement of a liability doesn't have tax consequences, there is no deferred tax on the same. But if we have tax deductions, then we will create deferred tax asset. Why? Because we will get deductions on the date the employees exercise their rights. So in the future we are going to get deductions. So yeah, they are future deductions which will reduce your future taxable profits. Hence we call it as deferred tax asset. But you need to be careful about one point. In case of equity settled share based payment, guys, listen to me very carefully, very important point. In case of equity settled share based payment, if cumulative future deductions in the tax books, if cumulative future deductions in the tax books exceeds cumulative expense recognized in P&L, then the deferred tax impact for the excess is recognized in equity. Tell me, where do we recognize the expense for share based payment equity settled? Where do we recognize the expense? Where do we recognize the expense for equity settled share based payment? P&L, right? So now standard says that to the extent we have recognized the expense in P&L, the deferred tax impact will be also in P&L. But if we are recording something extra in tax books, then the deferred tax impact for that extra will not go to P&L, it will go to equity. Why? Because it is an equity settled option. Is that clear, everyone? Okay, let me explain this with the help of a simple example. Understand here. Understand here. So let's suppose we have recognized an expense of 20,000 in the P&L. Okay, now we have assumed, we have we understand that the future deduction that I will get, the deduction that I will get in the future is 11,000. Now the deferred tax impact of it, that is 3,300, will go to P&L. But now understand, in the next year, the expense that I have recognized in P&L is 20,000. But tell me, what is the cumulative expense recognized in P&L? What is the cumulative expense recognized in P&L? Can you please tell me? Guys, I need numbers from you. Tell me, what is the cumulative expense recognized in P&L? Again, see it, please. Cumulative expense recognized in P&L. Why 60,000, Kanishka? It is 40,000 now. 20 plus 20, 40,000. Right? Now, what is the cumulative deductions that I will get in the future? See, this future deduction is a cumulative figure, 44,000. This future deduction is a cumulative figure, 44,000. So now, how much is extra? Tell me. How much is extra? Tell me. How much is extra? 4,000. 4,000 is extra. So the deferred tax impact of this 4,000, the deferred tax impact of this 4,000 will go where? Will go where? Equity. That's what I've done. See here. So 44,000 means deferred tax asset of 13,200. If you compare 40,000 with 44,000, how much is extra, Palak? How much is extra, Palak? Okay. Now, so the deferred tax impact of this 44,000 is 13,200. So what is the entry which I will record? So first of all, see, this is the closing deferred tax asset. This is the closing deferred tax asset. This is the opening deferred tax asset. So what is the movement? Can you please tell me? 13,200 minus 3,300. That is 9,900. So I have to create deferred tax asset by 9,900. I have to create deferred tax asset by 9,900. Okay. I have to increase my DTA by 9,900. Now, how much will I be, which I'll be taking to equity? So 4,000 ka 30% will go to equity. Rest everything will go to P&L. Rest everything will go to P&L. So 40,000 ka 30% minus 3,300 we recorded previous year will go to P&L. Is that clear, everyone? Now read this line again. In case of equity settled share-based payment, if the future deductions, that is, I like the numbers. Cumulative future deduction, that is 44,000. Exceeds cumulative expense recognized in P&L, that is 40,000. Then the deferred tax impact for the excess, that is 4,000, is the deferred tax impact of it is 4,000 ka 30% is equals to 1,200 will be recognized in equity. Is that clear now? So this completes my share-based payment. Yes, we are recording expense today. In accounts books, we record expense now, okay, as and when we are getting the services from the employee. But in the tax books, we record when we actually settle it off. When we actually settle it off, and then we record the tax in the tax books, okay? So this completes my share-based payment. So now let us first of all revise IFRS 8 operating segments. Now understand what exactly is the meaning of operating segments. What is the meaning of operating segments? So understand, operating segment is a division of a company. It is a division of the company which has these three features. One, it earns revenue and incurs expenditure and does some business. Second point, the business or the revenue or the income or the expense are reviewed by a person called as CODM, Chief Operating Decision Maker. Third point, the information, the financial information of this division is available. The discrete financial information of this division is available. Okay, so we very well know that this division has earned a revenue of this much, has incurred expense of this much, has an assets of this much, has liabilities of this much. So this is called as if a division has these features, all these three features, we say it is an operating segment. So it is called as a process of identification of segment. Identification of segment. But now comes the question, are all segments reportable? Are all segments reportable? When I say reportable, what is the meaning of reportable? So when I say reportable, means reportable in the face of financial statements. Reportable on the face of financial statements. So are all segments reportable? No. So what is the process of doing that? So first of all, entity identifies the segments. First of all, entity identifies the segments. Then entity clubs, aggregates few segments on the basis of, if let's suppose if they have similar nature of products or services, whose customer base is same, then we club that. I will give you an example. I am teaching CA final financial reporting, I am teaching ACCA FR, I am teaching ACCA SBR. Okay, so there are three segments that I am into. I am into three segments. Now what I say that, see, the student base for FR and SBR, is it the same? Can I say that? Tell me. The student base of FR and SBR are the same, because the student who will appear FR, they will definitely go and appear SBR. Tell me yes or no. Right? So what I'll say that these two segments, though these are two segments, but I can aggregate it and make it one segment. Why? Because the customer base is ultimately the one. So now I have two segments, CA final and ACCA. I have two segments now. Okay. Now, when I have identified the segments, does it mean that I will report both of these segments? No. It doesn't mean that I will report both of these segments. Now I have to identify, I have to assess the threshold criteria. The segments which you can say meet the threshold criteria are to be reported. The segments which meet the threshold criteria are to be reported in the face of financial statements. So again, I'm repeating the process. So understand, first of all, we identify the segments on the basis of how. So we see that if there is a division of the company which earns revenue, incurs expenditure, does some business, and the reports of which are reviewed by CODM, Chief Operating Decision Maker, CODM. Okay. Now, and whose discrete financial information is available. So this is called as a segment. So first of all, I identify the segments, then I aggregate few segments. Okay. Aggregation is done on the basis of segments who are in the similar in nature, similar in terms of products or services, in terms of production process, in terms of distribution, in terms of customers, in terms of geographical basis. So there can be multiple bases for the same. Okay. Now I will aggregate. Then after that I will assess whether the segment which I've identified, are they reportable or not? So to identify the reportable segments, I have to assess the threshold criteria. Now, what are the threshold criteria? Now, threshold criteria is, so if the segment revenue is 10% or more of the total segment revenue, if the segment revenue is 10% or more of the total segment's revenue, then that segment is reportable. If the segment result means profit or loss, is 10% or more of the total profit or loss, then that segment is reportable. Now, why it is written profit or loss, whichever is higher? Why we have written it this way? So understand, I will explain this point. So let's suppose company has three segments, 1, 2, 3. Company has three segments. This segment has profit, this segment has loss, and this segment has profit, Now tell me, if I take the net figure and then compare, will that be correct? No. So the standard says that first of all, calculate total profit, meaning thereby 1 plus 3. Then calculate total loss. Okay, then whichever is higher, let's suppose total profit this was 10, this was 5, this was 11. Okay, now, so the net figure is 10 plus 5, 15 minus 11 is 4. So if I compare from 4, it will not be correct. So what I do here is I see total profit is how much? 15. Total loss is how much? 11. Which is higher? 15. So now I have to compare 10% of 15, 10% of 15, 10% of 15. I will explain with the help of a question also, don't worry. So now it says that if the segment result is 10% or more of the total profit or loss, whichever is higher, then that segment is also reportable. Or if the segment asset is 10% or more of the total segment assets, segment asset is 10% or more of the total segment assets, then that segment is reportable. Now, is it the case that all the three has to be met? Is it the case that all the three has to be met? No. The standard says that if either of them are met, if either of them, if any of them is met, the segment is a reportable segment. Okay. Now, understand, if none of them are met, then what to do? If none of them are met, then what to do? Again, we have other thresholds. Okay. Let's suppose there is a segment which does not meet the threshold of limit number 1. 10% threshold is not meeting, but the CODM wants to report a particular segment. CODM wants to report a particular segment. CODM wants to report a particular segment voluntarily. Okay. That segment is not meeting the threshold, but the CODM wants to report it for some reasons, because might be it is a future oriented business. So as of now, the revenue is not much, but it is a very important segment. So CODM wants to report it voluntarily. So he can do so. Now tell me one question. CODM, there is one segment which is reportable as per these thresholds. CODM doesn't want to report it. Can we do so? CODM doesn't want to report it. Can we do so? No, we can't do that. So CODM has authority to report something additional, but CODM does not have the authority to not to report what is reportable as per the IFRS. Okay. Yes, that will become an ethical issue. Very good, very good. This proves that Vaishnavi, you are practicing questions. Very good. Now, limit number 3. If in the previous year a segment had become reportable, so in the current year also we will report the same. Okay. So if in the previous year we reported a segment, so in the current year also we will report that segment. Okay. Now standard says that, let's suppose the company had 1, 2, 3, 4, 5 segments, out of which as per limit number 1, 2 and 3, segment number 2 is reportable and 4 is reportable. 1 is not reportable, 3 is not reportable, 5 is not reportable. Only 2 and 4 is reportable. 2 and 4 is reportable. Now the standard says that once the entity identifies the reportable segment as per limit 1, 2 and 3, entity needs to evaluate whether the external revenue of reportable segments is 75% or more of the total external revenue. What is the meaning of external revenue? See, when I am assessing this segment revenue, it means internal plus external. Means if any revenue is earned among themselves, that is also considered here. Okay, because we say segment revenue. Okay, we see these segments as an individual entity sort of thing, you can say. But now here limit number 4 says whatever segments you have reported, they should report at least 75% of external revenue. So you can say this external revenue is the revenue that you will report in the face of P&L. This external revenue is the revenue that you will report in the face of P&L as per the provisions of IFRS 15. Okay. So are the thresholds clear? Tell me everyone. Thresholds clear? So first threshold says what? 10% of revenue, yeah, 10% of profit, yeah, 10% of assets. Second one says voluntarily. Third one says previous year done, current year also. Fourth one says 75% of external revenue. If it is not happening, then we will add some other segments to make it 75%. Then we will add some other segments to make it 75%. So now I have an example with you guys. I have an example that I can discuss with you. Okay, so basically, let's suppose there was a company XYZ who had A, B, C, D, E, F, G, H. How many? 8 segments. Who had 8 segments. Okay, now these were the external sales, inter-segment sales, total sales, segment profit or loss, segment assets. Everything is given here. Now tell me, what is the total segment revenue? As per limit 1, what is the total segment revenue? See here, the total segment revenue is how much? Just add this, add this. Can you please add this and tell me what is the amount? Can you please add this and tell me what is the amount? Can you please add 100 plus 315 plus 45 plus 15 plus 15 plus 50 plus 25 plus 35 is 600. Okay, now what is the 10% of 600? 60. So if this exceeds 60, it is reportable. See, this exceeds 60, reportable. This exceeds 60, reportable. This doesn't exceed 60, not reportable. Okay, see, this doesn't exceed 60, not reportable. So whatever are reportable, I will keep on highlighting. A is reportable, B is reportable, C is not reportable as of now, D not reportable, E not reportable, F not reportable, G not reportable, H not reportable. Okay, so as per the revenue criterion, only A and B is reportable. Now comes profit and loss. Now tell me, what is the profit here? So let's add the total profit. Let's add the total profit. Profit is 5 plus 15, 20, 20 plus 8, 28, 28 plus 5, 33, 33 plus 7 is 40. Now what is the total loss? Total loss 90 plus 5, 95 plus 500. So which one is higher? Total loss is higher. So 100 is higher. So I will take 10% of 100. So if anything exceeds 10, if anything exceeds 10, it is reportable. So now see here, 5 not reportable, 90 reportable, 15 reportable, 5 not reportable, 8 not reportable, 5 not reportable, 5 not reportable, 7 not reportable. Okay, now segment assets. Can you please add everything? So it is 15 plus 47 plus 5 plus 11 plus 3 plus 5 plus 5 plus 9. It is 100. So 100 ka 10% comes up 10. So if anything exceeds 10 is reportable. So this 10 reportable. This is reportable. Not. So A, B, C and D are reportable. A, B, C, D are reportable. Now someone is asking me a query. Hers is asking negative value doesn't count here. So negative, we ignore the term negative or positive. We just see the percentage. We don't see the term negative or positive. We just see the percentage. Okay, hers? We don't see negative or positive. We see the percentage. Okay, understand. Let's suppose there is a segment who is incurring significant losses. So shall we ignore that just because it is incurring losses? No, right? So if either profit or loss, if it is exceeding 10% is reportable. So we are not required to see positive or negative sign. No. Okay. Now, so limit, as per limit number 1, this is what it is. Now limit number 2 was voluntarily. Is the question saying anywhere about voluntarily? No. Limit number 3 was if in the previous year it is reportable, in this year also it will be reportable. Now tell me, is the question saying anything about that? No. So limit number 3 also ignore. Limit number 4 was the reportable segments should comprise 75% of external revenue. So just see here. So what is the external revenue? This much. What is the total external revenue? Can you please do that? 600 minus 100 minus 60. It should be 303.75, right? Now, how much it is happening? Minus 255 minus 15 minus 10. No, it doesn't comprise. So we have to add extra further other revenue, other segments also. So we will add H. Just consider H, the highest revenue one. Just consider H, the highest revenue. Now, is it comprising 75%? Tell me. Now, is it comprising 75%? I think yes. Right? So if you add 255 plus 15 plus 10 plus 35, 315 divided by 405, it comprises 77.77%. Yes, so it does satisfy. So what are the segments reportable? So segments reportable will be okay, not 35. I will not. Why will I take 35? The highest one is F, right? So I will take F. So how much it becomes? 255 plus 15 plus 10 plus 50 divided by 405. Yes, it comprises 81.48%. So F will be reportable. So what are the total reportable segments? A, B, C, D and F. A, B, C, D and F. A, B, C, D and F. Is that clear, everyone? Tell me. Is that clear, everyone? Now, to help you with the certain queries, why external revenue only till D? Because in the limit number 4, Palak, we take the reportable segments as per limit 1, 2, and 3. So as per limit 1, 2, and 3, A, B, C, D were the reportable segments. Okay, so that's why we took only till D, not further. I believe it is clear to everyone. Very good. So this is what, there is one more question. Which is there from the ACCA study hub. I will recommend all of you to solve this question or you're over. Okay. So this is your homework. Now further, segment reporting. See, this is the format of segment reporting. I have given the format here for your reference. There is nothing for me to explain in this format. I believe you can just see the format and accordingly you can put the values here. Okay. Now, coming to the further disclosures part. So understand, in the disclosures, what you have to see. So first of all, evaluate whether the company has multiple segments or the company has only one segment. Okay, so if the company has multiple segments, so company should first of all give general information. What is the meaning of general information? Information about all the segments, that this segment is dealing into which business, so a general information about all the segments. Then the segment reporting as per this framework, then the general segment reporting as per this format. Okay, then the third comes entity wide disclosures. What is the meaning of entity wide disclosures? Information about the top customers, top geographical areas, top products. Okay, information about products or services, geographical areas, major customers. But understand here, in this case, when we are giving entity wide disclosures, do we write the name of major customers? No, we don't write the name of major customers. So we just write customer 1, customer 2, customer 3, customer 4. Why we don't write the name? Because if we write the name of major customers, my computer will come, see my financial statements and take that customer from me, right? So we don't write the name of our major customers. But let's suppose if a company has only one segment, will we do segment reporting in that case? Tell me. If a company has only one segment, will we do segment reporting? No, we won't do segment reporting. In that case, we won't do segment reporting. Segment reporting, basically, we are doing why? Because we want to let know our investors that, see, my total profit is this much, but this much percentage of my profit is coming from this segment, and this much percentage of my profit is coming from this business. So let's suppose for a company like ITC, they are into multiple business. They are into paper division, they are into packaging division, they are into hospitality business, they are into you can say restaurants business, they are into tobacco division, right? So now they have to let know their investors that, okay, how much of my revenue or how much of my profit is coming from which segment. That's why segment reporting is important. But let's suppose there is a company who is into one business only. Zomato, it is into only one business. Right? So it is not required to do segment reporting. Yes, I understand that Zomato is also diversifying now. Okay, so it might be required to do segment reporting. But till the time it is only into food delivery, there is no segment reporting required because there is only one segment. Okay, is it clear, everyone? So this completes my operating segments. So now let us start IAS 34 interim financial reporting. A very, very, very small topic. Okay, now understand. Whenever we prepare the financial statements for less than a year, it is called as interim financial reporting. It is called as interim. Interim means in between. Interim means in between. So if we are preparing any financial statements which is shorter than for a year, it is called as interim financial reporting. Okay, so let's suppose if we are preparing the financial statements for 3 months, interim financial reporting. If we are preparing the financial statements for 6 months, interim financial reporting. If we are preparing the financial statements for 9 months, interim financial reporting. If we are preparing the financial statements for 12 months, it is not interim financial reporting. Okay, now understand, when you do the interim financial reporting, do you prepare the entire set of financial statements? Yes, if you want, you can do that. Okay, but standard doesn't mandate the requirement. Standard doesn't mandate the requirement. If you are a listed company, then the listing regulations will apply on you. If you are a listed company, then the listing regulations will apply on you, and you have to follow the principles of listing regulators. Okay, but as per IFRS, there is no mandate to prepare the entire set of financial statements in the interim period. But standard says that whenever you are preparing the interim financial statements, you have to disclose the material events. You have to disclose the material events or transactions that are incurred. Let's suppose you have got any significant customer. You have recorded an impairment loss, a major impairment loss. You have declined the value of your inventory significantly. Okay. You have taken a major loan from the you have acquired a subsidiary. So whatever are the major transactions and events that you are required to report in the interim financial statements. Is that clear, everyone? Now, presentation from the point of view of comparatives. Okay, I don't know whether this will be tested in the exam or not, but yes, let us discuss this part. So now understand, we call it as SOFP. Okay, now whenever we prepare the SOFP, interim financial statements, whenever we prepare interim financial reporting, okay, then whatever SOFP we have to give. So understand, let's suppose I will explain with the help of example. Let's suppose I have to give the financial statements for the quarter ended 31st December 2024 and assume that my reporting date is 31st March. So what is the latest reporting date that is signed FS? What is the latest reporting date signed FS? Can you please tell me? What is the latest reporting date signed FS that would be available with me? 31st March 2024. 31st March 2024. So now when I have to give SOFP, what will I do here? So I will give the SOFP as at 31st December 2024 and the latest signed SOFP. Now when it comes to P&L, so I will give the quarter ended 31st December 2024. Okay, then I will give 9 months ended 31st December 2024. So period ended 31st December 2024 and year to date. Now I have to give the comparative of the previous year. So I will give quarter ended 31st December 2023 and 9 month ended 31st December 2023. Is that clear, everyone? Okay, now when it comes to cash flow statements and other equity, then so we have to give only year to date. We have to give only year to date for the current year and for the previous year. Okay, understand. So when it comes to SOFP, okay, this is your last reporting date available. Let me write both. 2 years. Let me write 2 years. So my year starts from 1st April 2024, ends on 31st March 2025. So previous year started from 1st April 23. So now what I am doing here is I am preparing the FS ended 31st December 24. Okay, quarter ended 31st December 2024 is what I am preparing as of now. So now if this is what is my reporting period for interim FS. So what I will do, please listen carefully, all of you. So I will prepare I will show SOFP as on this date and I will show the latest signed SOFP. So what is the latest signed SOFP? This SOFP. So this is from the point of view of SOFP. Clear, everyone? Now from the point of view of P&L. So I will give P&L for this period and I will give P&L for this period. Okay. Now I will give the same information of the previous year also so that the investor can see, oh, what is the growth as compared to previous year. So I will give for the period ended 31st December 23, that is quarter ended 31st December 2023 and 9 months ended 31st December 2023. Same for the previous year. See, that's what I've written here. Quarter ended 31st December 2024. Quarter ended 31st December 2023. 9 month ended 31st December 2024. 9 month ended 31st December 2023. Is that clear, Palak? Now, if I'm preparing cash flow, then what will I do? I will give only 9 months from here to here. I will give from here to here cash flow. I will give from here to here cash flow. I will give other equity from here to here. I will give other equity from here to here. Okay, so this is what is a comparative FS that is required to be presented. Okay, I have given the what is the logic behind that, what is the rule behind that, but I have explained using the help of example, and I believe this is clear to all of you. Okay, now comes the next chapter, that is provisions, contingent liabilities and contingent assets, IAS 37. So understand, how will you make a distinction whether it is a liability or a provision or a contingent liability? So understand, so obligation are of two types, present obligation or a possible obligation. Now the examiner will try to confuse you. You know how the examiner will try to confuse you? So examiner will say it is a legal obligation. Legal obligation, the law says that, so it's a legal obligation. Okay, fine. Question will say there is no legal obligation, but the company has an obligation as per the past practice, meaning thereby it is a constructive obligation, or the obligation arises from a contract, so it's a contractual obligation. So obligation can be legal, constructive, contractual, anything, doesn't matter. What matters is if the obligation is a present obligation or a possible obligation. If the obligation is a present obligation or a possible obligation is what matters. Okay, now what is the meaning of present obligation? What is the meaning of present obligation? If the probability, okay, understand how to assess if it is a present obligation or not. The only point which you need to take care to understand if it is a present obligation or not, if it is unavoidable, it is a present obligation. I will explain it with the help of example. Okay, understand. I have told to my parents that I will buy a new laptop. Tell me, is that an obligation? I have not bought a laptop as of now. No, but I already went to a store, purchased a laptop and have not paid the money. Is it a present obligation? Yes. Why? Because it is unavoidable now. It is unavoidable now. Now, similarly, I am the director of the company. I told to my investors that I will repair this building entirely. I told to my investors that I will repair this building entirely. Is it an obligation? No. But I have already appointed the laborers and they are working on it. Is that an obligation? Yes, that is a present obligation. Okay. Now, I have discussed with an employee of my company, okay, that you will come from this date. Is that an obligation? No. But employee has actually started working in my company. Whether I have paid the money or not doesn't matter, but the employee started working in my company. Is that an obligation? Yes, that is a present obligation. So I believe you are understanding the meaning of present obligation. It is unavoidable obligation. It is an unavoidable. Something which is unavoidable is called as a present obligation. Okay? Unavoidable, which arises from the result of past events. Let's suppose I have sold the goods. Then a customer comes to me for repairs. Customer can come to me for repairs. That is a present obligation. Why? Because it is arising as a result of past event, that is the sales that I have made. Okay. Now, so I believe you are understanding what exactly is the meaning of present obligation. Now understand, if there is a present obligation and the outflow is certain, then you will record liability. Outflow is probable. Now, what is the meaning of probable outflow? Probable outflow means the possibility of payment is greater than 50%. The outflow is probable. Okay, the outflow is probable and the amount. Now understand, outflow is probable and the amount is certain. You make a provision. Outflow is probable and the amount is certain, you make a provision. Outflow is probable and the amount is certain, you make a provision. Now understand, outflow is probable, but the amount is uncertain. You don't know what exactly is the amount that you are required to pay, but you can estimate the amount. You can estimate the amount. Then also it is a provision. Outflow is probable and you cannot estimate the amount. If you can't estimate the amount, can you recognize it as a provision? Even though we want to, but we won't be able to, because to recognize we need an amount. To recognize we need an amount. So it will be disclosed as contingent liability. So it will be disclosed as contingent liability in that case. It will be disclosed as contingent liability in that case. Okay. Now understand, if the outflow is not probable, outflow is not probable means the probability of payment is less than 50%. The probability of payment is less than 50%. Then it is called as contingent liability. Then it is called as contingent liability. Okay. Now, if it is possible obligation, if it is possible obligation, okay. So understand. If it is a possible obligation means the probability of payment is very low. The probability of payment is very low. Okay. Then also it is a contingent liability. So are you understanding in what case are we required to record a provision or a contingent liability or a liability? Tell me, are you understanding this point? Okay. Very good. Okay, I want to help you here. I have to help you here. In business combination IFRS 3, do you remember I told you at one place that if the subsidiary company has a contingent liability, then we recognize on the date of acquisition, we recognize the provision for that contingent liability. Do you remember this part? Now tell me. So I'll tell you that which is that contingent liability. So this is that, this one, where it is, this one, this contingent liability I was talking about. This contingent liability. So this one, as per IFRS 3, we will recognize this as a provision at fair value on date of acquisition. Okay, I was not talking about this contingent liability. I was talking about this contingent liability. Is that clear, everyone, now? Very good. So see, are you understanding how we are linking the standards and studying it properly? Okay. Now, reimbursements. What is the meaning of reimbursement? So understand here. What happens? Let's suppose I am the seller of books. So I sold the books to the customers. Now customer comes to me and says that, see that sir, in this book, this page is removed. Give me a replacement of this book. So I gave him the replacement of the book. Now tell me, I will bear this loss? No, I will go to the publisher house. And tell them, see, you printed this book in a wrong manner, and because of which I have to replace one book. So what will happen? The publisher will tell me, sir, don't worry. I will give you one extra book. Means who is bearing the loss? Tell me, who is ultimately bearing the loss? The publisher. Am I bearing the loss? No. So definitely when it comes between me and the customer, so I have an obligation towards my customer. Which I will record as provision. But I will receive a reimbursement from the publisher also, no? I will receive a reimbursement from the publisher also, right? So that I have to record as an asset. But the condition here is the reimbursement should be virtually certain. There should not be even a slight chance that it will not be received. Okay, it should be virtually certain. Okay, then only we can recognize this as the reimbursement as an asset and income in P&L. Okay, so now if it is virtually certain, yes, we can recognize it as an asset in SOFP, and reimbursement in P&L as income. But understand one concept. The standard says that the reimbursement which you will record, it should not exceed the provision that you have recorded for your obligation towards the customer. The reimbursement which you record should not exceed the amount of provision that you have recorded towards your customer. Okay. Now comes the question, sir, what if it is not virtually certain? What if it is not virtually certain? If it is not virtually certain, it will be recorded as contingent asset. It will be disclosed as contingent asset, not recorded. It will be disclosed as contingent asset. Sir, in liability, there are three things: liability, provision, contingent liability. But in assets, there are only two things: asset or a contingent asset. There is nothing called provision in the case of asset. I believe you are understanding this part. Very good. Now, what is the meaning of onerous contract? Onerous contract are the contracts which are loss making, okay? Which are loss making. So now, first of all, tell me, do we recognize future operating losses? Tell me, do we recognize future operating losses? No. But if the future operating loss is in the nature of onerous contract, do we recognize that? If the future operating loss is in the nature of onerous contract, can we recognize that? Yes. Yes. How exactly or why exactly? I will show it to you. Don't worry. Let me take up an example for this. Example on onerous contract. So let's suppose I have a contract wherein I have an obligation to deliver 10 units at $50 per unit. At $50 per unit. Now, I know that the cost to manufacture will be 55 per unit. So if I execute this contract, what is the loss that I will incur? Tell me. What is the loss that I will incur? Tell me. So $5 per unit into 10, not 5. Let me make it 56. 56. So what is the loss? 6 per unit. $6 per unit is the loss, and 10 units. So I will incur into a loss of $60. I will incur into a loss of $60. Okay. Okay. Now, if I cancel the contract, I will have a loss of $70. Tell me, what is beneficial? I will have to bear a penalty of 70 to cancel the contract. If I execute the contract, I will have a loss of 60. Which one shall we go? So I will go as per the lower loss, 60. So I will have to record this loss. I will have to record a provision for this loss. Okay. So ideally, we don't record future operating losses. But if the future operating loss is the nature of onerous contract, we do record this. And in the case of revenue recognition, also we discussed it. I will show it to you. Just give me a minute. I will show it to you. I was discussing with my students in FR class. I will show that to you. Just give me a minute. Allow me a moment, please. See here. If in the case of IFRS 15, revenue has to be recognized over a period of time, and we see that the contract is a loss-making contract. Okay. Now understand here. So what happens here? So the contract price is 100. And expected cost is 115. Now the standard says that first of all, recognize revenue and cost of sales as per the input method or output method, whichever the company is following. So let's suppose as per the measure of progress, company has completed the 60% work. So what is the revenue that we will recognize? Tell me. This is the second year of contract. In the first year, they complete 20% work. Cumulatively, they have done 60% work here. So what is the revenue which the company will recognize? 60% of 100 minus 20, that is 40 ka revenue, minus 20, that is 40 ka revenue. Is that clear, everyone? Now, how much cost will be recognized? 115 ka 60%, that is 69. And how much revenue cost I have recognized in previous year? 16 minus 16 is 53 is the cost of sales which I am recognizing. So what is the loss which I recognize? Loss of 13 I am recognizing here. Is this part clear till here? Is it clear till here? Right? Now the question goes on to state that since this contract is a loss making contract, now you have to calculate what is the overall loss that will happen in this contract. Tell me, what is the overall loss that will happen in this contract? 15 is the overall loss that will happen in this contract. Okay, now how much loss I have already recognized? 13. So how much loss will happen in the future? 2. So for 2 I have to record a provision for onerous contract, meaning thereby I will record 2 ka provision for onerous contract in SOFP, and 2 I will add to cost of sales. This is what we discussed in revenue chapter as well. Okay, now, so this is called as onerous contract. Now, decommissioning, restoration and other liabilities, provision for DRRC, we studied in the case of two chapters. One we studied in IAS 16, and the measurement of which we also studied in IFRS 13, fair value measurement. Tell me yes or no. So I'm not discussing it again. Now restructuring. So if in future entity wants to do some improvements in the company, okay, so for the restructuring or some change in the infrastructure of the company or change in the systems or policies of the company, okay, some restructuring is happening in the company. So for that restructuring, can we recognize the provision? Yes, we can recognize the provision, but only if there is a formal plan for restructuring and the plan is communicated to the affected parties. There is a formal plan and the plan is communicated to the affected parties. Okay, it is then only we can make the provision for restructuring. But understand, when you do the provision for restructuring, you have to make the provision only for the direct costs linked to restructuring. Don't make provision of everything. Provision only for the direct cost linked to restructuring. Okay, so it might be redundancy costs. So for restructuring, I am firing off few employees. So for the employees which I am firing off, I have to pay them termination benefits. For that, I have to make a provision. Legal cost of restructuring, I have to make a provision. Now, let's suppose as part of restructuring, I transferred few employees to some different company. Now, in the different company is giving them training, staff training. Will I make a provision for that here? No, I will not make a provision for that here. Okay. Now, warranties, I discussed this in the revenue also. So warranties are of two types. One is the standard warranty that is coming as part of the product, and one is the additional warranty. Okay, extended warranty. Okay, now, so for standard warranty or the inbuilt warranty which comes along with the product, we make a provision for the same. But for the additional warranty, do we make a provision? No, we don't make a provision. Rather, we recognize revenue for the same. Okay. Now, what is the meaning of contingent liability? We discussed the meaning of contingent liability. We discussed the meaning of contingent asset. So understand, contingent liability is not recognized. It is disclosed in the notes to accounts. Contingent asset is not recognized. It is disclosed in the notes to accounts. But yes, if any contingent asset becomes virtually certain, that has to be recognized in the SOFP as an asset. Is that clear, everyone? So this completes my provisions, contingent liabilities and contingent assets. Now coming to the next chapter, that is events occurring after the reporting date. So I'll tell you, this name is not full. This is just the half name. So let me complete the name of this. So events occurring after reporting date but before FSR authorized for issue. But before FSR authorized for issue. Is that clear, everyone? Okay. Now understand the concept. Using this diagram. Okay. Now let's suppose this is my financial year. 23-24. This is my reporting date. And on this date, my FS got authorized. So the events occurring in this period is covered as per IAS 10, that is this standard. Are you understanding the scope of this standard? Okay, wonderful. Now these events are divided into two parts. Adjusting event and non-adjusting event. Now, how to identify whether this is an adjusting event or a non-adjusting event? Let me explain with the help of example. So understand, if the events that happen here already existed on this date, just that these events give a confirmation of it, then these events are called as adjusting events. Okay, otherwise these events are called as non-adjusting event. Now example, here fire happened. Tell me, fire caught the my warehouse caught fire. My warehouse caught fire. Tell me, is it an adjusting or a non-adjusting event? It is an adjusting or non-adjusting? It is non-adjusting event. Okay, non-adjusting event. Now understand, I had a trade receivable. Okay, I had a trade receivable on which I had significant doubt. On this date, I had significant doubt that he will not pay me the money. And on this date, he became insolvent. Is it an adjusting or non-adjusting? Tell me. Adjusting event. Why? Because I was having doubt. Now, on this date, a legal case was going on against my company. On this date, the final verdict came. Adjusting or non-adjusting? Adjusting. Okay, adjusting. So I believe you are understanding the meaning of adjusting and non-adjusting. I believe you are understanding the meaning of it. Now comes the question: what exactly will happen? How will it make difference? If it is an adjusting or a non-adjusting, how will it make the difference? Understand? If it is an adjusting event, we will account for in which year? Tell me. If these events are adjusting event, we will account for that in which year? 23-24 or 24-25? Tell me. In which year will I do the accounting? 23-24. Okay. Now, if it is a non-adjusting event, then in which year will I do the accounting? In which year I will do the accounting of it? 24-25. If it's a non-adjusting event, I will do the accounting in 24-25. But I will just disclose this event. If it is a material event, I will just disclose it in the FS of 23-24. I will just disclose it in the FS of 23-24. Is that clear, everyone? Now, standard also goes on to say that if the non-adjusting event are that material that it impacts the going concern, then it becomes the adjusting event. Are you understanding? Now tell me, don't you think this one page chart covers everything about IAS 10? This one page chart covers everything about IAS 10, right? Now, I have taken up certain examples, okay, which I believe can be tested in your exam, okay? Understand. First one is trade receivable. So on reporting date, I just made a normal provision. Okay, and my trade receivable became insolvent here before the FS was authorized for issue. Adjusting or non-adjusting? Tell me, guys. Non-adjusting. Now, on the reporting date, I made a high provision because there was a high risk and the debtor became insolvent. Adjusting or non-adjusting? Very good. Inventory. So on the reporting date, I had inventory. And subsequent to reporting date, fire came or earthquake came or flood came. But before FS are authorized, is it adjusting or non-adjusting? Non-adjusting. Now on the reporting date, okay, I had an inventory, but subsequent to reporting date, the price went down. Adjusting or non-adjusting? Tell me. Adjusting. Why? Because the inventory existed on this date. No, the inventory existed on this date, right? So if the price went down because this inventory existed on this date, which I am going to sell anyways in the future, and if the prices goes down, this is an adjusting event. Okay. Now dividend. If the dividends are proposed or declared after the reporting date, is it an adjusting event? No, it's a non-adjusting event. So will we recognize as a liability? No, but we will disclose this. We will disclose it in the notes to accounts if it is approved, if it is proposed or declared before the FS are authorized. Is that clear, everyone? Is that clear, everyone? Okay, so this completes my events also. Okay, so now let us revise the chapter of employee benefits. So understand first of all what exactly is the benefit, employee benefit mean. So understand employee benefit basically means in lieu of the service received from the employees, in lieu of the service received from the employees, whatever amount that we pay to the employees, whether in the form of cash or in the form of kind, whatever may be the form, okay, is called as salary, is called as salary, is called as employee benefit expense, is called as employee benefit expense. Okay, now understand, so employee benefit expense are of multiple types, employee benefit expense are of multiple types. So it can be a short term employee benefit, it can be a short term employee benefit, it can be a post employment employee benefits, it can be a long term employee benefits, or it can be termination employee benefits. Now comes the question, what exactly is the meaning of these four, what exactly is the meaning of these four? So let me help you with the explanation of the same. So let's suppose this is my reporting period starting from 1st April 23 ending on 31st March 24. Okay, so if any benefit that has to be paid to the employee within 12 months from this period, within 12 months from this period, within 12 months from this period, it is called as short term employee benefits, it is called as short term employee benefits. So let's suppose the employee has worked here for this period, we have to give him the bonus. So we say that within 4 months I will give you the bonus. So this bonus that is payable is called as short term employee benefits. Let's suppose the salary for the month of March is payable in the month of April, this is called as short term employee benefits. Okay, now if any benefit has to be paid beyond 12 months, beyond 12 months from the end of the reporting period, okay, beyond 12 months means after 31st March 25, it is called as long term employee benefits, it is called as long term employee benefits. Okay, now if any benefits are to be paid after the employees retire, after the employees retire, that is called as post employment employee benefits, that is called as post employment employee benefits. Okay, now any benefit that we have to pay if we terminate an employee, that is called as termination employee benefits. Now comes the question, what is the difference between post employment employee benefits and termination employee benefits? What is the difference between these two? So post employment employee benefits is like employee is resigning on himself, employee is resigning on himself, and when the employee resigns, when the employee resigns or gets retired, after that we pay the benefit to him, it is called as post employment employee benefits. Okay, after the employment is over. Now termination is when we terminate an employee, when the employer terminates an employee, and on termination he is giving any benefit to the employee. Sir, when can an employee be terminated? So let's suppose might be due to disciplinary issues an employee is terminated, employer terminated an employee. Okay, termination means kick out. Okay, so now, or you can say the performance was not good of the employee, so we terminated the employee, or you can say for any whatsoever reasons we fired the employee, we fired the employee, it is called as termination benefits. Now when the employee resigns on himself or gets retired, it is called as post employment employee benefits. So I believe you are understanding the difference between post employment employee benefits and termination employee benefits. Tell me yes or no. Clear, everyone? Very good. Okay, so now we have to study about each of them. First I will study about short term employee benefits, then we study about post employment employee benefits. So I can say that in this revision we will spend 30% of our time in short term employee benefits, 60% of my time, not 60, 65% of my time in post employment employee benefits, and the remaining 5% time I will help in the explanation of these two. Okay, only so you can understand the importance of these 2 points, you can understand the importance of these 2 points. Okay, so let me discuss with you guys now. So understand, so first one comes is short term employee benefits, short term employee benefits. Now short term employee benefits again are divided into three parts basically. One is the wages or salaries, the outstanding wages or salaries. Another is short term paid or compensated absences, and third is profit sharing or the bonus plan. So let me explain one by one everything. What is the meaning of wages or salaries? So let's suppose the salary of the month of March is pending, okay, is due to be paid in the month of April. So what is it called as? Outstanding salary. Tell me yes or no. Outstanding salary. So how will we record that? Salary expense account debit to salary payable. Salary expense account debit to salary payable. That's what I believe it is clear. So this is what is the treatment of wages and salaries. Now, if any profit or sharing plan or bonus sharing plan is there, okay, meaning thereby whatever is the profit earned during the year, we will give a share of it. We'll give a share of it to my employee. So when will we give it? When there is a obligation, when there is an obligation of the entity to give the profit share or to the employee. In that case, we give the profit share to the employee. So in that case, what we'll do, we will record it as an expense and a liability. Record it as an expense and a liability. That is profit sharing payable, profit sharing expense account debit to profit sharing payable. Simple, right? So here also we'll record what? Employee benefit expense. That will record an expense. We will record an expense and we'll record a liability for the payable. We'll record a liability for the payable. Okay. So understand one thing here. Just a minute. I will add a page. So as I told that short term employee benefits are of three types. So one is outstanding wages or salaries. Outstanding wages or salaries means the salaries which are incurred. Okay, employee has already given the services to me, but I have not paid the salary to the employee. So for this, what I will do, I will record the expense on an accrual basis. So it will be employee benefit expense account debit to salary payable. To salary payable. Now further, if I come up here for the profit sharing plan, profit sharing or bonus plan, so what will I do here? So I will again record here same thing, employee benefit expense account debit to profit share payable. Okay, or you can say salary payable. It is also a salary only, right? Just we are giving the name of profit sharing, but it is ultimately a salary payable, right? To salary payable. To salary payable, right? Now comes the third thing and the most important part of short-term employee benefits is leaves, which we also called as compensated absences. Absence means leave. Compensated means paid leaves. Okay, compensated means paid leaves. Now this is the most important part, paid leaves. So how to account for this? Now the standard says that leaves are of two types. One is accumulating leaves. And another is non-accumulating leaves. Now, what is the difference between these two? So let's suppose in the current financial year, I was entitled to take a leave of 10. I was entitled to take 10 leaves during the current financial year. Okay, but I availed only 3 leaves. Okay, or I availed only 3 leaves. Okay, now, so how many leaves are unutilized? Tell me, how many leaves are unutilized? Come on, guys, tell me. 7. Now what will I do with the 7? Now if the standard says that these 7 leaves which you have not utilized in the current year, it will get transferred to the next year. That is carry forward to the next year. Then it is called as accumulating leaves. Okay, now if it is cannot be carried forward to next year, can't be carried forward to next year, then it is called as non-accumulating leaves. Are you understanding the meaning? Come on, guys, tell me. Are you understanding the meaning? Okay, now standard further goes on to say that if it is accumulating leaves, that it can be carried forward to next year. So now in the next year, if the employees can take leaves, the employees can take leaves in the next year. Otherwise, if the employees will not take the leave, these leaves can be encashed. These leaves can be encashed. Okay. Now, or employees can take leaves in the next year, or if the employee doesn't take leave, these leaves will lapse. These leaves will lapse. Okay. Now tell me one thing. Is there a policy? Is there a policy that in the next year also, if the employee doesn't take leave, we will carry it forward for the next year? No, that is not possible. We can always carry forward to 1 year only, not more than that. Okay, we can carry forward to 1 year only and not more than that. Is that clear, everyone? Now, if the leaves cannot be accumulated, if the leaves cannot be accumulated, means the leaves cannot be carried forward to next year. Whatever is the leaves remaining. So let's suppose I was entitled to 10 leaves, but I availed only 3 leaves. So 7 leaves are unutilized. So what will happen to those leaves? So what will happen to those leaves? So either they will lapse, or the company will give me the encash. Company will help me in encashment of the same. So there are 4 cases that is there. Case 1, case 2, case 3 and case 4. And case 4. So these are the 4 cases which we have to study. These are the 4 cases which we have to study. Okay. Now, so let us understand the accounting treatment of each of these. Let us understand the accounting treatment of each of these. So understand, if in the next year the employees will take the leaves, or we will give them encashment. So understand what has happened. What has happened here? In the current year, employee has taken less leaves. Tell me yes or no. In the current year, employee has taken less leaves, means employee has worked more. Employee has worked more, for which we will give a benefit to the employee in the next year in the form of extra leaves or cash. In the form of extra leaves or cash. Tell me yes or no. So in the current year, I was entitled to 10 leaves, but I availed only 3 leaves. So 7 leaves remains unutilized. So 7 leaves gets carried forward to next year. In the next year, so what is the meaning of 7 unutilized? Means an employee has worked for 7 days extra as compared to the other employees. So we are compensating my employee who has worked extra by giving him extra leaves in the next year, or giving him cash for the 7 days. So now what will I do? I will make a provision for 7 days, and my journal entry which I will record is employee benefit expense account debit to provision for compensated absences. Okay, compensated absences to provision for compensated absences. Is that clear, everyone? Now, if this is case number 2, I will give the employees leaves, or they will lapse. So now understand, if the employee was not able to avail the leaves in the full leaves in the current year, tell me, do you think he will be able to avail the leaves in the next year fully? Might not be right, might not be the case. It can be or it cannot be. So in that case, if he doesn't avail the leave, the leaves will lapse. If he doesn't avail the leaves will lapse. So now, will I make provision for 7 days? No. I will have to estimate. Here I will have to estimate number of leaves in next year. What is the number of leaves that the employee will take in the next year, and accordingly I will make a provision for the same. Okay, and accordingly I will make a provision for the same. The journal entry will remain the same. Okay, now if the leaves are non-accumulating, that is, if I have not taken the leaves, it will lapse. So no treatment for the same. If I am giving cash to my employee, so for that I will record employee benefit expense account debit to bank if I have paid to payable if I am yet to pay. To payable if I'm yet to pay. Tell me, is the accounting treatment of short-term employee benefits clear to all of you? These journal entries, this journal entry, I'll tell you, this journal entry will be passed on the reporting date, Kaniska. This journal entry will be passed on the reporting date, okay, at year end, because we are evaluating what will happen in the next year, okay. So I believe it is clear to all of you. Now, one point which you need to take care of, see, question, if the question is silent, whether it is case 1 or case 2, see, the question will clearly state whether it is accumulating, or non-accumulating. The question will very specifically mention the same. But in most of the cases you will find that the question is silent whether it is case 1 or case 2. Then in that case, what will you do? In the case the question is silent, assume it to be case 2. Assume it to be case 2. If the question is silent, assume it to be case 2. Okay, assume it to be case 2 if the question is silent. Okay. Now, let us solve one example. So it says Rango company has 20 employees. Each is entitled to 25 paid days of holiday leaves per annum. So how many employees am I entitled to? So I'm entitled to 25 days of leave per year. Okay, very good. Now, a maximum of 5 days unused leave can be carried forward. A maximum of 5 days unused leave can be carried forward for 1 year. Carry forward for 1 year only, and that too only five leaves can be carried forward. But in the following year, the current year allowance must be used before the carry forward allowance. Now, what is the meaning of this line? Can you tell me? In the next year, the current year allowance must be used before the carry forward allowance. Tell me. So let's suppose, I'll tell you, I'll give you an example of this one. So let's suppose this is in this year, I was entitled to 25 days of leave. I availed, let's suppose, 22 days ka leave, and 3 days ka leave remains unutilized. 3 days ka leave remains unutilized. Okay. Now, so this becomes the opening is 3 days ka leave. Now, in the next year also, again I will be entitled to 25 days ka leave. Again I will be entitled to 25 days ka leave. Right now, here let's suppose I take 27 days ka leave. 27 days ka leave. Okay. Now what will happen here? See, understand. So I will say 27 days. First of all, I will adjust from these 25 days, and then from opening I will adjust 2 days. Meaning thereby here I will make a provision of not 3 days. I will make provision of 2 days. I'll make provision of 2 days. Right. So this is what is happening. Last in, so this is coming last, right? Last in but utilized for the first. So it is called as a concept of LIFO. Is it clear, everyone? LIFO means last in first out. Okay, tell me guys, is that clear, everyone? Are you understanding this concept? Okay, wonderful. Now, at Rango year end of 30th June, each employee had an average of 3 days unused leave. Average 3 days of unused leave means 25 days was availed, was entitled. I was entitled to 25 days. 3 days unutilized means they have taken the leaves of 22 days. They have taken the leaves of 22 days, and on an average, employee has worked extra for 3 days. Okay, now, however, the calculations of this average include one employee with 12 days carry forward and another with 8 days carry forward. Now tell me, can I carry forward 12 days leave or can I carry forward 8 days leave? No, I can't. So tell me, how many total employees I had? 20. Okay, total employees was 20. So and per day on an average. What is the unutilized leave? 3. So 20 multiplied by 3 is how many? 60 days. 60 days. But for one employee, 12 days is the carry forward. But can I carry forward for 12 days? No, I can carry forward only to the extent of 5 days. So the 7 days cannot be carried forward. Now for 8 days, can I carry it forward? No, I can carry forward only to the extent of 5 days. So the remaining 3 days cannot be carried forward. So 7 plus 3, 10 days cannot be carried forward. So this 60 minus 10 is 50 days only can be carried forward. 50 days is what can be carried forward. Now 50 days, and what is the salary per year? So each day paid leave costs 150. So 50 days into 150 per day is 7500 is the provision that I'll make. Is that clear, everyone? Is that clear, the provision? Wonderful. So this is what is the concept of short-term employee benefits. This is what is the concept of short-term employee benefits. Clear to everyone? The concept of short-term employee benefits is clear to everyone. Now I will start with post-employment employee benefit. Now comes post-employment employee benefits. Now what is the meaning of post-employment employee benefits? So understand, as I told, that any benefits that are payable to the employees, okay, after they resign the job, or you can say they retire from the job, okay. So it is called as post-employment employee benefits. The wonderful and the best example of these two are I'll give you the two examples. One is in case of India I am telling about. So one is the Provident Fund. Do you know what is Provident Fund? Okay. Another is gratuity. The two best examples, right? Provident Fund and gratuity are the two best examples of these two. Understand? So post-employment employee benefits are divided into two parts. And the accounting of them is significantly different. So that's the reason why we need to understand the meaning of these two first of all, and then study the accounting of it. One is defined benefit plan, and another is defined contribution plan. So now understand the meaning of it. So what happens in defined benefit plan and defined contribution plan? So in defined contribution plan, what happens? In defined contribution plan, what happens is employee gave service for 1 year. So whatever is the amount pertaining to this year, okay, we deposit in a separate account for the employee. Which is in the control of employee, but employee cannot use these funds now. Can employee use these funds? No, employee cannot use these funds now. But employee can see, okay, I have received the money. Employee can see that I have received the money, but employee cannot use the funds. When will employee be able to use the funds? When he retires from the job. Then he will be able to use these funds. Okay. So now see, understand. Employer received services. Employer gave the money. In a separate account. So the responsibility of the employer is over. So what will employer do? Employee benefit expense account, debit to bank. Simple treatment done. Whatever amount we contribute, we record as an expense, and my accounting done. But in the case of defined benefit plan, what happens here is, understand, I am telling to my employee that I will give you a defined amount here. Okay. Now let's suppose employee has served for a period of 5 years. Now tell me, is it correct that if I record whatever I pay here, I record the entire amount as an expense on this date? Will that be correct? Tell me. No. Why? Because I have received the services for 5 years. Then I have to record the expense also for 5 years. So I have to record the expense here also. But comes the question, the expense accrual happens here, but I am paying it here. accrual happens here, I am paying it here. So there is a time value of money component that gets involved. There's a time value of money component gets involved, right? So in this case, what will I do? So first of all, I will calculate what is the amount that I have to pay to my employee on this date. What is the amount that I have to pay to my employees on this date? Tell me yes or no. Point number one is estimate the benefits to be paid. Then calculate what is the benefit per year. What is the benefit per year? Then say, okay, this much is accrued for this year, but I am going to pay it this year. So there is a time value of money component involved. So what I will do, I will calculate the present value of it and record expense. I will calculate the present value of it and record expense. So this present value is called as what? Tell me. This present value is called as what? Can anyone tell me the name of the present value? What is the name of this present value called as for this year? For this year, the present value is called as what? Current service cost. Current service cost, which we record as an expense and a obligation. Current service cost, which we record as an expense and an obligation. So for this year, the present value is called as current service cost. Okay, now so this is what we record on this date. We record current service cost for this year. For this year, we record the current service cost. Now let's suppose when I go to the next year, what will I do? What will I do? So I will, since we have calculated the present value, and you know, whenever there is a concept of present value, there comes a concept of tell me guys, unwinding finance costs, right? So we will unwind this and record what? Finance cost. And we'll record what? Finance cost. And then again for this year we'll again record current service cost. Okay, so now so this will become the total. Now again we will undo the unwinding and record finance cost, and I will record current service cost for this year. Again I will do the unwinding and record finance cost, and I will record current service cost here. Again I will do the unwinding and record finance cost and record current service cost here, and then I will pay the amount. This is called as the accounting treatment that we follow in the case of defined benefit obligation, defined benefit plan. Okay, now understand. But this is not this much simple. Ideally, this is not this much simple. What happens at every reporting date? See, we calculated here initially. Now here the estimates might change. Here the estimates might change. So I will have to revisit all my calculations, and the change in the obligation due to change of the estimates are called as what? Tell me. Are called as what? Tell me. Are called as what? Change of the obligation due to change of the estimates are called as what? Actuarial gain or loss. We also say it to be remeasurement gain or loss. Remeasurement gain or loss. Now tell me, what is the treatment? So this current service cost goes to P&L. This finance cost goes to P&L. This actuarial gain or loss or remeasurement gain or loss, both are same thing. The name is just the name is they have two different names. Okay, but this is one and the same thing only. So this goes to other comprehensive income. This goes to other comprehensive income. Now understand, let's suppose there is a change in the plan itself. There is a change in the plan itself. What is it called as? Tell me. If there is a change in the plan itself, it is called as past service cost. And where does it get recognized? Tell me. Where does it get recognized? P&L or other comprehensive income? P&L. It gets recognized in P&L. So now tell me, are you understanding the entire concept behind this? Are you understanding the entire concept behind this? So what is defined benefit plan? What is defined contribution plan? What is accounting treatment of these two? Are you understanding these things? Tell me guys. Very good. Very good. So now I'll take up one example to help you understand the process of it, but I will sincerely request you guys that I have taken two examples, and I want all of you to solve these two examples in depth. If you solve these two examples in depth, I can guarantee that you will understand the entire concept surrounding the defined benefit plan. Not only these two examples, I have taken up further two more examples, example number 3 and example number 4. Okay, now if you solve these 4 examples, I guarantee that there is no different question that can come up in the exam. Okay, if a question on defined benefit plan comes in the exam, it will come from these 4 examples only. Not even a single different question can be set apart from this one. Now, example number one, defined a benefit plan. So understand. So what we do first of all here, we calculate the benefits to be paid as I told. Then we calculate what is the benefit attributable to per year. Then we calculate the present value, and this present value is called as what? It is called as current service cost. See this amount same. Is it written here also? See, tell me here. Is it same? Is it same? Tell me guys. Come on. Is it same? Tell me. Is it same? Is it the same? Come on, tell me. Is it the same? Yes, it is same. Now, how does it move? See, for the first year, was there any opening obligation? No. Was there any finance cost? No. So, for the first year, we record the current service cost, and this becomes my closing liability. Now, in the next year, it becomes my opening liability. Now, I will unwind and record finance cost and record the expense for the second year, and this becomes my closing liability. Now see further. So this closing liability becomes my opening liability for the third year beginning. Now I will unwind and record finance cost, and I will record the expense for the third year. This becomes my closing liability. So I will follow this process. Now understand, this finance cost and current service cost both goes to P&L. Both goes to P&L by the name employee benefit expense. Why employee benefit expense? Current service cost, we understand it is an employee benefit expense, but finance cost, why employee benefit expense? Why are we incurring the finance cost? For my employees, right? So this, all these two are both called as employee benefit expense. Don't club this finance cost under the head finance cost. No, no, no. Even though it is a finance cost, but in effectively it is not a finance cost, it is a employee benefit expense. So add these two and record as employee benefit expense to PVDB. What is the meaning of PVDBO? Present value of defined benefit obligation. Is that clear, everyone? Is that clear, everyone? Come on guys, tell me. Wonderful. Now, example number two. Now, in example number two, I am trying to say, if your estimates changes, so what you will do, you will remeasure your obligation, and whatever is the change in obligation due to remeasurement goes to OCI as actuarial gain or loss, or you can say remeasurement gain or loss. Okay, the actuarial gain or loss and remeasurement gain or loss are you can say synonyms. Okay, they are synonyms. Okay, they can be used interchangeably in the exam, so don't get confused. Okay, now, so what is journal entry? Other comprehensive income account debit to PVDBO. How do we record that in the statement of financial statements? Understand? So the current service cost goes to P&L. The current service cost and the finance cost goes to P&L. Okay. Now the actuarial gain or loss goes to other comprehensive income. In SOFP, we will record PVDBO. We will record PVDBO. In SOFP, we will record PVDBO. I believe it is clear to all of you now. So now the summary of it: current service cost goes to P&L, finance cost or interest cost goes to P&L, actuarial gain or loss or remeasurement gain or loss, that is change in liability due to change of estimates, goes to other comprehensive income. Past service cost, that is change in liability due to change of plan itself changes. Okay, then the past service cost, it goes to P&L. Curtailment or settlement. What is the meaning of curtailment or settlement? If I'm cancelling the plan, it is called as curtailment. Okay, now whenever I'm cancelling the plan, don't you think it will demotivate my employees? If I'm cancelling the plan, it will demotivate my employees, right? To motivate them further, I am paying a settlement money to them. So now if I cancelled a plan worth $28 million, so what will I do? I will debit my PVDBO by 28 million, because if I cancelled a plan worth 28 million, it will reduce my obligation by 28 million. Now to settle this, I am paying 16 million to my employees. So to bank, I did 60 million. Okay, now the difference is my gain of 12 million. Which will go to P and L. Is that clear to everyone? Tell me guys, is that clear to everyone? So this is the summary of PV defined benefit plan. This is the entire summary of defined benefit plan. Is that clear to everyone till here? Come on guys, tell me. Now, see, understand, we have fairly discussed the treatment of defined benefit plan, but there is one more concept. See, understand, we now know that the company has an obligation, the entity has an obligation, the employer has an obligation to pay a fixed amount of money at the end, at the time of retirement. Tell me yes or no. at the time of retirement, it has an obligation to pay a fixed amount of money. So even though we have recorded the expense in P&L, okay, so accrual part, expense part is fine, but from the point of view of outflow, don't you think it will be an excessive burden on the company to pay a large sum of money at one time? Tell me yes or no. Large sum of money to be paid at one time will be difficult for the company. So now what company does, what the employer does is every year they try to invest the similar amount, whatever they have recorded as an expense, they try to invest a similar amount in a fund, in an investment plan, okay. You know about these plans, right? This HDFC retirement plan, all those things. So these are the plans where this company invests, okay. Retirement plan, pension plans, NPS plan, this plan, that plan. There are a lot of investment plans, okay. Now few companies make their own trust for employee benefit trust for the same, okay, and the trust does the investment. So now basically what happens, to avoid a huge outflow at one time, just to avoid a huge sum of outflow at one time, company invests a little bit of money every year, so that the at the time of payment at the end of fifth year, I will have the investment, I will have sufficient investment from which I can pay the amount, and there will be no much burden on the company to pay a large sum at one shot, okay. So now this is called as funded scheme. Now, so what happens in the case of funded and unfunded? I will discuss both. Just listen to me carefully. So what happens here? If you are having a funded scheme, so what will you do? You will invest every year a sum of money, and this investment to that fund is called as contribution to the plan assets. So whenever we invest in that fund, we pass entry plan assets account debit to bank. But tell me, if it is unfunded, will we invest any amount of money in the year? Will we invest any amount of money? No. So no entry in this case. Unfunded, no entry. Now, if I have invested, definitely I will receive some income also from that. If I have invested any sum of money, I will receive income also. So what is the income? So plan assets account debit to finance income. Okay. Now, if I have not invested only, will I receive any income? No, I will not. Now, when you have to pay the benefits to the employees, when you are actually required to pay benefits to the employee, so if it is not funded, then what will I say? My obligation account debit to bank. Tell me yes or no. So whenever I have to pay the benefits, I will say obligation account debit to bank, right? But if it is funded, tell me who will pay the benefits? The plan will pay the benefits. I am not required to pay the benefits. The plan will pay the benefits. So now what happens here? In case of funded scheme, I am relieved of the obligation to pay a large sum of money at one time, right? I am relieved of it. Though it is my obligation, but I am relieved of the cash flow. So it is the plan assets who will pay the amount. So PVDBO account debit to plan assets. Are you understanding this part? Tell me, guys. Are you understanding this part? Tell me. Okay. Wonderful. So now let's leave this part and come to this question. Now it says on 1st April 2005, the fair value of the pension scheme assets was 200 and your obligation was 260. So your obligation was 260 and assets was 200. Now tell me, can I use this investment for any other purpose? No. So this investment has to be used specifically for PVDBO. Now since they are closely linked, they are closely related, so in the SOFP they have to be recorded on a net basis. We'll record the net obligation in SOFP. So what will I say? My obligation is 260. For that I have done an investment of 200. So my net obligation, which is 60. Okay. The interest rate is at the rate of 5%. So I will have to pay a finance cost of 5% on this is 13. I will receive a finance income of 5% on this is 10. So this is the net finance cost. So this is the net obligation, net finance cost. Now the question gives you current service cost is 30. So now tell me, current service cost will increase what? So current service cost, what is journal entry? So current service cost journal entry is current service cost account debit to PVDBO. So it will just increase my PVDBO. So it will just increase my PVDBO. Now contribution. So it will just increase my plan assets. So contribution is how much? 21. So it will increase my plan assets. It will increase my plan assets. Now benefits paid during the year 25. Now what will happen for the benefits paid during the year? It will reduce my obligation and plan assets both. For contribution paid, it will reduce my obligation and plan assets both by an amount of 25. By an amount of 25. Okay, by an amount of 25, it will reduce the benefits, it will reduce the plan assets and PVDBO both. Now scheme curtailment 28 means I have cancelled the obligation by 28, so it will reduce my PVDBO by 28, and to curtail, I have to pay settlement of 16. So I have to reduce my plan assets by 16, because if I have to pay, my plan assets will reduce. Okay, so this is what it is. Now what you have to do here is, this is what is your obligation, this is what is your assets. So calculate the net amount. PVDBO minus plan assets is equals to net PVDBO. So 260 minus 200 is 60. 13 minus 10 is 3. 30 minus 0 is 30. Nothing here. Cash contribution 0 minus 21 is negative 21. Negative 21. Benefits paid minus 25 minus 25, 0, nothing to be paid. Curtailment and settlement negative 12. It will go to P&L. Okay, now the closing balance becomes 250, 190, 60. So this obligation is, net obligation is 60. Net obligation is 60. Now the question gives you that at year end, as per the revised estimates, this is your fair value of the asset. 195 is the fair value of the asset, and 242 is the fair value of liability. 242 is the fair value of liability. So as per the revised estimates, what is the net obligation that you have? 47 is the net obligation that you have. 47 is the net obligation that you have. 242 minus 195 is 47, right? So what you have to do, you have to record the remeasurement loss of 13. You have to record the remeasurement gain. Your obligation is reducing, right? So 13 ka gain you have to record in, tell me where? P&L. This gain you will record in P&L? No, other comprehensive income. Other comprehensive income. So tell me, is that clear? Are you understanding this point? Are you understanding this point? Tell me, guys, come on. Very good. Now we need to understand one more thing. See, understand, as I told that when in SOFP we record plan assets and PVDBO on net basis. So understand, in SOFP there can be a situation of net obligation, that is PVDBO is greater than PA, plan assets. So like here, see, PVDBO was greater than plan assets. So we recorded the net obligation as it is. But if it is a case of net asset, meaning thereby the plan asset is greater than PVDBO, I have done more investment as compared to my obligation. So my obligation was 90, but I have done an obligation of 120. But I have done an investment of 120. So I have done investment 30 more. So what does it mean? Tell me. What does this mean? So it means that I will get a refund of 30 from the investment. So now the standard says that let us evaluate whether I am going to get a refund of 30 or not. So standard says that excess of plan assets over PVDBO will be refunded back to the entity. So now I have to check whether it will get recovered or not. And this process of testing whether it will be recovered or not 30 is called as impairment of net assets. And it is called as ceiling adjustment. So now in the case of ceiling adjustment, what we do is we compare that what is the fair value of refund. What is the fair value of refund? So let's suppose the fair value of refund is 20. So I'm expecting that I will get a refund of 20. So I have to impair the net assets by 10. I have to impair the net assets by 10, decrease the value by 10, decrease the value by 10, so that my net assets that I will record in SOFP will be 20 and not 30. Are you understanding this point? Are you understanding this point? So understand. So first of all, you have to calculate carrying amount of net assets, and then you have to compare with fair value of net assets. Okay, now this difference is called as actuarial gain or loss. Just a minute, I will write it separately. Add page. Okay, carrying amount of net assets and fair value of net assets. So this amount I have to compare, and this difference is called as actuarial gain or loss, which will get recognized in other comprehensive income. Now after this I have to compare fair value of net assets with that of fair value of refunds. Now if fair value of refund is less than fair value of net asset, if okay, then in that case the difference is called as ceiling adjustment, which gets recognized also in other comprehensive income. I believe it is clear to all of you. I believe it is clear to all of you. Okay, so now I have an example for this also. Don't worry. When Vishal Jain is here with you, you need not worry. Okay, so understand here. See. So what is the understand here? In this case, I'm not solving the entire question, but I'm explaining the concept to you guys. Understand? So what is the carrying amount of net assets? 9.16. Right? What is the carrying amount of net assets? 9.16. Is that clear, everyone? Is that clear, everyone? What is the fair value of net assets? 12. So what is the actuarial gain or loss? 2.84, which will go to OCI. Tell me, is this part clear? Is this part clear? So this is your carrying amount. This is your fair value. This is called as your actuarial gain or loss, which will get recognized in other comprehensive income. Right? Now, then what will I say? What is the fair value? 12. What is the fair value? 12. What is the fair value of refund? See, it is given in the question. It will be given in the question. Where is it given? See, yes, at the year end, the asset ceiling has been calculated at 11 million. So what is the fair value of refund? 11 million. So what is the difference? See, fair value of refund is less than fair value of surplus. Fair value of refund is less than fair value of surplus. Okay, so now I will record 1 million ka ceiling adjustment in other comprehensive income. Now see here this part. Tell me, is this clear? Is this clear, everyone? Is this clear, everyone? Come on, guys, tell me, guys. Please tell me. Clear to everyone? Wonderful. Okay, so again, guys, see, rest everything is a replica what we discussed in example number 3. Okay, so I want you guys to solve this question. This question I have taken from the technical article. Now coming to the defined contribution plan, I have already discussed defined contribution plan. So since I am contributing every year, I will record employee benefit expense account debit to bank if I have contributed. If I am yet to contribute, I will record it as a provision for defined contribution plan. Now coming to long-term plan. Long-term employee benefits. Now the standard says that long-term employee benefits, the accounting treatment is exactly same as post-employment employee benefit, but the only difference here is the actuarial gain or loss on PVDBO, the actuarial gain or loss on plan assets, and the ceiling adjustment will not go to other comprehensive income, rather it will go to P and L. Okay, why? Because in case of post employment employee benefits, there was a high level of uncertainty, that is when will the employee leave the organization or when will the employee retire. There is a high level of uncertainty which is not there in case of long term employee benefits, hence we are recording that in P and L. Now termination benefits, as and when we have to pay the termination benefits, we will record it as an expense to bank, or if you have not paid, I will record it as a provision. Okay, so this is what it is. Now hers is a query, sir, if this fair value of refund is in excess. So now, okay, very good, very good. So if let's suppose the fair value of refund would be not 11 million, it will be, let's suppose, 13 million, then what will I do? I will not record any ceiling adjustment. So what I'm saying now, that I will get a refund, I will get more refund. Okay, fine, let it be. I will keep myself at 12 only. Is that clear? Okay, so this completes my revision of employee benefits. So now what you have to do is you have to solve these examples. All of these examples, solve it, and you will get the confidence on employee benefits as well. Good evening, guys. Please confirm if the audio and video is clear to everyone. Is the audio and video clear to everyone? Please confirm. Amazing. Thank you, guys. Okay, so let's start the discussion of groups. So in this session, basically for the June 24 examinations, we will be taking 3 sessions. Okay, now today we'll be revising the entire group accounts. Tomorrow we'll be solving one question of group accounts, and day after tomorrow we'll be taking up a session wherein we will discuss question number 2, 3 and 4 of pre-mock June 2024 examinations. Okay, so I'll just show you the schedule basically. So these 3 sessions, so this session is happening now, and these 2 sessions are will be happening tomorrow and day after tomorrow. I believe it is very much clear to all of you. Okay, this is point number 1. Second point, we all of us know that from the perspective of group accounts, there are topics which overlap between FR and SBR. So now in this session, I will be discussing only the topics which are specifically from the point of view of SBR. Now the topics which are covered in FR, so I've already taken up a session for FR. So I will recommend all of you to go and watch this session after the class, not now, after the class. Go and watch this video. You can see ACCA FR. You can see ACCA FR video, right? So you have to go and watch this video after the class, so that you can also take a command over the FR group accounts. Okay, is that clear, everyone? Now all of you are watching the session but not liking the videos. Is it good? Come on, guys, all of you, please like the video. Please like the session, guys. Come on, all of you, come on. Okay. So let us start the discussion of group accounting from the perspective of SBR. So now, what are the standards which we are going to cover in group accounts? What are the standards which you have to cover in group accounts? So now understand, from the point of view of group accounts, the standards which you have to cover are 6 basically. Now they are IFRS 3 business combination, IFRS 10 console financial statements, IAS 27 that deals with separate financial statements, IFRS 11 that deals with joint arrangements, IAS 28 deals with joint ventures and associates, and IFRS 12 deals with disclosures. Though from an exam perspective, you are not required to by heart these standards. In the exam also, you are not required to mention the name of these standards. Okay, it is not at all required from the exam perspective. But yes, for the sake of knowledge, I am trying to give you this knowledge that these are the standards which we have to cover.
but from an exam perspective, you are neither required to write the standard number nor the name. Just understand the provisions, write the provisions of the standard, and you will get the full marks for that. Examining team has themselves said in the technical article that there is no extra credit available. There is no extra credit available for writing the standard name and the number, whether it be SBR or AAA. Okay, in both the papers, there is no extra credit available for writing the standard name and the numbers. So no need to take extra load and write these name and the numbers for which you are not going to get any specific marks. Yes, somewhere in that range, Mayur. Okay, now yes, but definitely one point for sure I can say, if you write a wrong standard number, that might lead to deduction of marks. So why to go into a perspective wherein if you write it correct, you won't fetch any extra marks, but if you write it wrong, definitely there is a deduction of marks. So please don't write unless and until you are very much sure of the standard name and the numbers. Don't write the standard name and the numbers in the exam. Now, group accounts. So all of us know that group accounts we have to prepare on, we might have to prepare on two particular dates. Okay, date one is on the day of acquisition. Let's suppose on today a company Tata has acquired Zomato. So on this date we might have to prepare consolidated financial statements or group financial statements. This is called as date of acquisition. Now what is today's date? 25th of May. 25th of May. Now let's suppose Tata has a year end of 31st of March. That is called as reporting date. So consolidated financial statements or group financial statements will be prepared on date of acquisition or on reporting date. That can be asked in the exam. Okay. Questions can come from date of acquisition group FS, or reporting date group FS. Okay. Questions can come from any of these. Now, further coming to an exam perspective, okay, before September 2023, okay, question number 1 of SBR of 30 marks used to be a you can say a theoretical or you can say explaining answer. Okay, where you need to explain the calculations. Okay, you are not required to do much of the calculations. It was much more focused towards the explanations. But from September 23, question number 1 approach has changed. I believe all of you are aware of that. That from September 23, the approach of question number 1 has changed, and they will give you a pre-populated screen for group accounts. Wherein they would have already prepared group accounts. But there will be some mistakes in the group account. Okay. They can either give you console SOFP, they can either give you console P&L, they can either give you console cash flow. Okay, they can give any of these things. Okay, the console financial statements will already be prepared in the pre-populated screen. Now you have to go through the question and find out the mistake in the already prepared group FS and rectify those mistakes. Or question will in the pre-populated screen, the question will give you fill in the blanks. Okay, they will prepare console FS, but they will leave some figures blank. Like for example, NCI is blank, goodwill is blank, console PPE is blank, investment in associate is blank. Okay, now you have to fill in these blanks. So understand. Prior to September 23, if there was a student who had conceptual knowledge of group accounts but didn't knew accurately how to prepare the group FS, or didn't had the practice of preparing group FS, he could have managed the exam. Okay, if he knew the concepts well but didn't practice the group FS, the preparation of group FS, which used to come in FR ideally, he could have managed. But from September 23 exams, okay, if you don't have the practice of preparing the group accounts, whether it be group SOFP or group P&L or group cash flow, then that student will face difficulty. So nutshell, what I'm trying to say here is you need to have a you can say practice. You need to have a practice of preparation of group accounts as well. Okay, when I say group accounts, I mean to say group SOFP, I mean to say group P&L, I mean to say group cash flow. Definitely I'll share these documents. Okay, definitely in my Telegram group I will be sharing this document, don't worry at all. Okay, for also for the session which I've taken for the FR, that document is also shared in the group. Okay, so you can refer that, okay. Now this document has to be seen in conjunction with the FR document. Kirtana, if you have not covered cash flow consolidation, then I will recommend you one thing. Do one thing. In the last session, see this one. Can you see ACCA SBR groups pre-populated response area? Okay, so in this session which I took for March 24, I have solved a complete question on group cash flow. Okay, plus I will be explaining cash flow today. I will be helping you in revision of cash flow. See, I have prepared the detailed notes for cash flow. I'll show it to you. Just give me a minute. See, I prepared detailed notes for console cash flow for you guys. Okay, so now detailed notes for you guys, and I'll be sharing this document with you guys. Don't worry at all for that. Okay, now you revise the console cash flow using my class, plus attend, watch this one, plus watch this video, that will help you in revision of console cash flow. I won't say that it will give you the complete understanding. Yes, after that you will get the basic knowledge of console cash flow. After that you practice, definitely you will get the grip over console cash flow. In that I can say, that I can guarantee with you. Okay, now see specific cases. I have went through past 12 examiner reports and identified the mistakes which you could do. Not only the examiner reports for SBR, I have went through the examiner reports for FR and SBR both, and then I have made this crux. These are the 25 mistakes which examining team has recommended that a student are doing these mistakes. Okay, so I have made a list of all the mistakes which you could do in the exam, and now you just need to take a grip over it and ensure that you are not repeating these mistakes. You can make a new mistake, but you are not repeating these mistakes. Tell me, is that clear, everyone? Tell me, is that clear, everyone? You have to ensure that you are not repeating these mistakes, and I will ensure you can't do any other mistake apart from this one, except for plus or minus mistake or a multiplication or a division mistake. If you are doing that, that is something which you have to take care of. Okay, but apart from that, this is something which I've already I've tried to make an exhaustive list for all the mistakes which you could do in the exam. Okay, by analyzing the past 12 examiner reports for FR and SBR. Okay, now group accounting. So let us start the discussion of group accounts. Okay, now understand. So as I was mentioning that question can ask you to prepare group SOFP on the date of acquisition, and or it can ask you to prepare console financial statements on a particular reporting date. So understand, if the question asks you to prepare a console financial statements or a group financial statements on date of acquisition, so things which you need to take care is on particular date of acquisition, which we need to find out. What is the goodwill, what is the goodwill, what is the fair value of net assets, what is the value of investments, what is the value of NCI. Okay, now so all these we need to find. But if the question is asking you to prepare console FS or group FS on a particular reporting date, then in addition to what you did on group, in addition to what you did on date of acquisition, you are also required to take care of change in the net assets from date of acquisition till that reporting date. I will show what I'm trying to say. I'll try to explain. So understand, this is, let's suppose, date of acquisition. This is suppose reporting date. Date of acquisition is, let's suppose, 1st July 20x4. Okay. Reporting date is, let's suppose, 31st December 20x4. Okay. Now on date of acquisition, we need to find what is the value of investments, what is the value of NCI, what is the value of net assets, what is the value of goodwill or gain on bargain purchase. Okay. Now if you are preparing on reporting date, definitely you are required to analyze these things, but in addition to this, you are also required to analyze what is the change in net assets of subsidiary. Okay. Post acquisition. When I say post acquisition, it means from date of acquisition till reporting date. Now you have to analyze what is the pre-acquisition profits and the post-acquisition profits, and whatever is the post-acquisition, you need to analyze, you need to allocate to parent and to NCI in the ratio of their holding. So this is what is called as allocation. Okay. And subsequently we will study it as allocation of net assets of the subsidiary. Now, group accounting. Valuation of cost of investments. Okay. So now if you go and watch my FR lecture on group accounting, you will understand what are the classification of investments. And I will discuss that the investments can be classified as a normal investment. The investments can be classified as a, you can say, subsidiary. Investments can be classified as an associate. Investments can be classified as you can say a joint venture or a joint operation. Now then I will discuss what is the accounting treatment of investments in SFS of the parent, in SFS of the investee. Okay. And what is the treatment in CFS, that is group FS. So that's what I will discuss in my group accounting lecture for FR. Okay. But now it's a similar thing, so I'm not discussing it again here. You can watch it from there and get a grip over it, but I'm proceeding further here. Now, so further, what is the valuation? How do you value the cost of investments? So the cost of investments is quite very easy, you will say. Why? सर कॉस्ट तो इजी है ना, मतलब हमने जितना पैसा दिया, जितना डॉलर्स दिया उस इन्वेस्टमेंट को अक्वायर करने के लिए, दैट इज माय कॉस्ट, दैट्स माय कॉस्ट, इट्स as simple as that. I agree. But in real life, understand guys, in real life, it's not as simple as that. Many times you will see that when I'm acquiring investments, it's not that I am paying the consideration for these investments directly in the form of cash or in the form of bank. No. I might give the shares of my own company, or I might give a promise to pay the money, a fixed amount of money after a fixed period of time. Okay, in future. Okay, or I might give a promise to pay in the future, but along with a condition attached to it. Like for example, I'll pay you this much dollars after 2 years if the profit of the combined entity is this much. So there is a condition attached to it. It is called as contingent consideration. Okay. Now, it is called as contingent consideration. So we will discuss about cash, share exchange, deferred consideration, contingent consideration, acquisition cost, everything in detail in my FR lecture I have already discussed, and I will recommend all of you to go and watch that after the class. Okay, now coming to contingent consideration. Sir, you told contingent consideration will be discussed at FR level. Yes, but at SBR level, there is one thing specifically which I want you guys to study from a contingent consideration perspective. Now, what happens? Contingent consideration can be of two types: financial liability or equity. Now, when you will watch my FR lecture on contingent consideration, I will say that whatever is the fair value change on the contingent consideration, that you have to account for in the consol P&L or the group P&L subsequently as and when it occurs. Okay, as and when the fair value changes occurs, whether it is a fair value gain or a fair value loss. you have to recognize that in P&L. But if the contingent consideration is in the nature of equity, if the contingent consideration is in the nature of equity, then you are not required to remeasure. You are not required to remeasure it. Okay, you are not required to remeasure it. Is that clear, everyone? Examiner might test you on this part. Examiner might test you on this part. Tell me, guys, is that clear to all of you? Now, and I have seen students in the mock that they remeasure the equity component as well. Okay, and that's why I will tell that this is an alert area. Wherever I'm writing alert, you guys have to become alert there. Okay, you guys have to become alert there. Now, other adjustments. This is something which you need to be very careful about. Okay, very careful. Now, other adjustments. So till here everything was FR related. From now onwards we can say that we are starting the group accounting of SBR. Okay, now other adjustments. Okay, other adjustments to the cost of investments. Okay, let's write here other adjustments to cost of investments. Now, payment to employees of acquiring company. Let's suppose Tata acquired Zomato. Tata acquired Zomato, and now Ratan Tata is telling to Dipender Goyal that, buddy, you remain in this company for some period of time. For 2 years, you remain in this company. You remain in this company for 2 years. For that, I will pay you $2 million. Tell me, will now understand? Tata is acquiring Zomato. So whatever amount the Tata pays to Zomato is the purchase consideration, is the cost of investment. Now understand, Ratan Tata is also paying $2 million to Dipender Goyal, the founder of Zomato. Now, tell me, will we add this $2 million to the cost of investment? Will we add this $2 million to the cost of investment? The answer is no. The answer is no. Why? Because this 2 million which Ratan Tata is paying to Dipender Goyal, the founder of Zomato, which Tata is paying to founder of Zomato, it is not for acquisition of shares. It is not for acquisition of shares. Rather, it is being paid to Dipender Goyal for continuing employment. Basically, Ratan Tata Dipender Goyal को रिक्वेस्ट करे कि भाई आप इस कंपनी में 2 साल और रुक जाओ, उसके लिए मेरे से आप $2 million ले लेना. So now, $2 million which Ratan Tata is paying to Dipender Goyal, it is not for the acquisition of shares of Zomato. Rather, it is for the continuing employment of Dipender Goyal, and that's the reason it will not be added to the cost of investments. Rather, you will recognize it as employee benefit expense in accordance with IAS 19. Employee benefits. Okay, so now that's what it says. If you are paying any amount to the employees of acquiring company and the payment, okay, I'm trying to speak in English itself. Might be thoda boda, somewhere in between I am speaking Hindi. I'll try to eliminate that as well. Don't worry. I'll try to eliminate that as well. Okay, now if the payment is for continuing employment, not a part of the cost of investment, now what you have to do, since you have paid the amount and you will receive the services in the future, so it's like a prepaid employee benefit expense. Okay, so prepaid employee benefit expense account debit to bank, recognized as employee benefit expense over the service period. Now, if the payment is done in the capacity of them being a shareholder. Now, if Ratan Tata would have paid this $2 million to Dipender Goyal on account of purchase of shares of Dipender Goyal. Understand, guys? Dipender Goyal is the founder of Zomato. Definitely, Dipender Goyal will have some shares of Zomato. Tell me yes or no. Definitely, Dipender Goyal will have some or the other some shares of Zomato. Right now, Ratan Tata is purchasing that shares from Dipender Goyal and paying to Dipender Goyal. So now this will be called as purchase consideration. This will be part of the cost of investments. This will be forming part of cost of investments. So for this, we'll pass entry investment account debit to bank. Replacement awards. Replacement awards. Okay. Now, in your BPP book, there is a question called Hammond Company, which deals with replacement awards. Which deals with replacement awards. I believe that's the question number 12 or 13. You can see. But yes, that's a wonderful question. That's a wonderful question, which I will recommend all of you to solve it once at least. Okay. I can tell you the name, exact question number and the name as well. Just if you can give me a minute, please, I can tell you the exact name and the number of the question. In my opinion, it is Humming's company. Yes. In my opinion, it's Humming's company, but still you guys can check. And I will also check and confirm you guys over the Telegram group. I will confirm the name of the question. Okay. In my opinion, it is Humming's company. But yes, there is a question. There is a question. Okay. Now, replacement award. Replacement award to employees of acquiring company. Okay, understand what is the meaning of replacement awards. Let's suppose again taking the same example of Tata and Zomato. Now Tata acquired Zomato. What happened? Zomato has already before this before Zomato got acquired, Zomato already issued some share-based payments to its employees. Now Tata acquired Zomato. Understand the sequence, guys. Okay, acquirer is Tata. Guys, I'm trying to make this session as detailed as possible. Please be in the class and watch this class with activeness. Be interactive. Please be active in the class. Okay, stay active, stay tuned. Okay, now, and acquiree is Zomato. And trust me, after this session, I can guarantee once you watch this session and FR session, your group accounts will be your key strength area. Okay, now, acquiree already issued some share-based payment awards. Acquiree already issued some share-based payment awards to its employees. Zomato already issued some share-based payment awards to its employees before it got acquired. Okay. Now, after that, what is happening? Tata acquired. Tata acquired Zomato. Now, when Tata acquired Zomato, now what Tata is saying to Zomato, that boss, what I'll do is I will give shares of my own company. I will give shares of my own company to your employees. You cancel your awards. That is called as a replacement award. This is called as a replacement award. Basically, acquirer company Tata cancels the share-based payment award. Listen to me carefully, guys. Tata cancels the share-based payment award issued by the Zomato. Tata cancels the share-based payment award issued by the Zomato and issues its own share-based payment award. And that is called replacement award. I am replacing the award. That's called as replacement awards. Now, what you need to understand? Please understand very carefully, guys, this point. Okay, a very easy point, but a very important point. Okay, now understand, guys. What happens when Tata company is giving its own replacement awards, its own share-based payment awards? What happens? Understand. When Zomato issued the share-based payment awards to its employees and told to its employees that I will give you these shares of this company, Zomato, I will give you shares of Zomato if you continue with the company for at least 4 years. Now understand, Employees worked in the company for, let's suppose, 2.5 years. Employees worked with Zomato for, let's suppose, 2.5 years. Tell me who received the services? Who received the services? Zomato. Zomato received the services. Now Tata comes into picture and Tata cancels the share-based payment award. Tata cancels the share-based payment and Tata says to Zomato that you are not required to give any shares. I will give shares. I will give shares. Now Tata is giving shares to the employees. Now what is happening? What is happening? Tata is settling the obligation of Zomato towards its employees, right? For 2.5 years of service, which Zomato already took from the employees before date of acquisition, prior to date of acquisition, was the obligation of Zomato. But this is being settled. By Tata. Right now it says that now since Tata is settling the obligation of Zomato, it's like I am paying on your behalf. Tata is paying to the employees of Zomato on the behalf of Zomato. Right? So standard says that add it to the purchase consideration, add it to the cost of investments, add this to the cost of investments. Okay, acquirer replaces the share-based payment award issued by the acquiree to its employees. Acquirer will issue new awards to the employees of acquiree for the services received by acquiree prior to acquisition. So what you have to do for the pre-combination part, standard says that you have to add it to the cost of investments. For the pre-acquisition part, the standard says that you have to add it to the cost of investment. But the question comes up here, how will you calculate the pre-combination award value? How will you find the pre-combination award value? So standard says that what the question will give you fair value of the original share-based payment awards. Original share-based payment means share-based payment award issued by Zomato. Replaced share-based payment award means share-based payment award issued by Tata. Okay, so fair value of original share-based payment award multiplied by expired period till date of action means what is the number of years of service which Zomato has received, divided by total vesting period. And the total vesting period, please be careful, total vesting period should be higher of original vesting period or the revised vesting period. Now what is the meaning of original vesting period? Vesting period of Zomato, vesting period given by Zomato. What is the meaning of revised vesting period? Expired period plus remaining period as per Tata. That's called the revised vesting period. Okay, now so this is the higher of this, you have to take as a total vesting period, and the entry for this will become investments account debit to SBP reserve, investments account debit to SBP reserve, or investments account debit to SBP liability reserve, or liability or provision for stock appreciation rights. Whatever is the case may be, you have to do it that way. Tell me, is that clear, everyone? What is vesting period? The period over which you have to satisfy the vesting condition. Okay, now what is the post combination? So what is the fair value of replacement award? Any value over and above the pre-combination portion is called as the post-combination award. Okay, now this you will account for as per IFRS 2, that is share-based payments. There is a standard on IFRS 2 share-based payments. You have to account it as per that. Okay. Vesting period we study generally in IFRS to share-based payments. If you don't know what is vesting period, then I will recommend you to watch my lecture on share-based payments. It is there, a revision lecture on share-based payments is there on my YouTube. Okay, you can go and watch it off. Now so let's do the summary of the. Now any acquisition related cost will be transferred to P&L. Any acquisition related cost will be transferred to P&L. It will not be forming part of the cost of the investments. Okay, now summary of the purchase consideration. If it is cash, investment on date of acquisition will be amount paid. Share exchange will be at fair value. Deferred consideration will be at present value. Contingent consideration will be at fair value. Now subsequently, no treatment for cash, no treatment for share exchange, but deferred consideration you have to unwind and record finance cost, and then you will pay on the scheduled date. Contingent consideration record fair value changes in P&L if it is financial liability, but if it is equity, you will not remeasure it off. Zigar, this session won't be helpful for FR. Okay, it is only and only for SBR. It is only and only for SBR. But yes, SBR students must watch the FR lecture. Now, the tax impact, the deferred tax impact of asset or liability. Now, understand what happens whenever. Tell me one thing. If you can recall it off. If you can recall, on date of acquisition, the net assets of subsidiary are acquired at what value? Carrying amount or fair value? On date of acquisition, parent company acquires the subsidiary's net assets at what value? Fair value or carrying amount? So the answer is fair value. Okay. Now, but we need to understand one topic. On in depth. So I'll take up that topic as well. But coming to the other adjustments, payment to the employees of acquiring company if paid in the capacity of shareholders, add to purchase consideration if paid for continuing employment. Do not add to the cost of investments. Okay. Replacement awards, add pre-combination portion to the purchase consideration. Reacquired rights, I will explain you right now. Acquisition cost has to be transferred to P&L. Now coming to reacquired rights. Now, what are reacquired rights? Okay. Now, in the mock which I was taking in the last week, so I was surprised to see that many students doesn't know what exactly is reacquired rights. So please understand, guys, reacquired rights is a very important topic of our syllabus, and the examiner can test it any given point of time. So don't leave these topics. Okay. Now, reacquired rights. What exactly is a reacquired right? Okay. Now, let's suppose all of us know the company called as Domino's, right? Definitely all of us know Domino's. Tell me, guys, come on, tell me. Domino's तो खाया ही होगा कभी ना कभी तो पिज्जा. बताओ. Come on. Why you guys are not active in the class? I want to see active students. In FR session, they fill the chat box. Okay. Now, so definitely all of us know Domino's, right? You know. Now, whenever we order pizza from Domino's, ever happen to see the invoice? Ever anyone happen to see the invoice of Domino's? Whenever we order pizza, no. Who cares for the invoice when Domino's pizza in front of us, right? Who cares for the invoice, right? We just throw it off like this. But if you get time, the next time, open the invoice and see, and you won't find the name of Domino's there. You will find the name of Jubilant Foodworks Limited. So Domino's operates in India under the brand name of Jubilant Foodworks Limited. Okay. Now, so what happens? Let's suppose. So what happened? Domino's has given the franchisee rights to Jubilant Foodworks Limited. Let's suppose for 8 years. Now, so Domino's has given the franchisee rights to Jubilant Foodworks Limited for 8 years at $8 million. Okay. Now, so Jubilant Foodworks Limited would have passed an entry, that is franchisee rights account debit, to bank $8 million. Okay. Now, this will be recorded as an intangible asset, which will be amortized over the next 8 years by Jubilant Foodworks Limited. Now, what happened going forward? In India, the Jubilant Foodworks is performing wonderfully. Okay, and Domino's noticed this. Now what happens? Domino's, when noticed that India is a very huge market for us, rather than giving franchisee to Jubilant Foodworks, Domino's now wants to acquire Jubilant Foodworks Limited. So Domino's now thinks, why to give franchisees to someone else? Let's operate as Domino's there. So now Domino's comes and discusses with Jubilant Foodworks and tells that we want to acquire you. Now let's suppose after 5 years, Domino's wants to acquire Jubilant Foodworks Limited. Now when Domino's acquires Jubilant Foodworks Limited, don't you think so in Jubilant Foodworks financial statements, there will be a franchisee rights whose carrying amount will be $3 million. So now I am acquiring a franchisee right which was issued by me. So I am reacquiring that franchisee rights. That is called as reacquired rights. That is called as reacquired rights. Now tell me, all of you are aware of this concept of reacquired rights. Tell me, is the concept clear? I have not discussed the treatment. I've just discussed the concept. Is the concept of reacquired rights clear? If you confirm me here, then I will discuss the treatment of the same. Come on, guys. Come on, come on, come on. Tell me. Is the concept of reacquired rights clear to all of you? Very good. Now comes the treatment. Now comes the treatment. What will be the treatment? So the treatment, basically reacquired rights will have the impact on the purchase consideration and will also have an impact on the net assets. So understand, the impact on net asset is very simple. Whenever you are reacquiring your, whenever you are reacquiring the reacquiring the rights, franchisee rights, so recognize that at fair value on date of acquisition. Whatever is the fair value, recognize it at that price. Now, what should be the adjustment to purchase consideration? What should be the adjustment for purchase consideration? For that, the standard is saying we will adjust an amount which is lower of the following, which is lower of the following, which is lower of the following. Now, what is the lower? So it says penalty to cancel the contract, or whatever is the fair value. Whatever is the fair value. See, understand, think from the point of view of Domino's. Think from the point of view of Domino's. Now when Domino's has to settle an obligation, definitely we, being a rational person, would like to pay less, would like to pay less. Now I will see, if I have to cancel the contract as per, if I have to cancel the contract as per the contractual terms and conditions, what is the penalty that I have to pay, or what is the fair value? Whichever is less, that I will pay, and that will be my settlement amount. That will be my settlement amount, and this amount you have to reduce from the purchase consideration. This amount you have to reduce from the purchase consideration. So this is the treatment. So understand, fair value of reacquired rights. I am writing the crux here. I am writing the crux here. Fair value of reacquired rights, you have to add to net assets on date of acquisition. Now, from the point of view of purchase consideration, reduce lower of penalty or fair value. So this is the treatment of reacquired rights. I believe it is very much clear to all of you. I believe it is very much clear to all of you. Tell me, guys, come on. Reacquired rights is clear to all of you. Done. Coming back to the notes. So I've discussed reacquired rights you have to reduce from purchase consideration. Now, tax impact. Tax impact. Come on, guys, tell me, is that clear, everyone, till here? Okay, wonderful. Now, tax impact. So understand, whenever we acquire the assets and liabilities of subsidiary, we acquire at its fair value. But in the tax books, is this fair value recognized? No. In the tax books, the asset continues to remain at its carrying amount. In the tax books, the asset continues to remain at its carrying amount, but in the accounts books, we recognize the assets of subsidiary at its fair value. So there arises a temporary difference. Now the standard says that if the fair value is greater than the carrying amount of net assets, then you have to create a deferred tax liability on the same. If the fair value is less, then you have to create a deferred tax asset on the same. Okay, so this is what you have to do from a tax perspective. Now, part 2, changes in the group structure. But before moving on to part 2, tell me, guys, is it clear to everyone till here? Can we move on to part 2? If anyone has any queries, you can discuss that with me, and then I'll move on to part 2. Okay, let us discuss part 2, changes in the group structure. For changes in the group structure, I will show you something. So this is what you have to take care of. Always you have to take care of. This one. Okay, changes in the group structure. Acquire or dispose. Acquire or dispose. Now, subsequently, you might acquire some investments. Subsequently, you might dispose of some investments. Now, what is the effect of the acquisition or disposal on the group accounts is what we have to study. Now, let's suppose when you acquire, there can be three possibilities. You have achieved the control. You have achieved the control. You have achieved significant influence. I believe you understand what is the meaning of control. Whenever the control is achieved, subsidiary relationship gets established. Whenever significant influence is achieved, associate relationship gets established. Whenever control is retained, nothing is happening. It was subsidiary before also, it is subsidiary now also. Okay, there is no change in the status. Okay, control is retained. It is retained as it is. Earlier also control, now also control is there. Now disposal is later on. Okay, fine. Understand? If control is achieved, now how? From investment to subsidiary. From investment, earlier you were having 10%, now you acquired 50% additional and you came at 60%, right? 10 plus 50 is equals to 60. Now earlier you were in normal investment, now you become a subsidiary. Earlier you were having 30% and you were an associate. Now you acquired 30% additional. And you came at 60%. This is called as 30 plus 30, 60. Associate to subsidiary. So in all this, control is getting established and we will apply step acquisition accounting. What is that we do in step acquisition accounting? We have already discussed at FR. Okay, we have already discussed FR, though I will give you the brief introduction about step action today also. But yes, now further, significant influence is achieved. Okay, now earlier you were a normal investment at 10%, you acquired further 20% and arrived at 30%. So 10 plus 20, 30, meaning thereby you were a normal investment covered under financial instruments chapter of IFRS 9. Now, when you acquired additional 20%, you became associates and covered in the scope of IAS 28, investment in associates and joint ventures. Control is retained. Now what is happening? Earlier you were having 60%. So you were a subsidiary. Now you acquired 20% additional and you arrived at 80%. Now also you are a subsidiary. So there is no change in the status. Earlier also subsidiary, now also subsidiary. That is called as control is retained. Okay. Now this is called as purchase or sale without change of control. Now, there are other two things also. Significant influence is lost or case of deemed disposals. We'll discuss. Let me come back to my notes. Step acquisitions. Now, though step acquisition I have covered in FR, but still I want to discuss step acquisition again with you guys. Okay. Now, what happens in step acquisition? Basically, understand. Earlier, I was having, let's suppose, 20%. Earlier, let's suppose I will take a blank piece of paper and explain something to you. Earlier I was having 20%, but now let's suppose I acquired 40% on this particular date. I acquired 40% and I become at 60% and the control is achieved. And this is the date of acquisition, meaning thereby this becomes my subsidiary on this date. Now on the date of this, since this company becomes my subsidiary on this particular date, I need to calculate goodwill. Tell me yes or no. Come on guys, tell me. I need to calculate goodwill. Tell me yes or no. Now to calculate goodwill, what I want, what will I need? I will need value of investments. I will need value of NCI. I will need value of net assets. So value of net assets will be given in the question. No challenges. Value of NCI, you can very well calculate. There is no challenge in that. There is no such challenge in that. Now challenge comes up in the value of investments. Now understand, you have invested in stages. 20%, 40%. 40% you have invested today. 40% you have invested today. NCI value is as on today. Net assets value is as on today. As on date of acquisition. Okay. Let's not write today. Let's write date of acquisition. Let's write date of acquisition. date of acquisition. But what happens? This 20% is as on this date. Now tell me, is it feasible? Is it logical? Is it feasible to compare the investments as of this date? Is it feasible or is it logical to compare investments as of this date versus the net assets as of this date? Tell me, versus the net assets of this date. Is it logical to compare the investments as of from here to the net assets as of here? Is it logical? No. So now what the standard says is you have to bring the investments to this particular date. So you have to bring it to fair value on date of acquisition. For the previously acquired interest, you have to bring it to the fair value on date of acquisition, and any gain or loss between this date, will be recognized in console P&L, or console OCI. Understand? If you are, I'm trying to say something, please listen to me very properly. Here, guys. Understand? Investment in equity instruments as per IFRS 9. Understand? Investment in equity instruments can be measured at fair value. It can be at fair value through P&L, fair value through OCI. It can be measured at cost. It can be measured at equity method. Equity method I will discuss towards the end. Not now. I'm not discussing it now. Okay. Now, you know these two, but now understand. Standard says that if you have recognized the investment in equity instruments at FVT OCI, okay, then this gain or loss will also go to OCI. If it is at FVT OCI, then this gain or loss will also go to OCI. If it was at FVT P&L, then this gain or loss will go to P&L. If it was at cost, then it will also go to P&L. I believe it is very much clear to all of you. Okay, so that's what is the treatment of step acquisition. Loss of control. Come on, guys, tell me, is step acquisition clear to all of you? When cost is allowed, hi Mayur. So for cost, that's an option available with the entity. You can either go with the fair value or as per the cost. Okay, you can either go as per the fair value or as per the cost. For investment in subsidiary, okay, let me deviate from the topic a little bit for Mayur. I will clear your query little bit in depth. So standard says that investment in equity instruments can be of two types: normal investment, okay, or investment in subsidiary, associate, or joint venture. Okay, now it says that normal investments can be measured at fair value only. It can be at P&L या other comprehensive income, either of these. Now if you follow other comprehensive income, if you know, it is an irrevocable option. At initial recognition. Okay, now if it is investment in subsidiary, associate, or joint venture, then again you definitely have an option for fair value either through P&L or OCI. Further, you have an option to measure it at cost. Okay, you have an option to cost, or you have an option to measure it at equity method. Now, so this is an option available with the entity. Okay, now entity can select any of these. But this option is available only at the time of initial recognition. Subsequently, you can't change. This option is available only at the time of initial recognition. Okay, this option is available only at the time of initial recognition. Now, Fair value through P&L, OCI, I believe you would have studied in detail in financial instruments. So I'm not discussing it much. Cost is fine. Equity method. When can we use equity method? So equity method we can use only for investment in associates. We can use only for investment in associate or joint ventures in SFS of parent. In SFS of parent, if parent does not prepare, if parent does not prepare consol FS, that is parent does not have any subsidiary, no subsidiary, plus has investment in associates or joint ventures. Okay, understand, I can use equity method only for investment in associate and joint venture, provided I am not preparing consol FS, I am not preparing consol FS, I am not preparing consol FS, and I don't have any subsidiaries. And in that case, equity method can be allowed for investment in associates and joint ventures. I believe it is clear to all of you. Mayur, does this clear your query? All this I am talking about SFS of parent. Now, coming further, loss of control. Loss of control. So understand, loss of control can be through full disposal or partial disposal. Now understand, tell me, when you acquire a subsidiary, what is the entry which you pass? We recognize the net assets of subsidiary, we recognize goodwill, we recognize NCI, we de-recognize investments, we de-recognize purchase consideration. Whatever is the difference is called as goodwill. We recognize net assets, we recognize NCI, we de-recognize investments. The difference is called as goodwill. Now you have to do the reverse here. On disposal, on loss of control. What is the meaning of loss of control? Earlier I was having 60%, but I sold off 30%. So now remaining investment is 30%. Or I sold off entire 60%. So control is lost. Now when the control is lost, basically what I will do, I will de-recognize net assets of subsidiary, I will de-recognize NCI of subsidiary, I will de-recognize goodwill of subsidiary, I will recognize sale proceeds, and any difference will be recognized in the consol P&L as gain or loss on loss of control. Loss of control. Is that clear, everyone? So journal entry which we will pass is bank account debit, sale proceeds which we have received, NCI de-recognize, NCI account debit, investments, if I have retained any investment, so investment retained at the fair value on date of disposal. Okay, now goodwill de-recognize to goodwill, net assets de-recognize to net assets, to gain or loss on loss of control. But understand, this gain or loss is the gain or loss on consol P&L. In the group P&L, this is the gain or loss in group P&L. Now many times I have seen students making a mistake here. Question is asking you, please calculate the gain or loss on disposal in the individual financial statements of parent. Will you calculate this? Tell me. In that case, will you calculate this? No, my dear friend. So please read the question carefully. I will show in the mistakes. See, read this part. Read question carefully. If gain or loss is asked in the SFS of parent or group FS. If question is silent, then calculate in group FS. 90% times student makes this mistake. The question is asking in individual FS and the students calculates in the group FS. Guys, please read the question carefully. If the question is asking you in the individual FS, it's very simple. Cost and the selling price compare. The difference is called as gain or loss. I will write that also. How to calculate in individual FS? Okay, here I don't have. Yeah, how to calculate? Let me write here. How to calculate gain or loss? How to calculate gain or loss on disposal of subsidiary in individual FS of parent, if it is full disposal or if it is part, okay, ठीक है, I'll not take it, give it this way. So it is sale proceeds plus if you have retained any investment, then what is the fair value of retained investment? What is the fair value of retained investment minus what is the carrying amount, or no, what is the cost of investments? What is the cost or carrying amount of investments? Okay, this is the gain or loss on disposal in SFS, separate financial statements of parent. Is that clear to all of you? Is that clear to all of you? Come on guys, tell me. Is that clear to all of you? Ta -ta -ta -ta. Further, deemed disposals. Now what are deemed disposals? Now many times what happens is let's suppose I have done an investment in another company. I have not disposed of the shares, I have not sold the shares, but my subsidiary company issued new shares. My subsidiary company issued new shares, on account of which my stake got liquidated. Okay, I'll tell you, I'll show you a scenario. Parent, subsidiary, this was having 100 shares, total 100 shares, and I obtained 60 shares. So I was having 60% holding. Right now what happened? Subsidiary issued further 50 shares. But this 50 shares was not acquired by me. So now what is my holding? 60 by 150. Can you tell me how much? 60 by 150 is how much? 40%. Now tell me, even if I have not disposed of the shares, my control gets lost. That's called as deemed disposals. I have not disposed, but it got disposed. Okay? Now, so what is the accounting treatment of deemed disposals? Similar to what is the loss of control. So you will de-recognize NCI, you will de-recognize goodwill, net assets. Okay, you will recognize the retained investment at its fair value, and the difference is called as gain or loss on date of disposal. Is that clear, everyone? I'm waiting for your response, guys. Come on. All of you, come on, guys. Show some energy. Okay. Purchase or sale of interest without change of control. So what is happening here? Understand. Basically, in this case, what happens is you are selling your interest from subsidiary to subsidiary. What exactly is the meaning of this? Understand. Purchase of shares. You were having so I'll write here this way, subsidiary to subsidiary only. Now you were having you were having 70% interest, you purchased 10%, you come at 80%. Now before purchasing 10 also, it was subsidiary. when there is a loss of control, it will affect goodwill. Definitely, definitely, Anista, right? If the control gets lost, you have to de-recognize goodwill. You have to de-recognize goodwill. Okay. Now, before acquiring this 10%, also it was subsidiary. After acquiring, also it is subsidiary. So now, is there any change in the status? No. So any control achieved? No. Any significant influence achieved? No. So what to do now? What to do now? So standard says that there is specifically no treatment. But now, since due to this acquisition, only one thing is changing. Nothing else is changing. Only one thing is changing. NCI is either increasing or NCI is either decreasing. So in this case, NCI decreases. Why? Because prior to this acquisition, NCI was 30%. But since I acquired this one, NCI gets reduced to 20%. Okay. So that's why it is called as reduction of NCI. Now here, I was having 90%. But I sold 20% and arrived at 70%. So 90% also I was subsidiary. After disposal of 20%, I came at 70%. Then also I'm a subsidiary, right? So now what happens? So when it was 90, NCI was 10. But when it was 70, NCI got increased to 30. So that's why it is called as increase of NCI. So now basically what you have to do is, you have to record the sale see, let's suppose you have purchased the shares, so to bank you have sold the shares, so bank account debit. Now NCI got reduced, so debit NCI proportionately, reduce NCI proportionately. Here NCI is increasing, so increase NCI proportionately. Now whatever is the difference will go to equity. Other equity, whatever is the difference will go to other equity. Whatever is the difference will go to other equity. Is that clear to all of you? Come on guys, tell me. Is that clear to everyone? Now, loss of significant influence. Now, basically, it means associate to either investment or associate to nil. Okay, associate to either investment. Loss of significant influence means loss of associate. So what will you do? You will debit investments retained, de-recognize investment in associate at its equity method. Whatever is the balance as per equity method, you will de-recognize. Now whatever is the gain or loss comes up, is you will recognize in the console P&L. Whatever the gain loss comes in, you will recognize in console P&L. That is called as loss of significant influence. Tell me, is that clear, everyone? If yes, then I will move on to foreign subsidiaries, which is again a very important area for SBR, guys. Very important area for SBR, which generally student tends to ignore, but we will discuss here with the help of an example. See, I've already drafted an example as well for foreign subsidiary. I will, using this example, I will explain the concept to you. Don't worry at all. We will discuss it in depth. Okay. But tell me, is that clear, everyone, till here? Okay. Coming to foreign subsidiaries. So understand, there is nothing difference in for accounting for foreign subsidiary or accounting for you can say home subsidiary, or you can say functional currency subsidiary. Okay, there is no difference. But understand, the difference comes only from the point of view of exchange difference. What should be the treatment of exchange difference? Now tell me. So approach remains the same. but the treatment of exchange difference is the challenge. So tell me, what do you want? You want me to discuss the theory and then go to the example, or discuss this concept of foreign subsidiary via example itself? Tell me, what do you want? Tell me, what do you want? Theory, then example, or direct example? Come on, guys, tell me. What do you want? Okay, Anisha is saying discuss via example. Okay, fine. So understand. Let us go to the example, and then first of all, I'll take the example. Once you get the grip over it, then I'll discuss the theory of it. Okay, good. Foreign subsidiary. So basically, what is happening? Understand this example. So it's a Dragon company acquired 90% of the tattoo company. Okay, Dragon company, understand the functional currency is dollars, but for tattoo company the functional currency is DN, means this is a foreign subsidiary, meaning thereby this is a foreign subsidiary. Okay, acquired 90% of it, okay, by paying a purchase consideration of DN 180 million, means the value of investment is given in foreign currency. Okay, retained earnings on the date of acquisition was 65 million DN, NCI was 14 million DN, NCI is at fair value. SOFP is P&L is given for DN and Dragon and Tattoo both. P&L is given. Goodwill is impaired by 10%. SOFP is given for both Dragon and Tattoo. Exchange rate is given 31st December 20x0 and 31st December 20x1. Average rate is also given. The question is asking you to prepare console P&L and console SOFP. So understand, this example will not only help you in understanding the foreign subsidiary concept, but also from end to end, whether it be console P&L, console SOFP, working notes, everything we'll discuss in this example. From the point of view of foreign subsidiary, we'll discuss each and everything in this example. Okay, now tell me, first of all, what do we do whenever we prepare console? We have to prepare console FS. What exactly we start with? Tell me, how do we start? With investments, right? Now tell me, what is the value of investments? DN 180 million. But this is in foreign currency. So will Dragon company account for this in foreign currency? No, it will have to it has to be converted into functional currency. Now what is the exchange rate on functional currency? So the question is giving you the converted amount, 60 million. 60. So what we will do, entry will be investment account debit to $60 million. Investment account debit to bank, $60 million. Now CFS of group. So what we will do? Now tell me, what is the date? What is the date of console SOFP? 31st December 20x1. And what is the date of acquisition? 31st December 20x0. Question is asking you console FS on date of acquisition or reporting date. Tell me. See these two statements and tell me. I have highlighted these two dates. Tell me, the question is asking you console FS on date of acquisition or reporting date. Date of acquisition or reporting date. It is a reporting date. It is a reporting date, not on date of acquisition, because the date of acquisition is 31st December 20x0, but the question is asking on 31st December 20x1. Okay, it is a reporting date. Now what will happen? So we have to, whenever it is a reporting date, so we have to allocate the net assets of subsidiary. So we'll prepare allocation of net assets. Now how will you prepare allocation of net assets? So first of all, prepare allocation of net assets in foreign currency, then convert it to, so understand, how will you prepare allocation of net assets? So first of all, prepare allocation of net assets in foreign currency, then convert it to functional currency, and then you will get an exchange difference, So understand. So what is the, first of all, prepare in foreign currency. So for tattoo, the reporting date is 5 and 215 for equity. 5 and 215. What is on date of acquisition? So assuming equity capital will remain the 5 and retained earning is given as 65. Retained earning is given as 65 on date of acquisition. Retained earning is given as 65. So I will write here 65 on date of acquisition. Okay, I'll go little slow here, understand everything. So basically this was given in the question. This was given in the question. Okay, now this we have calculated, this we have found as balancing figure. This we have found as balancing figure. Okay, is it clear everyone till here? Now, so what is the balance? 5 plus 65, 70, 150 and 220. So this is in foreign currency. See, this is in foreign currency, DN. Now we have to convert it to functional currency. So date of acquisition exchange rate is 3. How come? So question is giving you date of acquisition exchange rate is 3. So question is giving you, so I will take 3. By 3 I will do. Now, what is the post? So I will take average rate. What is the average rate? 2.6. Post will convert using average rate 2.6. Okay, now closing, we will reporting date will convert using closing date exchange rate. So it is 2, which is 2. So I'll take 2. So I will convert. So this is the functional, this is the value of net assets as per the functional currency. But now understand, ideally net assets on date of acquisition, listen to me carefully, ideally net assets on date of acquisition plus net assets on reporting date should be equals to net assets on reporting date. Net assets on date of acquisition plus net assets during post acquisition should be equals to net assets on reporting date. But tell me, just check, is it happening? Just check, is it happening? So 23.33 plus 57.7 is 81.03, but on reporting it is 110. So what is the difference for? The difference is 110 is minus is 28.97. It is on account of exchange gain. It is on account of exchange gain. This exchange gain will be transferred. This exchange gain will be transferred where? Tell me. This exchange gain will be transferred where? Okay, this exchange gain will be transferred where? So standard says that this exchange gain will be transferred to NCI. For the NCI portion, for the parent portion, it will be transferred to FCTR, foreign currency translation reserve, which is recognized in other comprehensive income. Which is recognized in other comprehensive income. Which is recognized in other comprehensive income. So in P and L OCI, you will recognize in other comprehensive income, but in SOFP, this is how you will show. Is that clear, everyone? In P&L OCI, entire amount of 28.97 will be recognized in OCI, but in SOFP, you will transfer a portion to NCI and parents portion to FCTR, foreign currency translation reserve. Now coming to goodwill, again same thing for goodwill. First of all, calculate goodwill in foreign currency. First of all, calculate goodwill in foreign currency, then convert it to functional currency, Okay. Now, so what was the value of investments in foreign currency? 180. See here, 180 is the amount. 180 is the amount. Sorry. 180 is the amount. 180 is the amount of investments in foreign currency. So 180. Now NCI is given. Fair value of NCI is given in the question. 14 million. Okay, net asset 70, we have calculated here 70 on date of acquisition 70. Since it is in foreign currency, we are calculating in foreign currency first of all. So goodwill comes to 124. Now the question clearly mentions that you have to impair the goodwill by 10%. So let's impair the goodwill by 10%. So it comes to 12.4. So the goodwill comes to 111.6, but this is in foreign currency. Now we have to convert in functional currency. So how will you convert? So goodwill 124 was on date of acquisition. What is the exchange rate on date of acquisition? 3. So we will convert using that. Impairment using average rate. Closing using closing rate. So now we will convert. So ideally, goodwill on date of acquisition minus impairment loss should be equals to closing goodwill, right? But is that happening here? Just check. 41.33 minus 4.77 is equals to 36.56, but my goodwill is 55.8. So difference of 19.24 is on account of exchange gain. And where will this exchange gain be recognized? Again, in P&L OCI, in SOFP, you will transfer it to in P&L OCI, in P&L you will in P&L and OCI, in statement of P&L and OCI, you will record in OCI. But in SOFP, you will record it at non-controlling interest and FCTR. But if only if the NCI is at fair value. Understand? Goodwill impairment, same formula. If goodwill impairment loss is there and NCI is at fair value, then parent and NCI. If NCI is at proportionate share method, then only parent. Similarly, if NCI is at proportionate share method, the entire amount of 19.24 will be recognized only in FCTR. Is that clear, everyone? Is that clear, everyone? So here the adjustment gets over. Now you can prepare the question normally. Okay. Now NCI on date of acquisition is 14.4.67. How come? 14 divided by 3. Okay. Now post acquisition is 5.77. How come 5.77? 57.7 cut 10%. Impairment, you can use average rate or closing rate, either of these. Okay. In questions, somewhere they have used average rate, somewhere they have used closing rate. Both rate is correct. Both is correct. Okay. Now, so it is 5.77 ka 10%. Exchange gain of 28.97 ka 10%. Okay. 19.24 ka 10%. Goodwill impairment is how much? How much is goodwill impairment? Tell me. 4.77 ka 10%. 4.77 ka 10%. So this is the value of NCI. Now you have the value of NCI. Console P&L and FCTR. So how much? 28.97 ka 90%. 19.24 ka 90%. Console P&L for Dragon, how much? What is the console RE for the Dragon? For Dragon it is 290. Dragon it is 290, so I will take 290 for the parent fully. Now 57.7 ka 90% it is. Goodwill impairment 4.77 ka 90%. Exchange gain will come up here. So this is the value of console RE. This is the value of console RE. Console RE and FCTR. Now prepare the console P&L and console SOFP as it is very normally. Okay. So now revenue for the parent, revenue for subsidiary divided by converted to functional currency using average rate. Since P&L items we will convert using average rate. Balance sheet items, SOFP items will convert using closing rate. Okay. Cost of sales again converted. So this is the profit. In OCI we will record exchange gain of 28.97 and 19.24. Now in SOFP again we'll convert using closing rates. PPE investments will become nil. Goodwill we will calculate using we have already calculated goodwill, right? 55.8 is the goodwill. We have already calculated it here. Okay. Now current assets again using closing rate. Equity will be the same for the parent. Retained earnings we have calculated. FCTR we have calculated. NCI we have calculated. Liability again using the closing rate. So this is what is the console SOFP and the console P&L. This is what is the console SOFP and the console P&L for the foreign subsidiary. Is that clear, everyone? Is that clear, everyone? Tell me, guys. Come on. Is that clear to everyone? Come on, guys. Please tell me. Is foreign subsidiary clear to all of you? So basically what you have, what we did here, do you want me to write the steps? Do you want me to write the steps for foreign subsidiary? Do you want me to write the steps for foreign subsidiary? So I'll write here. So basically what are the 4 things which you need to take care of for a foreign subsidiary? What are the 4 things which you need to take care of? First of all, prepare allocation of net assets in forex. Okay. Then convert to functional currency. Okay. Then here you will get exchange gain or exchange loss. Now this exchange gain or exchange loss, the treatment of it in statement of P&L or OCI, record this in OCI, but in SOFP you will record a portion, parent portion in FCTR, foreign currency translation reserve, and NCI portion you will adjust from NCI. If it is gain, you will add to NCI. If it is loss, you will reduce from NCI. Now similarly, calculate goodwill in foreign currency, okay, and then convert to functional currency, and then convert to functional currency whatever is the exchange gain or loss, whatever is the exchange gain or loss, whatever is the exchange gain or loss. Okay, now you have to be careful. I have written here the exchange gain or loss statement. Exchange gain or loss for goodwill, OCI, in the P&L statement of P&L and OCI, you have to record that in OCI complete amount. But if the NCI is at fair value method, if NCI is at fair value method, then you will record this exchange difference in NCI and FCTR in the ratio of holding. If it is at proportionate share method, then the entire amount of exchange gain will go to FCTR. Is that clear to everyone? Now tell me. I have written the entire amount in your notes as well for your better clarity. All assets and liabilities will be converted using closing rate, income expense using date of transaction, or if not available, then average rate. Share capital using date of acquisition, reserves on date of acquisition, reserve this average rate. Okay, post acquisition average rate. Any difference is foreign currency translation reserve, which will be recorded in OCI. It can be reclassified to PL at the time of disposal of foreign operation. When you are disposing, for FCTR means foreign currency translation reserve. Foreign currency translation reserve. Foreign currency translation reserve. Exchange gain or loss is not recognized in P&L for foreign subsidiaries. Normal exchange gain or loss is recognized. Foreign exchange gain or loss normal on any transaction, day-to-day transaction that we do is recognized in P&L. But for exchange gain or loss on foreign subsidiary will be recognized in foreign currency translation reserve, FCTR. Foreign currency translation reserve. In your books, you might see it as translation reserve just, but it is foreign currency translation reserve. Okay, now this foreign currency translation reserve will be transferred to P&L at the time of disposal of subsidiary. Now similarly, I have discussed about goodwill, I have discussed about allocation of net assets, same thing. Okay, now on disposal, if you have a loss of control, transfer to P&L. If no loss of control, then transfer a portion of FCTR to NCI. Is that clear, everyone? Is foreign subsidiary clear to everyone? Come on, guys, you have to give me a go ahead. Guys, time and again, I'm reminding you, please do not forget to watch the group accounting video for the FR. Okay, I am just covering the additional part of SBR. I am not covering what is already covered in FR, because it will just be duplication, and I don't want to duplicate it. Rather, I want to focus on SBR with effectiveness, right? If I would have covered FR and SBR both in this one, right, so I would not be able to explain everything with a proper example. So that's the reason FR part I have explained in detail in FR with examples, everything in detail. Okay, you can watch from there. SBR part I'm explaining in detail here, and tomorrow we will practice one question. Complete revision done. Now joint arrangement. What is joint arrangements? So basically, joint arrangement means when there is a joint control, we say it is a joint arrangement. Two or more parties have joint control. What is the meaning of joint control? Parties having understanding have control. There is a unanimous control. There is a unanimous consent. But understand, the only one thing which you need to understand about joint control is, let's A, B and C, all three parties together, they control Reliance. Then it is called as joint control. But let's suppose A individually has 50%, 52% holding, and has signed agreement with A, B and C. A, B, C together has signed an agreement to control Reliance, but individually A can control Reliance. Is this a joint control? No. In joint control, there is no individual control. Understand? Though A has 15%, B has 10%, C has 55%, entered into an arrangement to jointly control D. Is this a joint arrangement? Though there is an arrangement between A, B and C, but since A has standalone control, hence joint control does not exist, and this is not a joint arrangement. No individual party should have the control. Okay, now joint arrangement are of two types: joint operation and joint venture. Joint operation and joint venture. Now, how to understand whether it is a joint operation or a joint venture? How to understand whether it is joint operation or a joint venture? So standard says that first of all, assess, is the joint arrangement structured? If the joint arrangement is structured, if the answer is no, joint arrangement is not structured, it is a case of joint operation. Then, okay, if the answer is yes, joint arrangement is structured, then standard asks you to say, do you have the right to specific assets and liabilities, or you have the right to net assets? Now, what is the difference between these two? What is the difference between these two? Now, I have a right to receive 20% of assets, 80% of the liabilities, 50% of the income, 40% of the expenses. This is called as right to specific assets and liabilities. If that's the case, it is a joint operation. But if they right to net assets, I have 40% ownership over any entity, it's a joint venture. It's a joint venture. So this is how you will identify whether it is joint operation or a joint venture. Now, if it is a joint operation, the accounting treatment is covered under IFRS 11. If it is joint venture, accounting is covered under by IS 28, exactly same as associates. And accounting treatment of associates I have discussed in my FR ka video. Okay, so I'm not discussing it again because it is ditto same. Even the standard IS 28 is same. The name of IS 28 is investment in associates and joint ventures. Okay, so they don't make any distinction between associates and joint ventures. It's the same. What is the accounting treatment for joint operation? So standard says that for joint operation, we don't prepare consol FS separately. What we do is we add our share of assets, we add our share of liabilities, we add our share of income, we add our share of expenses. Okay, so we take our share, we just take our share. Is that clear, everyone? Now, coming to theory, but before theory, I have to discuss one more concept of group cash flows, console cash flows. But before that, please give me a go ahead if it is clear to everyone. Please give me a go ahead, guys. Is it clear to everyone till here? Okay, wonderful. Console cash flows. Now, cash flows can come from the perspective of subsidiary, associates or joint ventures or joint operations. Now, understand, if it is subsidiary, we have to do line by line consolidation like we used to do in group SOFP or group P&L. Line by line consolidation we have to do. Okay, and we have to eliminate the contra. Assume, that's what I said, in joint operation there is no console books. Okay, every party records their share in their standalone FS. Every party records their share of income in the standalone or individual FS. There is no specific console FS for a joint operation. Okay, there is no separate console FS for a joint operation. Yes, Anishta. Okay, now, so group cash flows. Now coming to group cash flows. Okay, subsidiary, we have to do line by line consolidation. Just add, line by line. Okay, now eliminate contra. Okay, now associate or joint ventures. Okay, now tell me, in P&L for associate joint venture, what do we record in P&L? Tell me, what do we record in P&L from the perspective of associates or joint ventures? What do we record in P&L? The share of profit, right? The share of profit. But is that share of profit a cash flow item? Is that share of profit a cash flow item? Is that share of profit a cash flow item? No, that's not a cash flow item. right? So its standard says that since in the profit, this share of profit is already added, so we will reduce share of profit from operating activity, and then we will add the dividend which we receive from associates in the investing activity, because the dividend which we receive from the from the associates is a cash flow item, okay? For joint operation there is no console FS. But now I believe you can prepare console FS, but from an exam perspective, the examining team might check your knowledge from the perspective of these 7 adjustments. So I'm not helping you to prepare the entire group cash flows, but yes, I have identified, or the even your study text or even your materials have identified few important adjustments. So now today we will be discussing these important adjustments with you. Okay, we will discuss these important adjustments with you. Now, acquisition or disposal of a subsidiary. Now, you will ask me, sir, definitely you will discuss the theory, but how will we practice group cash flow statements? So for that, let me show you this video on groups. Let me play and show it to you. See, I have discussed the group cash flow. I'll show it to you. See. Can you see I am preparing group cash flow? See, cash flow from operating activities, right? I am preparing cash flows, right? I am preparing cash flows. So I will recommend all of you to watch this video. I have already conducted this session in the last March 24 attempt. So please watch this one. You will find this in the live section of my channel. Okay, so you can go and watch this, and you will get a grip over the console cash flow question preparation also. So you will get the practice of the questions as well. I will discuss theoretically what are the adjustments and how you need to deal with the adjustments. Okay, is that clear, everyone? Come on, guys, show me a thumbs up. Come on, show some energy. Show some energy, guys. Come on. Exams are just 10 days away and you guys are so inactive. Okay. Adjustments. So we have to discuss these 7 adjustments. We'll discuss one by one. Acquisition or disposal of subsidiary. Now tell me one thing. Forget the concept. Let us discuss logically. Okay. So this is my wallet. Okay, this is my wallet. Okay. Now you know what? I purchased this wallet from someone. I purchased this wallet at a price of $10. I purchased this dollar at a price of $10. Now you know what? When I opened this wallet, I found $2 inside. Tell me, what is the cost? What is the cash outflow on the purchase of this the wallet? What is the cash outflow on the purchase of this wallet? Tell me. I purchased it for $10, but when I opened the wallet, I found $2 inside. What is the cash outflow on the purchase of the wallet? Come on, guys, tell me. 8. So now that's the answer here. So what is the cash outflow on acquisition subsidiary? Cash paid to acquired subsidiary, that is 10. What is the cash balance in the subsidiary? 2. So it is 8. It is 8. Are you understanding this? Tell me. Now, similarly, cash received on disposal. Now, you know what? I sold this wallet for 10. But in my wallet, there was $3 already available. So what is the net price that I have received? 7. Similarly here, cash received 10. Cash balance in the wallet 3. So what is the net cash that I have received? 7. Is that clear, everyone? Generally, I have seen students making a mistake that says, sir, to acquire subsidiary, I have paid 10. So 10 is my outflow. To dispose of subsidiary, I have received 10. So 10 is my cash inflow. No, my dear friend, you need to adjust this 2. You need to adjust this 3. And this 8 and 7 is your answer. I believe it is clear to all of you now. And you won't mistake. Always remember this wallet example. Okay, now acquisition of assets and liabilities of subsidiary. Acquisition of assets and liabilities of subsidiary. Now tell me, when you acquire subsidiary, the assets of subsidiary are your assets. But now tell me, to acquire those assets or liabilities, have you paid any cash? Have you paid any cash? To acquire the assets or liabilities of subsidiary, have you paid any cash specifically? Now you say, sir, we have paid cash to acquire subsidiary now. So that you've already considered here now. That you've already considered. But now specifically for acquisition of assets, have you paid any cash? No, we have not paid any other cash. Apart from this 8, we have not paid any other cash, right? So this is not a cash. This is not a cash flow item. This is not a cash flow item. This is not a cash flow item. Okay. Now, similarly, if I'm disposing of the subsidiary, right? Now, I'm disposing of the assets and liabilities of subsidiary also. So, is it a cash flow item? No, it is not a cash flow item. It is not a cash flow item. Now, impairment loss on goodwill. Tell me, what do? We reduce it from the profit in console P&L. We reduce it from the profit, impairment loss on goodwill. But is impairment loss a cash flow item? Tell me. Is impairment loss a cash flow item? Tell me. Is impairment loss a cash flow item? Tell me. No, it is not a cash flow item, right? So what we have to do, since it is not a cash flow item and it is already adjusted in the profits, hence we have to add back to the operating activity. We have to add it back to the operating activity. Tell me, is it clear, everyone? Tell me, guys, come on. Tell me, is it clear, everyone? Now, dividend paid to NCI. Dividend paid to NCI. Now, how will you find dividend paid to NCI? So, NCI balance, opening balance, NCI closing balance. Okay. Now, NCI will get increased by post acquisition share of profit of the subsidiary. Post acquisition profit of subsidiary. NCI will increase by that. Right. Now, NCI will decrease or increase. NCI will decrease or increase due to purchase or sale of shares without change of control. Right now we discussed purchase or sale of shares when control is retained. NCI increases or decreases there. Tell me yes or no. NCI increases or decreases there. Tell me yes or no. Now, so a portion of that is a bank transaction. A portion of that is a banking transaction. So it's a cash flow item. A portion of it is a cash flow item. A portion of it is a cash flow item. Okay. Now, portion of it is equity. So be very careful. Be very careful that you are taking only the sale proceeds or the purchase price in the cash flow, not others goes to equity. So then all non-cash flow items are in operating activities in the cash flow, right? Anishta, understand. I'll come to your query, but let me complete this part and then definitely I'll come to your query, Anishta. Okay, I'll come to your query and explain that part as well. Now, if you dispose of a subsidiary, NCI gets reduced. If you dispose of a subsidiary, your NCI reduces. But is that giving you any cash flow? No. Disposal of subsidiary gives me a cash flow which I have already recognized. 7. Which I've already recognized. Further, NCI disposal, I'm not recording any. There is no other cash flow. For acquisition of subsidiary, also NCI gets increased. Now, whatever is the balancing figure is your dividend. Paid to NCI, dividend paid to NCI, which is a cash flow item, which you have to record in financing activity. But understand, additionally, you have to write goodwill impairment also. If NCI is at fair value. Additionally, you have to write goodwill impairment also. If NCI is at fair value, it will reduce NCI. The balancing figure is dividend paid to NCI. The entry will be to bank. Okay, the balancing figure. So it will come under financing activity. Is that clear, everyone? Tell me. Now, coming to the last these three: acquisition or disposal of associate joint ventures, share of profit of associate or joint ventures, dividend received from joint ventures. Now, tell me, you already know share of profit. What will you do? You will reduce from operating activity. Dividend, what you will do? You will add to investing activity, right? Acquisition or disposal of associate or joint venture is an investing activity. So if you are acquiring associate, you will have to reduce investing activity. If you are disposing of an associate, you have to increase investing activity, because disposal means cash inflow, acquisition means cash outflow. So that's what I've written here. See, that's what. Okay. Share of profit of associate reduced from operating activity. Okay. Disposal of subsidiary, cash inflow right in investing activity. Dividend add to investing activity. Okay. Now acquisition, cash outflow, investing activity. That's what you have to do in investment in associates and joint ventures. So I will recommend use this approach for cash flow, and definitely you won't face struggle in cash flow. Definitely you won't struggle in cash flow. Okay, definitely you won't struggle in cash flow using this approach. So I will recommend you to watch pre-mock March June 2024, not 23. March 2024 video, question number 1 video detailed on the group cash flow. I've already shown you the video. Now coming to your query, Anishta, understand Anishta. So from where do we start operating activity? Tell me, Anishta, from where do we start operating activity in cash flow? From where do we start operating activity in a cash flow? Tell me. So we start from profit before tax. So in profit before tax, all the operating expense, non-operating expense, cash flow expense, non-cash expense, everything is adjusted. Tell me. All the income and expense, whether cash or non-cash, whether operating or non-operating, everything is adjusted there. Tell me yes or no. Tell me yes or no. I will show you something. Just give me a minute. Just see this one. So this is what net cash flow from operating activity means profit before tax plus minus non-operating activity plus minus non-cash flow. Okay, plus or minus non-cash flow you have to do. Okay, so basically what you have to do is you have to start from profit before tax plus all non-operating expense minus all non-operating income plus all non-cash expense minus all non-cash incomes. You have to minus. Example can be depreciation. Example can be finance costs. Example can be finance income. Okay, example can be non-cash income, can be revenue not realized. Okay, which gets adjusted through working capital changes, which ideally this one gets adjusted through working capital changes. Okay, is that clear, everyone? Anishta, I believe that clears your query. Okay, further now, so we have studied group cash flow, we have studied reacquired rights, we have studied changes in group structure, we have studied group foreign subsidiary. Now coming to last part, that is theory. Now what is the meaning of business combination? Whenever any acquirer acquires control over the subsidiary, control over the business of the acquiring company, that is called as business combination. So two things are important: control and business. The meaning of control I have explained in detail in my FR. The meaning of control I have explained in detail in FR, but I will explain the meaning of business now. So it says for a business to exist, there should be three things. There should exist three things: a input, a process, and an output. The process, when applied to inputs, generate output. Now in my class, this mic is an input. This mic is an input. This laptop is an input. This camera is an input. The equipment which I am using is an input. The process is a discipline, a process which I am conducting regular classes for FR and SBR on each batch basis in English and Hindi both, right? So this is a process. Right? Now the outcome is the fees which I generate. It is the outcome. Okay, so basically it says that a business means it needs to have an input, it needs to have a process, it needs to have an output. Now the standard also goes on to state that even if a company has a input and a process but does not have output, can be a business provided I have the process, has the ability to generate output. Okay, so understand, in India, there are a lot of startups, right? In India, there are a lot of startups. The startups are not generating revenue. Okay. You would have watched Shark Tank. In Shark Tank, there are multiple investors who comes and they say that we are not earning anything as of now. We are in the idea stage. So is it the case that they are not business? They are business. Why? Because their process is so strong that even though they are not generating any revenue now, but they have the capability to generate the revenue in the future. Then also there is a business. Okay. So business should have input, process and output. If output is not there, then we have to see whether the process is such strong that it has the capability to generate outputs. Okay, that what is called as a business. Now control, I have discussed in FR, so you can watch it from there. Asset acquisition is not there in your syllabus, you can ignore it off. Okay, uniform accounting process I have discussed in FR. Different reporting dates I have discussed in FR. Exemption from console FS I have discussed in FR. Okay, investment entities. What are investment entities? So investment entities are the entities which have more than one investment, more than one investor. Okay, investors are not related parties, and entity has ownership interest in the form of entities, equity or similar interest. Basically, they are like mutual funds. So understand. Investment entities, they take investment from multiple investors. Okay, and they invest in multiple companies. Now what is the intent of mutual investment entities? What is the intent of investment entity? Do investment entities want to get the control over the companies? They want to get the control over these companies? No. They don't want control. They just want benefits. They don't want control. They don't want control from their investments. See, let's suppose Tata acquired Zomato. Why? Tata is interested in the business of Zomato. Okay. Now, when investment entity like mutual funds invest in some company, is the intent of mutual fund to control that company? No. The only intent of mutual fund is to grow the portfolio, to earn from the fair value changes, to grow with the growth of the company. They don't want to participate in decision making. So that type of company is called as investment entity, and the investment entity are, you can say, exempted from preparing console FS. Investment entities are exempted from preparing console FS. Do not consolidate its subsidiaries or apply IFRS 3 business combination. No, rather you have to record it fair value through P&L, because your intent is to earn from the fair value changes. Hence you record it through fair value through P&L. That's what is called investment entities, and why they are exempt from the consolidation. I believe that is clear to everyone. So we have revised the group accounts completely. We discussed foreign subsidiary, we discussed change in group structure, we discussed group cash flows, we discussed mistakes. Now mistakes file I'll send you. Okay. These are the mistakes which I have identified, and I'll send this mistakes file to all of you, which you can refer and learn from this one. Additionally, I will also make a video on these mistakes. Not now, might be after 2-3 days I will make a video, so you can watch that video from there also and learn from that. But as of now, you can just see from this file and learn. Okay. But yes, I will be coming up with a video on the mistakes. So this is it from the group perspective. This is it from the group accounting perspective. Tomorrow we have a discussion on the pre-mock June 2024 paper. Tomorrow we have a discussion on pre-mock June 2024 paper. Definitely I'll share all the PDFs by today end of day. Okay, that's all for the day, guys. Thank you. I hope you enjoyed the session. And yes, once the session ends, please do not forget to give your feedback in the comment box. Okay. And if you're new to this channel, like the video and subscribe the channel. That's all for the day, guys. Thank you. Bye-bye. But do not forget to give a feedback in the comment box. Okay, bye-bye. Now let us revise IFRS 15 revenue from contract with customers. Now understand first of all what exactly is the meaning of the term revenue. In the past, examiner has tested your knowledge, and students generally are confused what exactly is the difference between revenue and income. So you need to understand revenue means income which is earned in the ordinary course of activities, ordinary course of business. Okay. Now income is a broader term, revenue is a slightly narrower term. Income covers all the gross receipts, but
revenue covers income from the ordinary course of activities. To give an example, let's suppose it is my business to sell laptop. So whatever income that I get from the sale of laptop is my revenue. But let's suppose I sold one furniture that I had. Okay, now the gain that I get on the sale of furniture, is that my revenue? No, it is not my revenue. And examiner has tested your knowledge in the past exams on this part. Okay, so there was a question in the past exam that an entity sold an intangible asset, okay, and received this much money. Can the entity recognize that amount as a revenue? The answer is no, because if you sell a non-current asset, you have to record the net gain. You have to record a net gain. Okay, the receipts minus the carrying amount, net you have to record as a gain. But in the case of revenue, you record the gross amount as revenue and the cost of sales, then comes the profitability. Okay, so this is the difference, and I believe you are understanding this point. Now, what is the core principle of IFRS 15? The core principle of IFRS 15, the core principle of IFRS 15 says that what amount you have received doesn't matter. What is the amount that you are entitled to receive for the transferred goods or services? Whatever goods or services you have transferred, for that, what is your entitlement to receive? Okay, what is that amount you are supposed to receive? Whether you have received it or not doesn't matter. What is your entitlement for receiving the money for the transferred goods or services? That is called as your revenue. Now comes 5-step model. Now in the 5-step model, what happens here? Understand. So step number 1, assume the contract exists. In step number 1, we have to understand that contract exists. Now, what is the meaning of contract exists? So standard is saying the contract must be a valid contract. The contract must be a valid contract. Step number 2, identify performance obligation. What exactly is the obligation of the entity towards its customer? Towards its customer, what is the promise made by the entity towards its customer? Okay, let's suppose if we talk about between us, so it is my obligation to deliver you the SBR classes. Okay, so it is my performance obligation. Now the third step is transaction price. Determine transaction price. What is the meaning of transaction price? For the entire contract, what is the amount that I am supposed to receive from the customer? The overall amount for the entire contract, what is the amount that I am supposed to receive is your transaction price. Step 4, let's suppose in a contract there are multiple performance obligations. To take an example, let's suppose the contract has a performance obligation of sale of SBR classes and also SBR capsule. So there are two performance obligations, the classes and the capsule, for which let's suppose I receive a lump sum amount. Now what I have to do, this lump sum amount is your transaction price. These two are the performance obligation. Now in step number 4, what I have to do is, this lump sum amount, which is called as transaction price, I have to allocate between performance obligation number 1 and performance obligation number 2. Now, how will I allocate? The standard says that we need to allocate in the ratio of standalone selling price of each performance obligation. Okay, so in the ratio of standalone selling price of the performance obligation, I will allocate this transaction price to this performance obligation. Now, in the 5th step, the standard says recognize revenue as and when the performance obligation gets satisfied. So as and when the performance obligation gets satisfied, you recognize revenue for the same. Let's suppose I give you the SBR capsule right away, so I can recognize revenue for the same. But SBR classes will continue for a period of 3 months, so I will recognize revenue for the period of 3 months. Okay, so as and when the performance obligation gets satisfied, I can recognize the revenue for the same. Now, an example. So it says X Limited enter into a contract with a customer for sale of software and 3-year technical support. So assuming contract exists. Now the first performance obligation is sale of software. Is a performance obligation number 1, and 3-year technical support service is performance obligation number 2. At a price of $30,000 is a transaction price, because this is the overall amount which I receive from the customer. Further, software and 3-year technical support services are sold separately for $20,000 and $15,000 respectively. So this is the standalone selling price of software, and this is the standalone selling price of technical support services. Now, how will you recognize revenue in this case? So first step is identify or assume that the contract exists.
Step number 2, determine performance obligation. So we have already determined the performance obligation number 1 is sale of software. Performance obligation number 2 is 3-year technical support services. Now step number 3 is determine transaction price. So what is the transaction price? 30,000. Now step number 4 is allocate this 30,000 to sale of software and 3-year technical support services. Now understand here. So how will I allocate? In the ratio of standalone selling price. So what is the standalone selling price? 20,000 and 15,000. So let us allocate that. Sale of software and technical support services. So transaction price is 30,000. I have to allocate in the ratio of 20,000 is to 15,000. Okay, so how will I do? 30,000 multiplied by 20,000 divided by 20 plus 15 is 35,000. So the allocation to sale of software is 17143 and allocation to technical support service is 12857. Now tell me, software I have sold upfrontly. I have given the control of the software to the customer upfrontly. So I will recognize the revenue also on the date of sale. But technical support services I will provide over a period of 3 years. So I have to recognize this 12857 as a revenue over a period of 3 years. That is 4286, 4286, 4286. I believe it is clear. You are understanding the 5-step overall basis. Now what we'll do is we'll go into each of the steps and understand that in depth. Okay, so let us discuss that now. Now let us study step number 1, that is identify contract. So now the contract has to be a valid contract. What exactly is the meaning of a valid contract? So understand, a contract is a valid contract if it satisfies all these 5 conditions. If it satisfies all these 5 conditions. Now what are these 5 conditions? The contract has to be approved by both the parties. Rights and obligations of both the parties are clearly stated in the contract. Payment terms are clearly stated in the contract. The contract has a commercial substance. Now, what exactly is the meaning of commercial substance? So, standard says that it should not be an exchange of similar items between entities in the similar line of business. Okay. Let's suppose. Okay. To give an example. Let's suppose I exchange BPP book with some different educator. I exchange BPP book with some different educator. Okay. So I give my own BPP book, and when he gets the BPP book, so he returns it to me. So it's an exchange of similar items between entities in the similar line of business. This transaction does not have commercial substance. So will we record revenue and profit out of it? No, we won't. We know we won't. But when I'm selling the BPP book or any other SBR capsule to my customer, to my students, will I recognize a profit out of it? Yes, I will. Okay. Now, the last condition is it is probable that the consideration will be received. So understand, if it is not probable that the consideration will be received, how can you recognize revenue? So standard says that if it is not probable that the consideration will be received, this contract itself is not a valid contract, because I am not here to sell the goods for free. I am here to sell the goods for a consideration. So consideration has to be collected. Now comes the question, how will we evaluate whether the consideration will be collected or not? So we have to see whether the customer has the ability to pay and has the willingness to pay. Both ability and willingness should exist. Okay, if it is there, then definitely yes, this is a valid contract. If it is there, it is a valid contract. If it satisfies to be a valid contract, we'll move on to step number 2. But if it doesn't satisfy to be valid contract, we will continue evaluating these conditions till the time it gets satisfied. Okay, now moving on to step number 2. Now coming on to step number 2, that is identify performance obligations. So what is the meaning of a performance obligation? So understand, in a contract, an entity does multiple promises to the customer. So are all the promises a performance obligation? No. The standard says that a promise to transfer a good or service, that is distinct is called as a performance obligation. So listen to me very carefully. A promise to transfer a good or a service that is distinct, okay, is called as a performance obligation. Now comes the question, what is the meaning of distinct? So standard has given you 2 conditions. both of which has to be satisfied to become distinct. But I will explain you in a simple manner. Okay, if a question on the exam comes, I will request you to write these statements as it is, but to evaluate whether it is a separate PO or not, I am giving you the tip, I am giving you a hint in a very simple language. Understand? If the customer can purchase the goods separately and wants to purchase separately, can purchase and wants to purchase. So let me write here, customer can purchase and also wants to purchase separately, then it is a condition number 1 gets satisfied. Now condition number 2 is there is no significant integration, customization or modification between the contracts, between the promises in the contract. Let's suppose I'm giving you an example. I sold a laptop and I also sold 3-year technical support. Now this 3-year technical support is not significantly integrated with this laptop. Anyone can do this 3-year technical support. Anyone can do this. I could have taken it from outside also. Okay, so there is no significant integration involved. But it would have been the case if this would have been the case, like this 3-year technical support services is significantly integrated with this laptop. Okay, that only this provider can provide this, then it is significantly integrated and they cannot be separated. Okay, they cannot be separated. To give another example, I went to purchase a laptop, and when I was purchasing laptop, I got the adapter also for the same. But now tell me, am I purchasing the adapter separately? No. Do I want to purchase separately? No. So what is happening? This is one single contract. This is one single performance obligation. Okay. Now let's suppose I went to purchase a laptop and I got inbuilt warranty. Standard warranty. Now tell me, am I purchasing the warranty separately? No, it is coming as a part of the package of the laptop, right? So is it a separate contract, separate performance obligation? No. But let's suppose for this laptop itself, I purchase an additional warranty. This is a separate performance obligation. Okay. Now, so this is step number 2. Coming to step number 3, that is determining transaction price. Now understand what exactly is the meaning of the term transaction price. So transaction price basically says that what is the consideration that the entity is entitled to receive, okay, from the customer. What is the amount that I am entitled to receive for the transferred goods or services? Okay, now understand. Transaction price excludes any amount paid or payable to third parties. That is, the best example of it is GST payable. Now, let's suppose I receive $100 from a customer. And the VAT payable on this is 5%. So this is including VAT. So what will I say? This is including VAT of 5%. Right? So my revenue, okay, let's suppose I received not $100. Let me make it $500. Okay. So now this is including VAT. So 100 is the selling price, then VAT is 5%, it becomes 105. But now, can I recognize this entire amount as revenue? No. So I have to recognize only 100 as revenue because this 5% is payable to the government. By the name of VAT payable or GST payable or any other name. Okay. So 500 divided by 105 into 100. It becomes how much? 476. So my revenue will be equals to 476, not 500. Okay. Now comes the question, what are the components of transaction price? So transaction price can be fixed, it can be variable. Now fixed, you very well know, I have sold these goods for this much price is a fixed consideration. Okay. Now I'll definitely take up an example also, but okay, let me first of all come to variable consideration. Now, what exactly is the meaning of variable consideration? So variable consideration means the amount is variable. The very first thought that we get when we hear the term variable consideration is what is the amount that we have to pay is variable. But that is not the only meaning of variable consideration. So variable consideration, it means if the amount is variable, the consideration is variable, or amount is fixed. What is the amount that I have to pay is fixed.
but the right to receive is variable. Whether we will receive it or not is variable. That is also called as variable consideration. Let me explain you with the help of an example. So let's suppose DLF has entered into a contract with Fortis for construction of a hospital for Fortis. So DLF is into real estate, Fortis is into hospital business, right? So DLF has entered into a contract with Fortis to construct a hospital for Fortis company. Now, so the contract was that DLF will take 3 years to construct the hospital, and the transaction price is $100 million. Transaction price is $100 million. Okay. Now, further, Fortis also went on to state that if you complete this contract within 2 years, I will give you a reward of $10 million. Further, extra over and above 100 million, I will give you a reward of over and above 100 million. I will give you an extra reward of 10 million. If you complete this contract within 1 year, then I will give you a reward of 15 million. But if you delay beyond 3 years, beyond your stipulated time, then I will charge a penalty of 20 million. Now tell me, in this case, is the amount fixed? No, either 10 million or 15 million or 20 million. Amount is variable. So it is a variable consideration. This 100 million amount is fixed. It is called as a fixed consideration. Now, further, Fortis also went on to state that the building which you will construct, I will do the quality check of the building. And if the building that you constructed for me passes the quality check, I will give you a reward of 5 million. Now understand, here the amount is fixed. 5 million is fixed, that I will give you this amount, but only if the quality is sorted, quality is passed, quality check is passed. So now here what happens? If the quality check passes, then I will get 5 million. If the quality check fails, then I will not get 5 million. So here the amount is fixed, but the right to receive is variable. We don't know whether we will receive it or not. Even though the amount is fixed, still it becomes a variable consideration. So I believe you are able to understand the meaning of fixed consideration and the variable consideration. So now here, one thing I will say, fixed consideration definitely forms part of my transaction price. But comes the question, will we include variable consideration as part of transaction price? Will we include variable consideration as part of transaction price? The answer to that is yes, we can. But provided there is a condition. Now the standard says that, listen to me very carefully, this is a very, very, very important point. The standard says that if it is highly probable, according to the estimates available today, that whatever amount you are recognizing as a transaction price, you will not reverse in the future when the uncertainty attached to the variable consideration is resolved. Meaning thereby, you recognize this as transaction price according to the best estimate available today. So if according to the estimates available today, you are sure that I will receive this amount, then recognize this as a transaction price, no issues. But if you are not sure that whether you will receive this price or you will receive this amount or not, then don't recognize now, because unnecessarily you will recognize it as a transaction price, recognize as revenue, and in the future you are seen reversing the revenue. So don't do it. See, again, I'm telling you one point. Standard is not saying that you can't reverse. Standard says that yes, if you have to reverse. There is no challenge. In the future, if you have to reverse. But according to the current estimates, just evaluate and then work. Okay. Now, let me give you an example. Let's suppose, according to the current estimates available, DLF believes, yes, I will pass the quality check. Okay. Then definitely DLF can recognize this 5 million as transaction price. Now, according to the current estimates, DLF believes that I will be able to complete this hospital within 2 years. So DLF considers the reward of 10 million. Okay. But now, going forward, the estimates changed. COVID came into the picture and DLF was not able to meet this 2-year period criterion. So then DLF has to reverse the 10 million. DLF will have to reverse this amount. So now what is happening? We can reverse, but provided your estimates are changing. provided your estimates are changing, then you can reverse. There is no challenge in that. There is no challenge in that. But the standard is saying according to, always do according to the best estimates available. Don't do that. Don't do this work. So now whatever what I'm saying now, this is what the standard says not to do. So if I knew that, okay, I will not be able to receive this safety check, quality check, I will not be able to receive this amount. Still, I am recognizing that as a transaction price because I want to inflate my revenue. That is wrong. You should not do that. You should not do that because if you consider that as a transaction price, you will recognize as a revenue, and in the future, you know, when you will not receive, you will have to reverse in the future. Don't do this work. Don't do this work. So now come here, see what the standard says that. What is the meaning of variable consideration? Consideration is variable if the amount is variable or the entity's right to receive is variable. Okay. Now, will variable consideration form part of transaction price? Yes, but only to the extent it is highly probable that the significant reversal of the cumulative revenue recognized will not occur when the uncertainty is resolved. I believe, guys, you need to remember this line. This line is important and which you need to remember for the exam. Okay. Now comes the question: if variable consideration has to be recognized as a transaction price, then at what amount? At what amount? So the standard says that if there's a range of possible outcomes, this can happen, 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 range of possible outcomes, then use expected value method. What is the meaning of expected value method? Let's suppose these are the three outcomes. Now in this outcome, I am expecting that I will receive 10 million, I will receive 20 million, and I will have to pay 20 million here. Okay. Then what is the probability? 40%. So 10 into 40% is 4. 20 into 55% is 7. Okay. And 20 into 25% is minus 5. So 4 plus 7 minus 5. What is the amount? 4 plus 7. 7 plus 4, 11. 11 minus 5 is, tell me how much? 11 minus 5 is 6. So this is 6 is the expected value amount. 6 is the expected value amount. This I will include as part of transaction price. Now, if there are only two possible outcomes, either this can happen or this can happen, either this can happen or this can happen, okay, and one of them is highly likely to happen. The highly likely to happen means most likely to happen means the probability of happening that is more than 50%, okay, then it is called as most likely amount. Then in that case, we take, let's suppose 5 million I will receive, or 5 million I will not receive. 5 million I will receive, or I will not receive 5 million. So in that case, you will take 5 million as the most likely amount and include 5 million as the transaction price. Now understand. So this is the rule of using the expected value method or most likely method. But if the question specifically mentions, use of any method, then use that method. Let's suppose question clearly mentions that you are required to use most likely method, then use most likely method. If the question clearly mentions you are required to use expected value method, then you use that method. Okay. Now, one mistake that all the student does in the exam is when they are calculating the transaction price as per the most likely method, let's suppose what is happening here, I will explain. So let's suppose in most likely method, there are two outcomes. Outcome number one is I will receive 5 million and the probability of this is 80%. The probability of this is 80%. And I will not receive 5 million means I will receive 0 and the probability of this is 20%. Now what a mistake happens in the exam is student that what they will do is they will say 5 million ka 80% is 4 million. This is 0. So my most likely amount is 4 million. This is wrong. This is wrong. In case of most likely amount, in case of most likely method, you are not required to do this thing. You will say this is the most likely amount. I will consider the 5 million entirely. Most likely amount 5 million entirely I will take. I believe you are understanding this logic. Now, let us move on to the next topic, that is significant financing component. So now first comes the question, what is the meaning of significant financing component? So understand, if there is a time gap, between transfer of control and the receipt of consideration, and this time gap is more than 12 months, okay, let's suppose I have sold the laptop today, but I will receive the money after 2 years, okay, at the end of year 2. It is a case of significant financing component. Or I have received the money today itself, but I will be delivering the building after 2 years. Okay. Then it is a case of significant financing component. Okay. So if there is a time gap between transfer of goods or services and the receipt of consideration, and this time gap is more than 12 months, it is called as significant financing component exists. Now,
if significant financing component exists, then what is the amount of revenue that you should recognize? What is the amount of revenue that you should recognize? So understand that generally there is a wrong notion among the students that we recognize revenue at the amount of present value. No, it is not the case of present value. You need to understand the entire concept first of all. Understand, guys. So let's suppose first two questions. That two questions in case of significant financing component, there comes two questions. When? First point, when do you need to recognize revenue? When? The answer is whenever the control is transferred on that date, I will recognize revenue. Whenever the control is transferred on that date, I will recognize the revenue. Whatever might be the date, whenever the control is transferred on that date, I will recognize revenue. Now comes the question, at what amount? At what amount? Now, understand the answer to that is, if cash selling price on the date of transfer, of goods or services, on the date of transfer of control, okay, if the cash selling price is available, then we will recognize the revenue by an amount of cash selling price on the date of transfer of control. Okay. Now, any excess or shortage received will be your finance income or finance costs. Now, if cash selling price is not available, then we will recognize revenue at value of contractual consideration, whatever we are receiving as per the contract. Whatever amount we are receiving as per the contract, what is the value of that consideration on the date when control is transferred? So let's suppose example, in case A, we are transferring the control here, so definitely we'll recognize the revenue here, but we are receiving the consideration here. So now, at what amount will we recognize revenue if cash selling price is not available? The value of this consideration on this date, on this date is your revenue. Hence, it is called as a concept of present value. Now, in case B, what happens? When is the control getting transferred? Here we are transferring the control. So now, what is the value of consideration on this date is your revenue. So it is called as a concept of future value. So there is no hard and fast rule that we have to recognize revenue at the present value only. No. You just need to see when is your control getting transferred, on that date recognize the revenue, and at the value of contractual consideration on the date when the control is getting transferred. I believe it is very much clear. Now. So let me take the help of an example and explain this point. So let's suppose I am receiving a consideration of 121,000 and the discount rate is 10%. So now tell me, what is the present value? The present value is, let's suppose, comes to 100,000. Now we are recognizing revenue 100,000. So what about 21,000? Because we are receiving 121,000, but we are recognizing revenue of 100,000. So 21,000 will be called as finance income. Why finance income? Why are we breaking this 121,000 into revenue and finance income? Because we have received 121,000 for the sale of goods. Then why to break? Let me explain the logic. So understand, this is entity and this is customer. Now, entity has given the goods to the customer. And entity received 121,000 from the customer. Now understand, entity transferred the goods today, but will receive 121,000 after 2 years, at year end 2. So don't you think entity has given to the customer goods for free now and will receive the money after 2 years? So it is like a loan. It is like an entity has given a loan to the customer. Right? So now what we are saying, we have to recognize revenue only for the goods. So what will I do? So I will say, out of 121,000, 100,000 is for the sale of goods and the remaining 21,000 is for the benefit of finance given by the entity to the customer. Okay, so benefit of finance, for the benefit of finance given, I will record finance income. For the goods transferred, I will record revenue. Now in the difference case, in this case B, let's suppose I have received a consideration of 100,000 here. The discount rate is 10%. So I will if I calculate the future value, it comes to 121,000.
So now I will record a revenue of 121,000. Why? What is the logic behind this? So understand here. Entity has transferred the goods to the customer. Okay, now what is the entity receiving? Entity received 100,000 today. Entity received 100,000 today. So entity received it today, but entity is transferring the goods at year end 2. Don't you think customer is giving me a loan for 2 years? Customer is giving me a loan of 2 years for free. Customer is giving me the loan of 2 years. So now I have transferred the goods. Now for the transfer of goods, I am getting these two benefit. For the transfer of goods, I am getting these two benefit. So what is the value of goods? This plus this plus this. So that's why I am recognizing a revenue of 100,000 plus 21,000. That is 121,000. That is 121,000 is the revenue which I will record here. I believe you are understanding the logic here. Okay. Now how will the journal entries work? So on this date, since I have transferred the control but not received the money, it will be trade receivables account debit to revenue at 100,000, the present value. Then I will unwind the trade receivable and record finance income. Then I will recover the trade receivable. Okay. Now in case B, so whatever amount I have received, since I have not transferred the control, it is my contract liability. Then I will charge finance cost on it and unwind it, and it will become 121,000. I will record 121,000 as my revenue here. Okay. Now, so this is the case of significant financing component. So now there are few cases where it might appear that it is a case of significant financing component, but ideally it is not. So I will recommend all of you to read this one once. Okay. Now comes the next point is non-cash consideration. Means I have transferred the goods. To the customer. I have transferred the goods or the services to the customer, but the customer is ideally not giving me the consideration in the form of cash. Rather, it is giving me in the form of non-cash. Then what will happen? So the standard says that what is the amount of your revenue? Your revenue is what you receive from the customer. Okay, what you receive from the customer. So now whatever, if you are receiving non-cash consideration, doesn't matter. So the revenue will be equals to, or the transaction price will be equals to fair value of non-cash consideration. Fair value of the non-cash consideration that you receive. Fair value of the amount consideration that you receive, whether it is cash or non-cash, doesn't matter. But the standard says that if you are unable to find the fair value of non-cash consideration that you have received, if you are unable to find the fair value of non-cash consideration that you have received, in that case you will take the fair value of the transferred goods or services. Whatever goods or services that you have transferred, take the fair value of that and recognize that as a transaction price. I believe it is very much clear to all of you. Now coming to the next part. Customer provided goods or services. Customer has given me some goods or services. So now, understand here. Customer has given me some goods or services. Okay. Now, if the customer gives me the control, then I will increase the transaction price. Why? Because don't you think, if the customer has given me the goods services and the customer has given me the control of that, so I become the owner of that. So it is like a non-cash consideration. Right? So I will increase my transaction price by the fair value of those goods or services. So applying the same logic of non-cash consideration. But if the customer does not give me the control, so customer has given me the land, but the customer has not given me the control of land. Customer told, on this land construct a building. Okay, so customer is giving me the control of land. No. So there is no adjustment required to the transaction price. Okay, I believe it is clear to all of you. Now, consideration payable to the customer. So I am paying, entity is paying a consideration. Entity is paying a consideration to the customer. So it is more like a cashback. Right? So in that case, what we'll do, we'll reduce the consideration from the transaction price. Whatever consideration that the entity pays to the customer, we will reduce from the transaction price. This example, this concept I can best explain with the help of an example. Is, let's suppose from Paytm, I booked a flight ticket from Bangalore to Kolkata, which costed me, let's suppose, rupees 10,000. Okay, which costed me, let's suppose, rupees 10,000, and as I was booking the ticket, I got a cashback of 1,000. So what is the revenue of Paytm? 9,000, 10,000 minus 1,000, because 10,000 is what I paid to Paytm. Now 1,000 Paytm gave it back to me as a cashback. So it is a Paytm is an entity, I am the customer. So consideration payable to the customer. So Paytm gave me 1,000. Okay. So the revenue is 9,000, not 10,000. Okay. Now, so this is the all about transaction price. I believe step number 3 is clear to all of you. I believe step number 3 is clear to all of you. Okay. Now moving to step number 4, that is allocation of transaction price to each of the performance obligation. Now comes the question, how to allocate. So as I already discussed, we have to allocate in the ratio of standalone selling price of each performance obligation. But comes the question, what if standalone selling price is not available? What if standalone selling price is not available? Then in that case, we can have to take adjusted market assessment approach. Then what is the market price of similar goods available? Okay. And if we have to if there is some change in the features, adjust the price for the change in the features. Okay. Now if the adjusted market price assessment approach is not available, then if I'm selling the product, definitely I will know the cost of it and at what margin generally I do sell it, so cost plus margin approach I can take. Now, if there's a scenario that the margin that I charge varies from customer to customer, to some customer I charge a margin of 10%, to some customer I charge a margin of 300%. The margin is a wide range of margin. So in that case, I can take a residual approach. So whatever, let's suppose I have performance obligation number 1, performance obligation number 2, performance obligation number 3. So on this, standalone selling price was available. So I will allocate in this ratio. Now whatever is remaining, I will allocate the residual amount will be for performance obligation number 3. Residual amount will be for performance obligation number 3. Okay. So this is how I will allocate the transaction price to each of the performance obligations. Okay. Now, coming to the next part, step number 5, recognize revenue as and when the performance obligation gets satisfied. Recognize revenue as and when the performance obligation gets satisfied. Now here understand, when can we recognize revenue? See, so far we have understood that we recognize revenue when the performance obligation gets satisfied. Now what is the meaning of satisfaction of performance obligation? That is the control of that goods or services are transferred to the customer. Now when will we understand that the control is transferred? So there are certain indicators given in the standard, that is right to receive consideration. Entity has a right to receive consideration. Customer has a legal title. Transfer of physical possession. Risk or rewards are transferred. Customer has accepted the goods or services. So in that case, we can assume that the control is transferred and we can recognize revenue. Is that the conclusive list? No, they are just the indicators. I will highlight indicators. Okay. Now, how does control gets transferred? So control can get transferred at a specific point in time or over a period of time, but how to analyze or how to conclude whether the control is getting transferred at a specific point of time or over a period of time? At a specific point of time or over a period of time, how to conclude that? So the standard has given you 3 conditions. Now the standard says that out of these 3, if any one of them is satisfied, if any one gets satisfied, then we say that the revenue has to be recognized over a period of time. But if none of them get satisfied, then revenue has to be recognized at a specific point in time. At a specific point in time, we have to recognize revenue. Okay. Now, what are the 3 conditions? Customer simultaneously receives and consumes the benefit as the entity performs. So as and when I'm teaching to you, you guys are getting and consuming the benefits. So in my case, I will recognize revenue over a period of time. Okay. Now, entity's performance creates and enhances an asset that the customer controls. So let's suppose in this case there is an asset case. So I'll take the example of a real estate contract. Okay. Now let's suppose. Tell me. I am DLF. I am constructing a residential apartment wherein I am selling the individual flats to the customers. Now tell me, let's suppose one customer has purchased one flat from me. Now tell me, as and when I am the entity, as and when I am constructing that residential apartment, so that asset is getting created and enhanced. Yes. But does the customer control that? No.
Customer is not controlling it. Entity controls it. So this condition gets failed there. Now, entity does not have alternative use to the asset and the entity has enforceable right for the payment work done till date. Okay, so entity cannot use the asset for any other purpose and the entity has the enforceable right to payment for work done till date. Whatever work the entity has done till date, entity has the right to receive the payment for the work done till date. Okay, if any of these conditions get satisfied, we can say that the revenue has to be recognized over a period of time. Otherwise, revenue has to be recognized at a specific point in time. Let me give you one more example. Okay, so I had a land on which I wanted to construct my own classes. So now what I did, I appointed DLF to construct classes for me. So now understand, as DLF is constructing classes on that, so an asset is getting created and enhanced, but me as a customer is controlling that asset. Now here DLF is not controlling. Here I am controlling. So revenue has to be, the DLF will recognize revenue over a period of time. Now let's suppose at any specific point of time, I told to DLF that DLF, see, I'm not liking your quality. So please let's close this contract. I will get the rest of the work done by some other contractor. So now tell me, DLF will say, no, sir, I have done 30% of the work for you. So 30% payment I am entitled, right? So that's what is happening. Entity has the enforceable right to payment for the work done till date. Okay. So standard says that if any of these conditions get satisfied, the revenue has to be recognized at a specific revenue has to be recognized over a period of time. And if none of the conditions get satisfied, the revenue has to be recognized at a specific point in time. Okay. Now, if revenue has to be recognized over a period of time, then definitely we need to measure what is the percentage of completion. How to measure? So we can measure the percentage of completion using the input method or output method. So what is the meaning of input method? Input method means the efforts put in by the entity. That is, what is the costs incurred till date and divided by what is the total expected costs. Then what is the meaning of output method? What is the value to the customer? Now, how will we calculate this one? So on the basis of work certified, we calculate here the percentage of completion. What is the work certified divided by what is the total contract price? So this is how I measure the percentage of completion. Okay. Now, how will I recognize revenue as per IFRS 15? So the entire process of it. But I'm discussing the revenue recognition as per the overtime. Okay. Because point in time is very simple. And let's suppose I sold the laptop. The revenue has to be recognized at this specific point in time. So I sold the laptop, whatever amount I receive is my revenue. So point in time is very simple. I need to discuss about overtime. Okay. Now understand. Overtime is over a period of time. It can be 2-year, 3-year, 4-year contracts. So now for overtime contract, whenever a question comes on revenue recognition, the first thing that you need to see that on an overall basis, is the contract profitable or is the contract loss making, or you are uncertain whether the contract is at profitable or loss making. Why uncertain? Because the contract is at initial stages. Hence you are uncertain whether the contract will be a profitable contract or a loss making contract. So now understand. So first of all is you have to evaluate whether the contract is a profitable contract or a loss making contract, or it is uncertain. Now if it is a profitable contract, then what will you do? You will recognize revenue and cost of sales as per input method or output method, whichever is specified in the question. If question says input method, you will use input method. If the question says output method, you will use output method. The question will give you the data about it. Whether the question wants you to use input method or output method, the question will give you the data of it. Now comes the question, how to calculate using input method and how to calculate using output method. Let me discuss that part also with you. So under input method, what will you do? Cost incurred by total expected costs. Cost incurred till date by total expected costs. So what is the revenue? Contract price multiplied by the measure of progress. That is the measure of progress that you calculate here. But understand, always calculate measure of progress as cumulative. Let's suppose this contract is for 3 years. Okay, now you are standing here. Then what will you do? You will say what is the cost incurred till date and what is the total expected costs. Now, if you are standing here, then what you will say? What is the cost incurred in these 2 years and what is the total expected cost? So always calculate measure of progress as the cumulative. So till date, this is the work, this is the percentage of work that is done. Till date, this is the percentage of work that is done. So now, so contract price multiplied by the measure of progress. Till date, this is the amount of revenue that has to be recognized. Till date, because measure of progress is cumulative, then revenue which you recognize, which you calculate here is also cumulative, right? Then you have to subtract what is the revenue that you have already recognized in the prior years. What is the revenue that you've already recognized in prior years? Okay, now what is the cost of sales? What is the cost incurred in the current year? Whatever is the cost incurred in the current year is your cost of sales. I believe this is very much clear to all of you. Now, if you are using output method, then how will you calculate measure of progress? What is the work certified till date divided by the total contract price? This is your measure of progress. Again, calculate measure of progress as a cumulative figure. Then what is the revenue? Work certified in the current year is your revenue. What is the cost of sales? Total expected costs multiplied by the measure of progress is the cost of sales till date. Then you have to minus cost already recognized. Costs already recognized, you have to minus here. Okay, so I believe you are understanding how to recognize the revenue as per the input method and output method. Now coming back to my flow chart here. So if the contract is a profitable contract, if the contract is on an overall basis, if the contract is a profitable contract, you will recognize revenue and the cost of sales as per the input method or output method, whichever is specified in the question. But if the contract is a loss-making contract, then what will you do? So the standard says that you have to give your answer in 2 stages here. Stage 1, recognize revenue and cost of sales as per input method or output method, whichever is specified in the question. Then in step number 2, you have to calculate whatever is the overall loss in the contract. What is the overall loss in the contract? Please calculate that. Then calculate what is the loss already recognized. What is the loss that you have already recognized till date? Then calculate what is the loss yet to be recognized. Let's suppose the overall loss is 20. Overall loss is 20. The loss that you've already recognized is, let's suppose, 16. The loss that is yet to be recognized is 4. So for this 4, the standard says that you have to recognize a provision for onerous contract. And what is the journal entry for this? It is a cost of sales account debit. Cost of sales account debit to provision for onerous contract. To provision for onerous contract. To provision for onerous contract. Provision for onerous contract. To provision for onerous contract. So now I will give you the example of this. So understand, let's suppose my expected on this date my cost contract price was 100, expected cost was 80. So it was a profitable contract. It was a profitable contract in the first year. So what I did, 20% work is done. 20% is the measure of progress. So what I did is I recognized my revenue at 20% and I recognized my cost of sales also at 20% and recognized a profit of 4. I recognized a profit of 4. Now understand, here at the end of second year, I complete my contract by 60%. So now what happens? But my expected cost increases to 115. My expected cost increases to 115. So what will I do? First of all, tell me revenue is 100 ka 60%, that is 60. Minus 20 is 40. So I recognized a revenue of 40 here. Now 115 ka 60%, 115 ka 60% is 69 minus 16 recognized in previous year. So my cost of sale is 53. So I recognize a loss of 13. But what is the overall loss? 115. So what is the loss yet to be recognized? What is the loss yet to be recognized? Tell me. What is the loss yet to be recognized? Tell me. Loss yet to be recognized. Tell me. The loss yet to be recognized is 2. So for this 2, I have to make a provision for onerous contract. For this 2, I have to make a provision for onerous contract. Okay. I believe it is very much clear to you. So we need to see the cumulative losses here. What is the cumulative losses that we have recognized so far? What is the overall loss? What is the overall loss? What is the loss yet to be recognized? What is the loss yet to be recognized here? Okay. Now, if the contract says it is uncertain, then what will you do? Then revenue is equals to cost incurred. Basically, whatever cost you have incurred is your revenue. Basically, the standard is saying no profit, no loss. Since you are uncertain, no, this contract will be profitable or a loss making. Then what you have to do is, recognize revenue is equals to cost incurred. Don't recognize any profit. Don't recognize any losses for the same. I believe it is very much clear to you guys. Now comes how will you present in the exam, or which method to follow. So understand, output method or input method. Ideally, it will be given in the question, okay, directly or indirectly. The question will give you hint. But if the question is silent, then see what data is available to us. If the data of cost incurred is available, then use input method. If the data of cost certified is available, then use output method. Okay. Now, then comes the question, how will we present that in statement of financial position? So, what is the meaning of contract asset? So, understand, if the revenue, if I have recognized a cumulative revenue, understand in SOFP when I say everything is cumulative, understand. Now, cumulative revenue recognized till date is 100, but I have invoiced to the customer only 80, so 20 is called as my contract asset. 20 is called as my contract asset. Why? Because I have invoiced only 80 but recognized revenue of 100, right? So I have a receivable of 20 which I have not yet invoiced, but it is my receivable, so it is called as my contract asset. So what is the meaning of contract asset? Revenue recognized but not yet invoiced. Is called as your contract asset. Similarly, from the point of view of cost, so you have recognized a cost of 70. You have recognized a cumulative cost in P&L of 70. But the outflow, the cost that you have outflow is 90, means you have paid something extra which you will recognize as an expense in the future year. So you have paid the expense in advance. So it is your prepaid cost of sales. So it is called as a cost of contract asset is 20 here. So when the outflow is greater than the cost expense, it is called as a contract asset. Now just the reverse is contract liability. Now if you have received more than what you have recognized as a revenue, so you have recognized a revenue of 80 but you received 90, so this 10 is your contract liability, which you also used to say by the name of deferred revenue or refund liability, right? It is called as contract liability here. Now if you have incurred a cost, if you have, let's suppose, recognized a cost of 75 in P&L but you have paid only 60, means 50 you have recognized as an expense but not yet paid. It's an outstanding payment. So this 15 is your contract liability. I believe you are understanding the concept of contract asset and contract liability as well. Now moving on to the special business models. In special business models, we need to study, so first of all, principal versus agent. Now understand, we need to understand this point that principal recognizes gross revenue and agent recognizes net revenue. What is the meaning of gross revenue, net revenue? Understand, let's suppose I am the customer, Make My Trip is the agent and Indigo is the principal. Okay, now I give 6,000 to Make My Trip for booking my flight tickets. Okay, now Indigo, so now Make My Trip is just an aggregator or a marketplace where it brings the customers and the entities together and we can purchase the tickets from here. So it is the income of Make My Trip is just the commission income. Okay, so now Make My Trip, what it does, it retains 500 its own share of income and transfers 5,500 to Indigo. Now so Make My Trip should recognize a revenue of only 5,500. So if Make My Trip does that, it recognizes the revenue of 6,000 and recognizes the cost of sales of 5,500, it is wrong. Okay, so rather Make My Trip should recognize a revenue of 500. It's commission income. Now Indigo, what will Indigo do? Indigo will record a revenue of 6,000 and a commission expense of 500 to sales, to do the sales. Commission expense of 500 to do the sales. Why? Because Indigo was the principal and Make My Trip is the agent. Now comes the question, how to identify which company is entity, which entity is the principal and which entity is agent. So now we have to see these three indicators. Who has the primary responsibility of fulfilling the contract? In this case, Indigo has the primary responsibility of fulfilling the contract. Who bears the inventory risk? So let's suppose in a flight there are 180 seats and Indigo, Make My Trip, is able to sell only 60 seats. Who will bear the loss for the remaining 120 seats? It's the Indigo, not make my trip, not make my trip. Who establishes price? The base price is established by Indigo. They definitely make my trip give some additional card discount, this discount, that discount. But yes, the base price is established by Indigo and not make my trip. So airlines set up the base price, the establishment of price. So in this case, Indigo is the principal and make my trip is the agent. So Indigo will recognize gross revenue and make my trip will recognize net revenue. How? On the basis of these three factors. Now next is non-refundable upfront fees. So when you go to the gym, you give up in initial membership fees, joining fees. Now what is the treatment of joining fees that the gym guys do? Gym as an entity, how do they record this joining fees? So standard says that, does this fees relate to any specific goods or services transferred to the customer? Any specific goods or services, maybe a joining goodie bag that they are giving. Yes, it says, if it says yes, recognize revenue on transfer of promised goods or services. So when you give the goodie bag to the customer, you have to recognize revenue. But if this fees does not relate to any specific goods or services, then in that case, on the date when you are receiving the money, record it as a contract liability and recognize this contract liability as revenue over the contract period. So joining fees is for the 1 year period. So this whatever the joining fees will be recognized as revenue over the 1 year period. Okay. Now comes the third is the sale with a right to return. Sale with a right to return. So understand why this concept is coming and how will it be treated. So let's suppose Amazon sells a goods to the customer with 30 days return period. Okay. Now comes the question. Amazon will recognize revenue when? On the date of sale or on the date when the return period expires? When will Amazon record revenue? The answer to that is Amazon will record the revenue on the date when the sale is happening. Okay. But sir, this sale can be refunded back. These goods can be returned back. So in that case, Amazon will have to refund the money back. Then how will I recognize revenue for the same? So now apply the concept of variable consideration here. So what happens? If it is highly probable that the significant reversal will not occur, then we can include this as a revenue. So now in this case, entity will have to estimate that what are the probability of returns. So let me explain this concept with the help of an example. So understand, Amazon has sold 100 laptops to a customer with 30 days return period. Okay. The price of the laptop is 50,000. The cost of the laptop is 40,000. Okay. Now, and there's a probability that 5% of the laptop will be returned back to us. So now on the date when we are selling the laptop, what is the entry which I will pass? 50,000 into 100 is 50 lakhs. So I have received in my bank account 50 lakhs. Now 5% of which I will have to return. So I will not recognize the revenue to the extent of 5%. So 50 lakh ka 5% is 2.5. which I will not recognize as a revenue, rather I will say it to be refund liability. The rest will be my revenue. Now, applying the matching concept, since I have recognized revenue to the extent of 95%, since I have recognized revenue only for the 95%, I will recognize cost also for the 95%. I will recognize cost also to the tune of 95%. Now, so what was my cost? 40,000 into 100 is 40 lakhs. So my inventory gets reduced by 40 lakhs. But can I recognize cost of sales by 40 lakh? No, I will recognize 40 lakh ka 95%. That is 38 lakh. The remaining it is called as inventory lying with the customer. The control of the inventory is with me, but it is lying with the customer. So you can give any name, inventory lying with the customer, or you can say right to return asset, okay, and write this one too. Now on the date when the return period expires, so there can be two instances. On the date when the return period gets expired, goods will not be returned or goods can be returned. So if goods are not returned, then what will happen? In that case, I will reverse my refund liability and recognize it as a revenue. I will reverse the right to return asset and I will recognize as cost of sales. Why? Because now I am treating that 5% also is my sales. Now goods are returned back to us. Then
If goods are returned, definitely my inventory will increase and I will have to refund the money. So refund liability account debit to bank. So this is the entry which we have to do for sale with a right to return. Recognize revenue to the extent it will not be reversed. Do not recognize revenue for the expected returns. Recognize cost of sales only to the extent revenue is recognized. On the expiry of return period, if goods are not returned, then reverse refund liability and recognize revenue. Reverse right to return asset and recognize cost of sales. On the expiry of return period, if goods are returned, then pay off refund liability and reverse right to return asset and recognize inventory. I believe this concept is clear to all of you. Now comes warranties. So under warranties, the warranties are of two types. One is called as standard or inbuilt warranty. And another is additional or extended warranty. Now we have already studied in step number 2, performance obligation, that standard warranty is not a performance obligation, but additional warranty is a performance obligation. Is a separate performance obligation. Additional or the extended warranty is a separate performance obligation. Now since it is a separate performance obligation, we have to recognize revenue over the warranty period. Whatever is the transaction price allocated to this performance obligation, we will recognize as the revenue over the warranty period. But see, if it is a standard warranty, it is not a separate performance obligation. So are we going to recognize any revenue for that? No, but we do have an obligation to do the repairs for free to the customer. So it's my obligation arising due to past events, the amount of which is not certain but can be estimated. Hence I have to recognize the provision under IAS 37. Okay, and I have taken up an example also in IAS 37 discussion. Okay, now comes the consignment arrangement. It is again like a principal versus agent thing. Now tell me, who is the principal here? The consigner. Consigner is the principal here, and the consignee is an agent here. Who sells the goods on behalf of principal. So now again understand, consignee will record net revenue, the commission, and the consigner will record the gross revenue and the commission expense. Now comes the question, when will the revenue be recognized? So when the consigner transfer the goods to consignee, will consigner recognize revenue? No. But when the consignee sells the goods to the end customer, it is then the consigner will record the gross revenue and consignee will record the net revenue, that is the commission income. Okay. Now it is a consignment arrangement. How will we assess if it is a consignment arrangement? Now understand, if the product is controlled by the manufacturer or the consigner, the entity, that is the consigner, can ask the dealer, that is the consignee, to require the return of the product, to return the product back to the consigner. So consigner has the ability to ask the consignee to return the product back to consigner. Okay, dealer does not have does not have an unconditional obligation to pay for the product until the same is sold to the customer. So dealer will give the money to the consigner only when it sells the goods to the end customer. Okay, so if these three conditions are satisfied, it is then we say it is a consignment arrangement. If it is a consignment arrangement, the consigner will record the gross revenue, consignee will record the net revenue. Consigner is the principal, consignee is the agent. Revenue is recognized when the consignee sells the goods to the end customer. Okay, now bill and hold arrangement. What is a bill and hold arrangement? Let's suppose what we have done here is customer has purchased the goods. Customer has paid for the goods, but customer says that I don't need the goods as of now. Customer is requesting the entity to keep the goods with the entity. So now if this is the case, the standard is saying that bill is a separate performance obligation and hold is a separate performance obligation. And whatever is the transaction price has to be allocated to the bill and the hold. So whatever is the transaction price allocated to the bill is recognized as revenue now itself because I have sold the goods. Whatever is the transaction price allocated to the hold is a warehousing arrangement, for which revenue has to be recognized over the warehousing period, on which the entity is keeping the goods of customer with the entity. Okay, now this arrangement will hold good only if these four conditions get satisfied. What? Customer has requested the arrangement. Product must be identified separately as belonging to the customer. So see, understand, the control of the goods has already passed to the customer, but it is just that entity is keeping the goods on behalf of customer. Okay, and customer has requested the arrangement. Entity has kept the goods with himself on behalf of customer. So product must be clearly identified. Okay, this goods belongs to that customer. Okay, but just that we are keeping with us, but this goods doesn't belong to me.
entity saying this goods doesn't belong to me now because the control of goods has already been transferred to the customer. The product is ready for transfer. Whenever the customer will say the product is ready for the transfer, entity can neither sell the goods or use the goods. Okay, so if this is the case, we say that there are two arrangements, that is sale of goods and warehousing arrangement. Now whatever the transaction price has to be allocated between the sale of goods and the warehousing arrangement in the ratio of their standalone selling price. Whatever is the transaction price allocated for the sale of goods is recognized as revenue. Now whatever the transaction price allocated for the warehousing arrangement is to be recognized as revenue over the warehousing period. Repurchase arrangements. So now entity has sold the goods to the customer but retains the right to repurchase the goods at a later date. So now in this case, I will say very simply, if the repurchase price is greater than the original selling price. So let's suppose I have sold the goods at 100, but later on I will purchase at 121. If the repurchase price is greater than original selling price, always keep this in mind. Then it is a financing arrangement. Or if the repurchase price is less than original selling price, then it is a lease transaction. Okay, now. But understand one more thing here, guys. If the question says that the probability that the entity will repurchase the goods, is low or nil, then always consider it to be a sale transaction. Don't think it to be a financing transaction or a lease transaction. No. If the understand, okay, I'll give you a chart. I will give you a flow chart. So in the case of repurchase arrangements, if the probability of repurchase is low or nil, then we say it to be a sale transaction only. But if the probability is high, then we see whether the repurchase price is greater than the original selling price. If that's the case, it is a financing transaction. If repurchase price is less than the original selling price, it is a lease transaction. Okay, so this is all about repurchase arrangements. Now comes discount vouchers. Now what happens in case of discount voucher? So first of all, let us understand the modus operandi of discount voucher. It is then you can understand the accounting treatment of it. So understand. So let's suppose this is an entity and this is a customer. Entity has sold a product A to the customer for $1,000. Okay. Now, when the customer was getting this invoiced, at that time, the invoicing guy told to the customer that, sir, we are giving you a discount voucher of 40% up to 500. Okay, we are giving you a discount voucher of 40% up to 500, which you can avail in your future purchases. Now understand here. The customer has paid 1,000. But the customer has got two things. One is product A, and another is the discount voucher. Now the standard is saying, if this discount voucher gives any additional right or a material benefit to the customer, then this is a separate performance obligation. Now the scenario is the entity gives flat discount of 10% to all the customers. But because the customer entered into this transaction, customer got a benefit of 40%. So what is the extra benefit that the customer has got? 30%. So this 30% is the additional benefit which the customer has got. So this 30% is a separate performance obligation. This 30% is a separate performance obligation. Now, so what we will have to do? The transaction price is 1,000. Okay, so step number 1, assume contract exists. Step number 2, performance obligation. 2 performance obligation. 1 is product A. Second is discount voucher to the tune of 30% up to 500. Third is transaction price, which is 1,000. Fourth is allocation of 1,000 transaction price to each of the performance obligation. But comes the question, how to allocate the transaction price? So in the ratio of standalone selling price. So we know the standalone selling price of product A is 1,000. But what is the standalone selling price of discount voucher? We don't know. So we have to calculate the standalone selling price of discount voucher. So how will we do that? So now this says that we are estimating that in the future, customer will make a purchase of 1,000. Customer will make a purchase of $1,000. Okay, so now if the customer makes a purchase of $1,000, what is the additional discount which we'll give to the customer? Because 10% discount is given to everyone. What is the extra discount which we are giving to the customer? It is 30%. Okay, and now what is the probability that the customer will make the purchase? 80%. So 240 is the standalone selling price of the discount voucher. So now we know the standalone selling price of the product A. We now know the standalone selling price of the discount voucher. So what we can do, the transaction price is 1000. So we have to allocate this transaction price of 1000 to product A and discount voucher in the ratio of standalone selling price. So how to do that? 1000 into standalone selling price of A divided by A plus discount voucher. A plus discount voucher. It is 806. Now, discount voucher, transaction price of 1000, standalone selling price of discount voucher divided by 1000 plus 1240. So it comes 194 and 806. Now tell me, since we have already transferred product A, so we will recognize the revenue for the same, but discount voucher will be applied in the future sales. Discount voucher will be applied in the future sales. So when the customer applies the discount voucher, it is then we will reverse this contract liability and recognize the revenue. Now understand, the discount voucher also have a limited period that you have to avail within the next 30 days. So if the customer avails within the next 30 days, then I will reverse contract liability and recognize as a revenue. But if the customer fails to do that, then the contract, the discount voucher period expires. Then what will we do? Now, is there an obligation for me to satisfy? No. So I will reverse contract liability and recognize as revenue. So understand, this contract liability of 194 will be recognized as revenue when either if the customer uses the discount voucher. So at the time when the customer uses the discount voucher, it is then I will reverse it and recognize revenue. But if the customer doesn't use it, then on the expiry of the discount voucher, I will reverse this contract liability and recognize as my revenue. I believe this discount voucher point is clear to all of you. Now the similar point is breakage. So let's suppose customer has paid for the goods. 194 customer has already paid for it, right? But the customer has not exercised its right. It is called as the unexercised right, is called as the breakage, which we have to recognize as revenue, either when the customer exercises its right or the unexercised part expires. There is no further obligation of the entity. Okay, so this breakage part is similar to the discount voucher. 194 is called as this 194. We can call this 194 as breakage, the unexercised right of the customer. Okay, so which we have to recognize as revenue when the customer exercises its right or the unexercised right expires and the customer cannot exercise its right. Okay, so now comes to the next part, that is licensing, rights to access or rights to use. So in case of rights to access or right to use, we are talking about the intellectual property. The use of intellectual property might be a Harry Potter image, might be Dharma Productions music. That is a DDLJ music, Dharma Productions. Whenever a movie starts for Dharma Productions, the DDLJ song gets played. It is an IP. Okay, so now comes the question: if entity sells its IP, whether it should recognize revenue over a period of time or at a specific point of time. So now standard says that if it satisfies all the below conditions, all of these conditions, then the revenue has to be recognized over a period of time. If the entity is not able to satisfy any of these conditions, then the revenue has to be recognized at a specific point in time. Now, what are these conditions? Understand, entity is required or is reasonably expected to undertake activities that significantly affect the licensed intellectual property. Understand, I will be discussing from two angles. One is the RCB, Royal Challenges Bangalore image, okay, the logo, Royal Challenges Bangalore logo. And the another example I'll take is, you can say Harry Potter. Okay, now understand. If RCB plays well, then the sale of the RCB t-shirts increases, right? So what is happening here, the RCB as an entity is doing some activities for due to which the customer is exposed. Let's suppose RCB as an entity has sold the RCB logo to an entity. Let's suppose Levi's to manufacture RCB t-shirts wherein the RCB logo was printed. Okay, so now if RCB plays well, the sale of the RCB t-shirts increases, right? Sale of the RCB t-shirts increases. So now what happens here? Now what happens here is the activities of RCB exposes the customer to the market. But let's suppose, now tell me, Harry Potter series, are they working now? Are they working now? No, they are not working now. The series is already over. The series is already over now. The series is already over now. Are there any activities conducted by the Harry Potter team? No, no. So there is no activities which exposes the customer to the market. Okay, now the license exposes the customer to any effects of the entity's activities, which I was telling now. Entities activities are not a performance obligation, which I was telling now. The RCB, when it plays good, are the performance obligation of this contract? No, 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 no. So RCB plays well, will expose the customer to the market. Will expose the customer to the market. Okay, so now if all these three conditions get satisfied, in case of RCB, all the three conditions get satisfied. Why? Because RCB is playing. So RCB plays well or doesn't play well will impact the sale of the RCB t-shirts. Okay, now the playing of RCB is not a performance obligation. It's not a performance obligation. So all the three conditions get satisfied. So when the RCB as an entity transfers the logo of RCB to be printed on the Levi's t-shirts, that is a case of rights to access the IP, and the revenue has to be recognized over a point of time. Access to the logo of Royal Challengers Bangalore. Okay, now, but if Harry Potter as an entity transfers the use of Harry Potter cartoons or the characters, Harry Potter characters, then in that case, it is a case of revenue to be recognized at a specific point in time, because Harry Potter, they are not working now, they are not doing any activities which exposes the customer to any effects of the entity's activities. Okay, now crowdfunding. Okay, now let me take one more example. Dharma Productions music label. Is DDLJ working now? Is DDLJ as an doing any activity now? No. So when we say about Dharma Productions music label, okay, it is not working any now. So it is at a point in time. It is at a point in time. A music label recorded way back. Is it working anything now? No. So it is at a point in time. It is at a point in time. Okay. Now crowdfunding. So crowdfunding means the entity is getting the funds from getting the funds from the general public. So now we have to see what is the accounting treatment of crowdfunding. So we have to see for what purpose we are raising the funding. For what purpose? So if it is targeted at investors, so I am receiving the funds and I am promising to the promising to the funders, the person who has given us the funding, I am promising to them that I will give you equity shares of my company. Then it is called as equity based, and we have to record it as part of bank account debit to equity share capital. Accordingly, I'll write. If it is debt based, I will record as a loan. If it is reward based, I will receive the money from the person who was providing me the finance, the funds. And in the return to that, I will be giving some of my goods. Okay. Then in that case, I will be recording a revenue for the same. Okay. It will be in the scope of IFRS 15. If it is donation based, then again it will be in the scope of IFRS 15. I will request you to read this paragraph entirely in full once, and you will understand what I'm trying to say here. Comes the last part of this chapter, that is contract costs. The costs are of two types: contract acquisition costs and contract execution costs. Now we have to see if it is incremental cost to acquire the contract. If it is incremental cost to acquire the contract, then I will recognize it as an asset and amortize over the contract term. If it is not an incremental cost, what is the meaning of not an incremental cost? Meaning thereby this cost will be incurred irrespective of whether we get the contract or not. So example of incremental cost can be commission or a brokerage. Example of not an incremental cost can be advertisement costs. So if I run an advertisement, the cost will be incurred irrespective of whether I get the contract or not. Okay, but for commission, I have to pay this commission only if I get the contract. So this commission is an incremental cost which I will recognize as asset and amortize over the contract term. If no, then P&L. If it is not an incremental cost, it will go to P&L. Contract execution cost means what? Cost to fulfill the contract. Cost incurred to fulfill the contract.
Okay, now if it is covered under the scope of any other standard, then I will account for as per that standard. If no, then I will recognize as an asset and amortize over the contract term. The best example of this contract cost is in the pre-mock December 24 question number 4, amount paid to social media influencer. Amount paid to social media influencer. That's the best example that can exist for contract acquisition costs. I will sincerely request you to go and watch that. Okay, so this completes my revision of revenue. I hope you enjoyed the session. Now let us revise IAS 12 income taxes. Now, as we know that income taxes has two components, current tax and deferred tax. Okay, from an SBR perspective, what is relevant is deferred tax. So what I will do is I will directly jump to the deferred tax, but yes, from the point of view of current tax, I will explain with the help of one example. Okay, with the help of one example, that what is the amount that goes to P&L as tax expense and what is the amount that goes to SOFP as liability. I will discuss with the help of one example, but my primary discussion here will be focused on deferred tax. Now, how do we calculate deferred tax? So understand. So point number 1 is we calculate the carrying amount of an asset or a liability as per the accounts books. What is the carrying amount? We calculate what is the tax base of an asset or a liability. Okay. Then we calculate temporary difference. How to calculate temporary difference? Carrying amount minus tax base is your temporary difference. Now, once we have calculated the temporary difference as the carrying amount minus tax base, we need to classify whether this temporary difference is a taxable temporary difference or a deductible temporary difference. Now, what is the meaning of taxable temporary difference? Any temporary difference which will increase the future taxable profit and it will increase the future tax payments is your taxable temporary difference. Any temporary difference which decreases the future taxable profits or which decreases the future tax payments is your deductible temporary difference. Now, all taxable temporary difference, we recognize deferred tax liability. But for all deductible temporary difference, ideally we recognize deferred tax asset, but subject to prudence limits. Why prudence limits is coming in the picture here? So understand, the standard says that for taxable temporary difference, it will increase the tax payments and it will increase the tax payments. So that is not a challenge. So for all taxable temporary difference, we can recognize deferred tax liability. But for deductible temporary difference, it will decrease the tax payment. For the tax payment to decrease, first of all, there should be a tax payment. That's what will decrease, right? If there is no tax payment only in the future, what the deductible temporary difference will decrease. So it will not have any value. So we have to see whether there are future taxable profits against which we can take a deduction of this temporary difference. Okay, so it is called as assessment of the prudence limits. Now, whatever deferred tax asset or a deferred tax liability that we recognize, okay, at the end of the year, so we have to see what is the movement of the asset or liability during the year. What is the movement of the asset or liability during the year? Now, understand few point here. For the movement, if the movement increases deferred tax liability, so it is called as deferred tax charge or deferred tax expense. Second, if it decreases deferred tax liability, if it decreases, your liability is decreasing, it's your income, so it is called as deferred tax credit or deferred tax income. Now, if it increases deferred tax asset, your asset is increasing, it is your deferred tax credit or income. Fourth, if it decreases deferred tax asset is decreasing, it's your expense, so it's a deferred tax charge or an expense. It's a deferred tax charge or an expense. Okay. Now, fifth point, opening it was deferred tax asset, but closing it becomes deferred tax liability. So what happens? Deferred tax asset is becoming zero and deferred tax liability is getting created. So for this, you will record what? Deferred tax charge, that is expense. Now, point number 6, opening was deferred tax liability.
Opening was deferred tax liability. Closing is deferred tax asset. So deferred tax liability is extinguishing and then deferred tax asset arises. So it is a deferred tax credit. It's a deferred tax credit. Okay, so you understand, ideally this deferred tax charge or the deferred tax credit is recognized in P&L. Ideally it is recognized in P&L, but if the base transaction is recognized in other comprehensive income, then the deferred tax charge or deferred tax credit for the same will also be recognized in other comprehensive income. For example, revaluation gain. If the revaluation gain is recognized in other comprehensive income, then the deferred tax impact of the revaluation gain will also be recognized in other comprehensive income. Okay, now if a share based payment expense is an equity, the deferred tax expense for the excess part, if you can link it with IFRS 2, the excess part also goes to equity. So wherever the base transaction is recognized, there the deferred tax impact also goes there. Okay, so ideally P&L, but if the base transaction is recognized in OCI, the deferred tax impact will also go to OCI. If the base transaction is recognized in equity, the deferred tax impact will also go to equity. I believe it is very much clear to all of you. Now, how to calculate tax base of an asset? So a standard says that from the asset definitely we'll get future economic benefits. If the future economic benefits are taxable, then the tax base is equals to future deductions available from the asset in the tax books. Okay, if the future economic benefits from the asset are not taxable, then it is equals to carrying amount of the asset. Now, what is the tax base of a liability? Tax base of a liability is equals to carrying amount liability minus future deductions or settlement of liability. So understand basically one logic behind creation of tax base of an asset or liability. The standard says that if there is any asset or a liability, the settlement or recovery of that asset or liability has tax consequences, whether it is increasing tax payment or decreasing tax payments, whatever it is, if it has tax consequences, we will create deferred tax on it. Okay, now see here, future economic benefits are not taxable. Not taxable means no tax consequences. Will we create deferred tax on it? No, we will not create deferred tax. So now what is happening here? We create deferred tax. We create deferred tax on temporary difference multiplied by tax rate. Now, what is the formula for temporary difference? Carrying amount minus tax base. Now, if it is not taxable, tax base is equals to carrying amount. So, tax base is equals to carrying amount. So what happens? Minus 0. So there is no deferred tax. So the formula for tax base of an asset and tax base of a liability is designed in a manner that it meets this logic. It meets this logic. I believe you are understanding this point. Okay, so this is the logic behind creation of deferred tax asset and deferred tax liability. IS 12 requires creation of deferred tax asset or liability only if it is probable that recovery or settlement of the carrying amount of an asset or a liability will have tax consequences. Otherwise, we will not create deferred tax asset or a deferred tax liability. Okay, now for all taxable temporary difference, we will create deferred tax liability. For all deductible temporary difference, we will create deferred tax asset subject to prudence limits. Now, how to assess it is a taxable temporary difference or deductible temporary difference? So ideally, the logic behind this is if it increases future tax payment, or future tax profits, it is a taxable temporary difference. If it decreases future taxable profits and future tax payments, then it is deductible temporary difference. This is the logic. But if you want to mug up, I have written the mug up point also. If carrying amount of asset is greater than tax base, it's a taxable temporary difference. If carrying amount of liability is less than tax base of liability, it is taxable temporary difference. Similarly, the opposite here in deductible temporary difference. Now, what are the prudence limits? So we have discussed in the classes that prudence limits means we have the sufficient future taxable profits in the year when deductible temporary difference are expected to reverse. So understand, how will we assess that there are future taxable temporary difference? So now standard says that, see, future taxable profits means that in the future I have profit. How will I get to know? Management will state me. Management of the company will say that, okay, in the company is expecting to make a future taxable profits. So understand, will we rely on what the management is saying? No, we can't rely. So what we have to see is if there are sufficient taxable temporary difference getting reversed in the year when the deductible temporary difference is reversing, then we can recognize deferred tax asset. Why? Because taxable temporary difference will increase the tax payment against which deductions can be taken. Okay. Now, or if sufficient taxable temporary difference are not there, then the company has sufficient tax planning opportunities, or the company can justify that I will have future taxable profits. If it is there against which I can take deduction, then the prudence limits are met and we can recognize deferred tax asset. Sir, but what if prudence limits are not met? Then we, for deductible temporary difference, we can't recognize deferred tax asset, and rather we will disclose unrecognized deductible temporary difference in the notes to accounts. Okay, if prudence limits are met, we will recognize deductible temporary difference as deferred tax asset. If it is not met, we will disclose unrecognized deductible temporary difference as notes to accounts. Okay, now, so we have to take tax rate. So temporary difference minus multiplied by tax rate is equals to your deferred tax asset or a deferred tax liability. Now understand here, which tax rate we have to take, enacted or substantively enacted tax rate we have to take, and the tax rate should be on the basis of manner of recovery. Let's suppose I have a property, plant and equipment, and my intention is that I want to use this property, plant and equipment and produce output and sell the output in the market, and recover the money. So what is happening? I am recovering the value of PP using revenue. So revenue will be taxed at the rate of PGBP, profit and gains from the business and profession. But if my intention is I want to sell the PP, then capital gain tax rate will be applied, right? So you have to see how exactly will you recover this asset. By sales of products produced from this, then normal tax rates will apply. If we want to sell this asset itself, then PGBP rate, capital gain rate will apply. Okay. Now, so I have written here how about the movement. If the deferred tax liability is increasing, deferred tax charge. If the deferred tax liability is decreasing, deferred tax credit. Credit means income and charge means expense. Okay. Now, how will you present that in SOFP? So in SOFP, you will record net deferred tax asset or deferred tax liability. You will net off. But understand, you will do the net off only when the deferred tax asset and deferred tax liability are arising from the same taxation authority. So let's suppose Infosys is operating in India and Infosys is operating in US also. From Indian tax laws, it is getting deferred tax liability, and from US tax laws, it is getting deferred tax asset. Can we do the net off? No, we can't do the net off. In that case, we have to show separately. But if Infosys is getting deferred tax liability from Indian law and deferred tax asset from Indian law, then it can definitely do the net off. Okay. Now in P&L, we will record deferred tax charge for the transactions recognized in P&L. In other comprehensive income, we will record deferred tax for the transactions recorded in OCI. Okay, that is revaluation gain. The best example is revaluation gain. Now, some special cases which are very important to be understood here. Some important cases. First of all, I will take up this case. A very easy and important point. Using this example, I will explain you the concept of current tax and deferred tax both. So now let us solve this question. So this question I have taken from ACCA FR, which is a very important point, question I believe. Ulington Company's trial balance show a debit balance of 2.1 million brought forward on current tax and a credit balance of 5.4 million brought forward on deferred tax. The tax charge for the current year is estimated to be 16.2 million. Now understand. So the question is talking about both current tax and deferred tax. So let us deal separately. So first of all, ignore deferred tax fully. Let us focus on current tax now. Has a debit balance of current tax. Tell me, what is the meaning of debit balance? So we have discussed debit balance means under provision in previous year, which we have to recognize as an expense in the current year. Sir, what if this would have been a credit balance means over provision in the previous year, which will reduce the expense of current year. Since it's a debit balance, I have increased my expense. If it would have been a credit balance, I would have reduced my expense. Okay, now. So 2.1 million is the debit balance of current tax. Now, what is the current year provision required? The tax charge for the current year is estimated to be 16.2 million. So what is the current year charge? 16.2. What is the previous year excess charge that we have to record? 2.1. So what is the current tax expense that we have to record? in P&L we will record 18.3. But now understand what is the liability that will go to P&L. What is the liability that will go to P&L? So in SOFP, what is the liability that you will record in SOFP? It will be 16.2. Sir, why not 2.1? Why not 2.1? Because 2.1, what does it mean? I'll tell you. So it means that in the previous year, let's suppose I made a provision of 20. In the previous year, for the previous year, I made a provision of 20. But in the current year, when I was making the payment of this, I had to pay 22.1. I had to pay 22.1. So this 2.1 is already paid. It is already paid, which we are recognizing as an expense in the current year. Sir, why are you recognizing as an expense in the current year? Because previous year FS is closed and this is change of the estimates. Change of the estimates has to be accounted for prospectively. 22.1 which we pay, 20 is already paid in the previous year. The remaining 2.1 we have to recognize an expense in the current year. So from where you got 20 and 22.1, I have assumed to arrive at a net figure of 2.1. I have assumed to arrive at the net figure of 2.1. Okay. Sir, what if we made a provision of 20 in the previous year, but in the current year we are required to pay only 17.5? Then what to do? Then it will be called as 2.5 ka. There is a credit balance which will reduce my expense of the current year. Why? Because we recorded an expense of 20 in the previous year, but ideally we are required to pay 2.5 only. So we recorded excess expense in previous year, which will reduce my current year expense. Okay. Now this is all about deferred tax. Now coming current tax. Now coming to deferred tax. So now deferred tax, it says the deferred tax shows a credit balance of 5.4 million. Credit balance of 5.4 million on deferred tax. Credit balance of deferred tax means what? Deferred tax liability opening balance. So opening balance of deferred tax is 5.4 million. Now what does it say about closing balance? The carrying amount of net assets are 13 million in excess of the tax base. Carrying amount of asset is greater than the tax base. It means taxable temporary difference of 13 million. What is the tax rate? 30%. So 13 multiplied by 30% is how much? 3.9 ka deferred tax liability, 3.9. So what is happening? Your deferred tax liability is decreasing. Your deferred tax liability is decreasing by 1.5. So what will happen? Ideally you will say it is a deferred tax credit. It's a deferred tax credit of 1.5 million, right? In the P&L you will record. But now the question doesn't end here. The question says this 13 million includes 3.3 million for revaluation surplus. And now tell me, where is the revaluation of building recognized in other comprehensive income? So if 3 million is recognized in other comprehensive income, which is a taxable temporary difference, now what will happen? We will need to recognize a deferred tax charge on it to the extent of 30% in OCI. So in OCI, we have to record a deferred tax charge of 0.9 million. 0.9 million I will record in OCI. But comes the question, what is the amount that I will record in P&L? So ideally P&L we would have recorded this amount. But out of this 0.9 I have taken to OCI. So what is the amount? 2.4 million credit in deferred tax. 2.4 million credit in deferred tax. So now what is the presentation? So understand the presentation. In P&L you are recording deferred tax charge, deferred tax credit of 2.4 million. In other comprehensive income, you are recording deferred tax charge. You are recording deferred tax charge of 0.9 million. 0.9 million, the expense. Okay. Now, what is the net? You are recording? Tell me, what is the net? 1.5 million ka deferred tax credit. 1.5 million ka deferred tax credit, which was the movement. And now in SOFP, what will you record? In SOFP, you will record deferred tax liability of 1.5 million. Sorry, not 1.5, 3.9. Sorry, just a minute. Income taxes. So in SOFP, I will say my opening balance was 5.4. I reduced it by 1.5. So it becomes 3.9 million that will come in SOFP. Deferred tax liability is what I will record in SOFP. I believe it is clear to all of you. Okay. Now we will move on to the other special cases and understand the same. Let us go to them one by one. Special cases. Business combinations. So we know that whenever we acquire subsidiary, we acquire the assets and liabilities of the subsidiary. We acquire the assets and liabilities of subsidiary at fair value. Okay, so now the standard says that if we have a fair value gain, if we have a fair value gain, that okay, we will record deferred tax liability on the same. If we have a fair value loss, we will record deferred tax asset on the same. Now goodwill on acquisition. So on goodwill we don't record deferred tax. Why? Because goodwill is not tax deductible. So on settlement of goodwill there is no tax consequences, hence we will not record deferred tax on goodwill. Now unrealized profit on intra-group trading. I believe in group accounts, you remember we studied something called as unrealized profit, right? So unrealized profit on intra-group trading. What happens? Parent has recognized profit, okay, but the group has not recognized profit. So parent recognized profit, parent would have paid tax on it. Parent would have paid tax on it. But the group is reversing the profit. So group is saying this is a tax, this is a profit which will accrue in the future to the group. Okay, group is saying that this is not the profit that I have realized as of now, but the parent has already paid tax on it. So it's a prepaid tax. So we have to create deferred tax asset on the same. Okay, now share based payments, the tax impact I have already discussed in the chapter of share based payments. So I will recommend you to go and watch it there if you are not watch it. So go and watch it there. Now carry forward of losses. So for carry forward of losses, it will decrease future taxable profits. So hence you have to create a deferred tax asset provided prudence limits are satisfied. Revaluation of PP. If there is a revaluation gain, we have to record deferred tax liability and the impact will go to other comprehensive income. If there is a revaluation loss, we will record a deferred tax asset. The effect will go to OCI because the revaluation loss gets adjusted from revaluation reserve. So the impact will go to other comprehensive income. But if revaluation loss is adjusted against P&L, then the deferred tax impact will also go to P&L. Okay, now this example I have discussed with you. Now moving on to the financial assets at FBT P&L. So if you have a financial asset at FBT P&L, so you will definitely record fair value gain or loss in P&L, but will you record this fair value gain or loss in tax books? No. So there will arise a temporary difference. So you will record a deferred tax liability with the corresponding impact to P&L. If there is a fair value loss, then you will record a deferred tax asset with the corresponding impact to P&L because this fair value gain or loss goes to P&L. Now, in case financial asset is at FBT OCI, then we will definitely record deferred tax asset or deferred tax liability, but the effect goes to other comprehensive income. Okay. Now, if it is a lease transaction, then what happens? So understand in the case of lease transaction, I will explain with the help of example. So understand. So let's suppose I have taken an asset on lease for 3 years, paying 100,000. Discount rate is, let's suppose, 10%. The present value is 249. So here I record ROU asset of 249 and a lease liability of 249. Right now we need to evaluate what is the tax impact. So let's suppose we arrive at year end 1. Now we are saying for this lease transaction, what is the lease liability that I have? 249 plus 24.9 minus 100 is 174. Now what is the ROU? 249 minus 249 by 3, that is a depreciation for this year. That is 166 is the ROU, the carrying amount at year end 1. So what is the net carrying amount that you have? 8. 174 minus 166 is 8. Now tell me, in the case of tax books, are we recording lease liability and ROU? No. So tax base is 0. So temporary difference is 8. So we have to record a deferred tax asset of 2.4. 8 ka 30% is 2.4. Sir, can you please explain the logic behind this? Okay, fine. So understand, in the accounts books, we would have recognized pertaining to this lease transaction. What is that we have recognized? Finance cost and depreciation. So now tell me, what is the finance cost that we have recognized? 24.9, round of 25. Now what is the depreciation? 249 divided by 3, somewhere comes to 83. So total expense of 108. What is the expense that I will recognize in my tax books? The amount that I have paid, 100. So it is 100. So what is the difference? 8 is the difference. It means what? I have recognized excess expense in my accounts books. Okay, excess expense in my accounts books, for which I will get the benefit in the future, for which I will get the deductions in the future. So it's a future deductions, hence I have recognized a deferred tax asset for the same. Okay, now disclosures. though disclosures are not there in the syllabus, but yes, you can see these disclosures. You have to recognize, you have to disclose unrecognized taxable temporary difference. Plus, if you have to disclose what is the accounting profit, what is the taxable profit, what is the reconciliation between the same, what is the account, what is the tax expense that you have recognized in your accounts P&L, and what is the tax payments that you have recognized in your tax P&L, and what is the reconciliation between the same. Okay, what is the actual tax rate, corporate tax rate, and what is the effective tax rate that you have paid. So a reconciliation between these three is required to be given in the disclosures. So this completes my tax expense as well. Now coming to small chapters like IAS 1 A24. Now I'm not discussing these chapters because there is nothing for me to discuss in these chapters, but what I have done is I have made simple notes for you to go through it and understand. Okay, so now tell me, IAS 1, what are the components of financial statements? Financial statements should show a true and fair view. What if I take departure from IFRS? Okay, what is the meaning of going concern? So all these things are the bare minimum, which I believe you already know. So there is nothing, there is no need for me to explain here. But yes, I have simplified the notes for you so that if you read it once, you will understand it. But still, if there is any query, you can put your query in the Telegram group and it will be sorted, and I will ensure that it is resolved. But now a final note to you guys, understand here. See, in this revision, we have helped you in revision of the entire group accounts. But see, I have made a video on few guidance or the instructions for the pre-populated screen, which I will recommend all of you to watch it. Link will be given in the description box. For ethics also, I have guided the entire approach. The link is given in the description box. Okay. For APM, you have to prepare on your own. There is nothing that I can guide you in APM. IFRS for SME, again, this is something you have to prepare on your own. Now, current issues. What are the current issues which you have to focus on? IFRS S1 and S2. The video of that is already uploaded. What I'll do is I will put the link of that video in the description box. Cryptocurrency, I've already made a video and uploaded. I will put the link of that in my description box. Now this is very important, all about other comprehensive income. So what are the items that goes to other comprehensive income, and how does it move from OCI to P&L or OCI to retained earnings, from OCI to other equity? How exactly it moves? It is a very important. In almost every exam, I see a question on other comprehensive income. So I will request all of you that please go and watch it. I've already made a video and uploaded it for you guys. So I will paste the link of that in my description box. Now, SBR last 12 attempts examiner report analysis is what I have done for you guys. Okay, so wherein I have guided what are the mistakes which you are required to avoid in your SBR examination. So please go and watch it. Okay, super 30 questions of SBR also I have posted. So I will recommend all of you to go and watch it. Okay, pre-mock will be uploaded today, and the link of all these videos will be there in my description box. So please go and watch all these videos. It will be super helpful for you. Yes, and also join my Telegram group for the notes of this class. So for the notes of this class, please join the Telegram group. Okay, now technical articles to be studied, I already told. IFRS S1, S2, cryptocurrency, they are the most important. And ethics in digital age, there's a technical article, ethics in digital age, that is also one of the important articles that you must read. And I believe with this, our SBR revision comes to an end, and I believe you enjoyed the session. So please do give a feedback in the comment box. Okay, that's all for today, guys. Thank you. Bye.